Hello, Namaskara, Vanakkam. I am here with the much awaited CMA Final Law Marathon. Of course, abiding by the restrictions imposed by YouTube on us, we cannot upload a video which is beyond 12 hours. So, we had to split our marathon into two parts. You already know that the marathon in a mix of Hindi and English has already been uploaded, mostly considering the North Indian students, of course. So, if you are willing to see a marathon which is a mix of Hindi and English, you can check out the marathon which is already uploaded. Secondly, this is just the first part of marathon which comprises of company law portion, basically, that is the corporate law, strictly in the sequence and covering the exact syllabus of CMA final law. So you don't have to worry about all that. And it's completely amended, undoubtedly. Moreover, the second part will be coming soon, so keep the channel subscribed. As of now, I have put in a lot of effort in making this marathon and as well as my full course, of course. So, if you are looking for full course, then you have to visit our website bookmyvideo.in, or you can download our app bookmyvideo. But this is only revision. Okay, so if you want that conceptual clarity, of course you will not get through this video. If you have slight knowledge, then this is going to be of tremendous help to you in revising the whole subject in a concise manner, and rather I would say in a time bound manner. Okay, but if you're looking for conceptual clarity, you haven't ever read the subject, then I would insist that go for the regular full classes which are available. Okay, and here, of course, I have taken efforts. So what is your duty as a student? Your duty is just to like the video, comment the feedback, and spread and share it with all the students who need it, junior, senior, peer, everyone, right? Okay, and one more thing, because I'll be using the charts throughout the marathon, and some students, of course, my registered students, they have my handwritten charts, they have my question bank, they have my books, they have everything. But the students who are connecting to me through YouTube, they do not have this handwritten charts. You can do two things. Option number one, you can scroll through the video, and along with the video you can note whatever important parts you have to or you want to. Of course, I know that will be difficult, but we also have restriction, we cannot just provide it like that. Secondly, if you are willing and you are capable, then you can purchase the charts. The hard copy book of charts is also available, which can be obtained, or the order can be placed on our website. As I mentioned, bookmyvideo.in, right? So, without wasting any more time, I am leaving you with this marathon. Hope you enjoy the same. Hope this is helpful. I'm sure this is going to be helpful not just now, but even just before your day of exam, because you have a huge syllabus to cover, but very less time for the same. So it's going to be of tremendous help. Thank you. And now let's start the same.
Hello everyone. Let's start our class, and this is basically the revision class. Whatever we have studied in chapter number 1, that is companies formation and conversion, before we actually go on to discuss the questions, because see, we have read the whole chapter, we devoted so many hours in this chapter, but before we actually do the questions which are essential for your examination purpose, so we must focus on presentation, we must focus on what type of questions may be asked in the examination. So we will do all that, right? But before we go on to our questions and answers, we need to revise our chapter. Certainly, we need to recall all the concepts. Now, I'm not going to do this revision as a very superficial one, as if just cramming all the things and trying to read it as they are. No, we are not going to do that. We will focus on in-depth revision. So one by one, all the topics related and covered under this particular chapter, we are going to revise them. Fine. So here we start our revision of company formation and conversion. So we had a lot of concepts in this particular chapter. We'll start one by one. I hope you all are ready with the charts as well as the material provided by me to you, because we are going to revise it from the charts as well as the material. So both should be handy with you. And let's start. See, one simple reason, I think I've told this before also, and I'm telling this again also, why we can't take up revision, or as of that matter, the whole classes from the institute's material itself, because that material is first of all not updated, not in the sequence as I want it to be, not covering the questions or examples that I want to be, right? So we had to modify it a bit. Of course, the complete coverage is from the institute's material itself, but with necessary changes. So mutatis mutandis, right? Now, let's start our revision of the first chapter, company formation and conversion. So here we begin. First of all, the first thing, what do we mean by a company? Because we have started with company law, we are going to read about Companies Act, we have to read about company, how is it formed and all that. So what at all you mean by company? That is the first and the foremost question. Okay, so company basically is, if you understand the meaning, it is a group of people. A group of people who voluntarily want to come together and do a certain business. They have a common objective, that is called as a company. But if you go by the definition, that's not what a company is. I mean, maybe 4 people are working together. Can they be called as a company? No. They will be called as a company if they're registered under this act. If they're registered under this act of previous company law. So according to section 2, clause 20 of Companies Act 2013, a company is going to be called as a company only if it is registered under this act of previous company law. Previous company law, that means any previous company law. Fine. We have certain basics of Companies Act. If at all you choose this particular form of business organization, that means you have chosen company. I want to start a business. I have chosen that I am going to form a company. If I choose to form a company and I form a company, everything from scratch till end, from tip to toe, is going to be governed by Companies Act 2013. How am I going to form the company? How am I going to run the company? How can I close the company? How can I take decisions in the company? Everything will be told by and under Companies Act 2013 only. So what is Companies Act 2013? It is nothing but a law which governs this form of business organization known as company. So if I want to run a company, I have to follow this law. I have to follow this act. Just like if I want to drive on road, I have to follow Motor Vehicle Act. Likewise, if I want to run a company, I have to follow Companies Act 2013. Now, Companies Act 2013 is huge. It's divided into 29 chapters, 470 sections, 7 schedules and a lot of rules. Right? So, ma'am, we have to read the whole Companies Act. No, you have a limited and a selected coverage, although it's again huge. Because you are at the final levels, what can you expect? You cannot expect a coverage of 10-20%. It's a huge. But still, it's not complete, right? Now, this act is applicable to the whole of India. It even extends to the special types of companies, that is banking, insurance, electricity. Banking, insurance, electricity also have the respective laws. So if there is any contravention, if there is any confusion, if there is any conflict between what is given in the specific law and what is given in Companies Act, the specific law will prevail over Companies Act 2013, right? Under this act, for companies, we have different authorities. What are the authorities? We basically have ROC, which is Registrar of Companies. Registrar of Companies, they maintain full records relating to the company, right? See, the whole country is divided into different states, and every state has a Registrar of Companies. In 2 states, we have 2 ROCs also, right? Now, if supposedly I am a company, I want to start business in a state of Uttar Pradesh. So, I am going to form a company in Uttar Pradesh. My complete records will be with ROC Uttar Pradesh. So, ROC is an authority which maintains all the records, where we do all the filings. Although we don't have to walk in physically anywhere, now the complete thing is online. So we go to a website mca.gov.in and we do the necessary filing. All our records are the records of all the companies. They are sent to the respective ROCs through that online platform only. Apart from this, we also have a regional director. Regional director who is the head of the region. So in one region there might be some 2-3 ROCs, so that is the regional director. Okay, apart from that, we also have NCLT and NCLAT, National Company Law Tribunal and National Company Law Appellate Tribunal. They are the replacement of courts for corporate matters. So if there is any dispute, they're the governing body where we can approach, right? Slowly and steadily you'll realize everything. NCLT is also constituted under Companies Act itself, fine. So that is what the administration part, basic part that you must know about Companies Act. Fine, ma'am. Now, since we are starting with Companies Act, we must know certain things about the company at first place. Okay, ma'am. So we will first analyze the basics of company. Company is an artificial person. That means it cannot see, it cannot hear, it cannot speak, it cannot marry, it cannot get divorced. So nothing like that, because it is an artificial person. Then what can it do? It can hold property. A company may have a bank account of its own. A company may have a land of its own, right? A company may sue. So that means it is given a legal identity to do legal things, to obviously, but it is an artificial person. It is not a natural person. It gets birth by law. It is dissolved by law, right? It dies by law. Then comes your separate legal entity. That means the company is different from its members, directors, whoever you call it. The company is different and we are different. One simple thing, if I am doing a proprietorship business, I take a bank loan of 10 crores and I'm unable to repay it, what will happen? The bank officials will pick me up, my children, my parents, my house, my car, everything they can pick me. They can pick, not literally, but kind of, right? But if I form a company, I am running the company, I have formed the company, but I have taken the loan in company's name. So company has taken a loan. If company doesn't pay the loan, company will suffer. I will not suffer. So my property, my parents, my children, they're all intact, right? Nothing is going to happen to them. So that is what is the simple thing which relates to both these points, kind of separate legal entity and limited liability. Basically, we're different. The company is a different identity. So whatever company is doing, company has to be liable for that. I cannot be held liable. It doesn't matter. I am the one who's running the company, right? For this, we have a very famous case law. Salomon versus Salomon and Company Limited. I think this is one such case law which everyone remembers. What happened in this particular case law? Let's have a quick recall. There was a person named as Salomon. He was doing a business of leather and boots, great. He decided to form a company and he formed a public company. So for public company, you need at least 7 people. He got all that 7 people in-house only. He, his wife, his daughter and his 4 sons, right? So they all formed a public company. he kept all the shares with him and gave one share each to all this different people. Now, this is a business of leather and boots. He formed a company. Now, this company is going to take over the business of leather and boots. So, whenever you take over some business, you pay something that is known as purchase consideration. So, the company paid the shares, gave away shares in exchange of the business to Salomon, his family, and also some debentures. Now, see what happened. In the balance sheet of Salomon and Company Limited, there were assets and there was share capital, there were debentures, and there were other creditors also. Fine, ma'am. After some time, this could not turn out to be the best of business and eventually ran into financial difficulties. So there was financial stress and the company had to be closed. What happens when the company has to close down? The assets of the company are sold, and out of the money realized from the asset, the liabilities are paid off. Fine. The liabilities are paid off in a sequence that first of all we'll pay the debenture holders, then we will pay the creditors, and then we will pay the shareholders. Fine. These creditors got really angry and they said that the company is paying first to the debenture holders, which is who is nothing else, no one else but Salomon himself. That means Salomon has formed a company, he was running the company, and when the company ran into financial difficulties, through this debenture mode, he is taking all his money and we are left with nothing. So do you think it's fair? The court contended, yes, it's fair. Why? Because Salomon is different. He is taking money in the capacity as a debenture holder, and the company has to pay money in order of whatever has been stated. So Salomon is different and his company is different. Whatever company is unable to pay, it's not because of Salomon. Right, so this is a principle which was established in the case of Salomon and Salomon Company Limited. Fine. I think that's clear. Now, next is limited liability. What do you mean by limited liability? See, the liability of company is unlimited. That's not limited. That means if a company takes a bank loan of 10 crores, it cannot say that I am going to pay only 5 crore, my liability is only up till 5 crores. No, whatever your liability is generated, you have to pay. So there is no limit on the liability of the company, but the company cannot take money from its members or cannot force the members to pay money. Like it happens in proprietorship, as I told you, right? See, if there are 4 members and each of them has agreed that I will buy 10 shares of the company each. Fine. Now, supposedly one shareholder, the final price that the shareholder had to pay to the company for his shares was 10,000 and he paid only 5,000. So company can ask for balance 5,000. No, company will say that you had to give me 10,000. You have given me only 5,000. So you are liable for 5,000 more. That is, the member is going to be liable for the unpaid money, the money which you have not paid on the shares which you hold. Right. We have a different type of company called as limited by guarantee also, in which the members undertake to guarantee. Supposedly one member has given a guarantee of 1 lakh, other has given a guarantee of 50,000. So his liability is 50,000, limited to 50,000. His liability is limited to 1 lakh. Right. So a company can be limited by shares also, it can be limited by guarantee also. When we go on to read the different types of companies, we will understand this even better. Great. Next is perpetual succession. No matter who comes and who goes, the company is going to go on and on and on. How many of you know LIC? When was it formed? Do you think when it was formed till now, there is one person who's running LIC? Someone comes, someone retires, someone dies, someone comes again. But LIC is going to go on and on and on. LIC is not a company, it is a body corporate. But the feature of body corporate is same as of a company. Supposedly Mr. Ambani formed Reliance Industries Limited. Now what is going to happen to the company? He dies, the company dies? No. The company goes on and on and on. He dies, someone else comes. In private company, usually the businesses are being run by the family itself, but in public companies, there are different people who are hired, there are different people whose shares get transferred, there is government may be involved, so government, if it is involved, sometimes the other person is president, sometimes the other person is president, right? So it is the office. President or central government holds shares of the company. The government keeps on changing, but the shares are held, right? So it doesn't matter who comes and who goes, the company goes on and forever. Next is common seal. Now what is common seal? That's common seal. Company doesn't have hands to hold a pen and actually sign. The company cannot do that, right? So there was a concept of common seal, that we have prepared an official signature of the company. So if company is buying that particular shares or buying that particular property or dealing with any person, entering into a contract, the company will sign, affix that stamp, that is known as common seal. Now eventually over the period of time, government realized that since the company doesn't have actually hands, the company cannot pick up that stamp and put it wherever they want to. So company is not making a decision. It is the ultimate directors who are making a decision, who are picking up that stamp and affixing them. So instead of picking up that stamp and affixing it, why don't they themselves sign it, right? So over the period of time, companies' common seal was made optional. So now we have it optional. It is not mandatory for every company to have a common seal. Some companies may have that common seal, some companies don't have common seal. So in companies where you have common seal, that is affixed on every document, if there is no common seal, the persons who are representing company in the dealings, they sign it, right? We have proper provisions for the signing part also. Okay, now next is transferability of shares. Transferability of shares. What do you mean by transferability of shares? We all have heard about stock exchange. In fact, nowadays, these times, everyone has a demat account and you're doing some share trading for sure. Maybe you're not an intraday person, maybe you hold shares for a longer tenure, but whatever it is, you're buying shares, you're selling shares, and you're making money. At times losses too. But the whole point is that you are buying shares and you're selling shares. When you sell shares, what are you doing? You're transferring the shares from you to someone else. You do that, right? Although in a private company, you cannot freely transfer shares like this. That means you cannot do that. Okay, you take my shares, someone else is selling the shares to someone else. We have conditions, we have restrictions, but otherwise the shares can be transferred from one person to another. What do you mean by share? Just like any form of business organization, it has capital. The company also has share capital. Share capital is the total amount of money that the company has raised, right? So supposedly the share capital is 10 lakh rupees. The company may decide, the company cannot raise this 10 lakh from one person itself, right? It is from all the members. So the company may decide that, okay, I'm going to keep the price of my share at 100. Someone can buy just one share, someone 2 shares, someone 100 shares, someone 500 shares, right? So share is nothing but the smallest unit of division in the share capital of the company. Okay. Separate property. Separate property. Okay. What do we mean by separate property? Just like company is different from its members, so is its property. Let's say, for example, Mr. Salomon, he formed a company, right? And he wanted to buy a car maybe. He bought it from company's bank account and in the name of company itself, and decided to use it personally because he wanted a car. His wife wanted a car, his children wanted a car, so he did that. He said, it's my own company, I'm going to buy from the company's bank account and I'm going to use it personally. Now what happened is the company was closed. Company was shut down. Do you think Salomon can claim that this car belongs to me and not the company? So this should not be sold and the liabilities of the company should not be paid out of the proceeds of this car. He cannot claim that. Why? Because no member can claim himself to be the owner of company's property, right? Not when the company is running, not even when the company is going to be wound up, right? So that is something which is not possible and which is not allowed, right? So company does not even, that is what separate property means. This is another line which has a case law of McQuarrie also, but I'm not explaining you here in the revision class. Now, capacity to sue and be sued. See, if I enter into any transaction on Flipkart, now I have a complaint. Who am I going to sue? The owners of Flipkart or the Flipkart company itself? Flipkart. Because company is a separate legal entity, I can sue the company. If they have a problem, they will sue me, right? So they can be sued and they can also sue, right? It means filing a suit. Filing a suit or case in a court of law. Okay. Now, a new concept. Corporate veil. What do we mean by corporate veil? What is it? See, veil means a curtain, a kind of protection. Why do we put curtains in our houses? To protect us from the sunlight, or maybe we want some privacy. We don't want people to see us. We want to hide behind the curtains. That is what the curtain, that is what is the purpose of curtain, right? Now, that is what is the veil of incorporation. Whenever a company is formed, although every action that this company is doing is being guided or is being actually done by these directors or by these members, whatever you call, right? Directors, members, they're different, but I'm trying to explain you the concept of corporate veil over here. Fine. But still, if a company does not file some document, company is responsible. Penalize company. Company will pay penalty. Although I am the one who forgot this deadline. You get my point. I am the one who forgot this deadline. But this is a protection which the members of the company get. That they are different from the company, they are shielded, they are protected from company's actions. That whatever company is doing, company is going to be liable and I am not going to be liable for that. Fair enough. But what if they actually do some fraud in the name of company? They know that they are never going to be caught. So what they do is they enter into some contract, take money from bank and they run away. And even if they are caught, they will say that company has run away. Company took the money. I did not take the money. Or you are the one who is using the name of the company and filling your pockets or doing whatever you want to. So in these situations, we lift this curtain. We lift this particular curtain and we want to really see who is hiding behind this company, because they are the ones who are doing wrong and they are the ones who deserve to be punished, right? So that is known as lifting of corporate veil. when the law disregards the corporate entity and actually looks at the individual members who are doing it. Now, see, we have some statutory provisions and we have some judicial interpretations. What are these? What are you trying to tell us? See, statutory provisions and judicial interpretations. Supposedly, I called a company has cheated on me. See my potential, the company will cheat on me. So let's say, for example, the company has cheated on me and I drag this particular company to the court. The court penalizes the company, but I actually emphasizes on the court that it is not the company which is cheating, it is the management of the company who are doing this. And if you leave them like this, they will again do like this. So they are fraudulently, they are defrauding the people around, and their intention is that only. So don't leave them. The court says, but the company is different and they are different. How can I penalize them? So I will find out a way. In these type of circumstances, in these type of situation, the court says, fine, we will lift this particular curtain and we will penalize the actual person who is doing that. So at times, in a lot of judicial cases, this has happened when the court has disregarded this separate legal entity concept and has actually penalized the one who is involved. Fine. So has removed this, has not paid any heed to the protection which is given to the members. So these are the judicial cases which we read over here. Now, we have some statutory provisions also. That means even in Companies Act 2013, there have been many instances like if there is a mistake in prospectus, of the company. Now, ideally, this is a mistake which has been done by company, so company should be penalized, but court say, but the provisions of Companies Act, the statutory provisions of Companies Act tell us that no, not the company. For this, we will make the people who have made this prospectus, they are going to be responsible. So these statutory provisions we read over the period of time under Companies Act, but the judicial interpretations are given here itself and we are going to read them. Fine, ma'am. First of all, protection of revenue, Dinshaw Menegji Pettit. What happened? What this person did is, he had a lot of income and he had to pay taxes. For avoiding taxes, he formed 4 companies and he transferred some of his investments to these 4 companies. Now, these 4 companies are doing nothing. They're just formed to hold that investment. So, in this way, he reduced his tax burden. Court realized that no, he has formed the company only to evade taxes and there is no other purpose for these companies to be formed. So in such a case, we will lift the corporate wheel and we will not say that the company is different and Dinshaw Menegji Pettit, you are different. No, we will club it all. And every income will be treated as the income of Mr. Dinshaw and accordingly he will be taxed. Fine. Next is determining enemy character of the company. What is determining enemy character of the company? You have heard about, you have read about actually Indian Contract Act and you know the concept of alien friend and alien enemy. Supposedly, not that I want it ever, and with no controversies or no offense, supposedly India is at war with Pakistan. Fine. Do you think in the times when there is a war going on, any people of any one of India would want to enter into any contract with a person of Pakistan? Or any person of Pakistan would want to enter into any contract with the person of India? Do you think that's going to happen? That's going to happen? No, ma'am. Fine. Now just think of this. We have this Pakistan and we have India. We have a company. We have another company. They both are Indian companies, so they can contract with each other. They can enter into a contract. That's the problem? No, ma'am, that's definitely not a problem. But this particular company is being run by all Pakistanis. All the directors, all the members, they're all Pakistanis. Now, do you think entering into a contract with this particular company who's run actually by Pakistanis, don't you think it is not fair? But this is an Indian company. If we keep this concept of separate legal entity alive, this company is different and this is different. So they can't be said they have a separate legal entity. But in this situation, they will lift the corporate wheel and look behind the real persons to determine whether this particular company's character, its particular character is of enemy or of friend. Fine. So that is Daimler Company Limited versus Continental Tire and Rubber Company Limited. Now the next, Smith Stone and Knight Limited versus Lord Mayor. Now this is basically what you have to remember in this is, a company has formed other company to act as an agent. Now you have to remember that the agent binds the principal. It does not bind himself. Right, so the agent and principal, they're one thing only. Whatever agent is promising, it is ultimately going to the principal itself. Right, likewise, if I have formed a company to become my agent, it is not a different company, it is me only. Fine, so in such cases, corporate wheel may be lifted. Then we have State Officer Chandigarh versus SE's Information Technology Limited. In this case, corporate wheel could be done in case of transfer of shares of a company which actually was sale of land which the original allottee was prohibited to do so. What is happening over here? One company has been allotted some land, and on the condition that this land is not going to be transferred for at least 3 years, the company transfers some shares to another company maybe. Now what is happening? The ownership of this land is somehow shifted to another person. However, the transfer of land was not permitted. So in such a case, we cannot say that no, members are different, company is different, etc., etc. We will club it all and we will look behind the real person who has done this, right? So we cannot say that there is a wheel of incorporation. That wheel is going to be lifted in this particular situation. Fine? Okay. Now, next. Company formed for fraud, Jones versus Lipman. Fraud is a case where definitely corporate wheel is lifted. And lastly, we have avoiding legal obligations, Workmen of Associated Rubber Industry Limited versus Associated Rubber Industry Limited. See, we all know about a Payment of Bonus Act, right? What is happening in that particular act? Whatever profit company makes, some portion of that profit has to be given as bonus to the workmen. If a company makes more profit, more bonus will be given. If a company makes less profit, less bonus will be given, right? So accordingly, the bonus gets adjusted. Just to avoid this bonus or just to lower this bonus, what this company did is formed a company and transferred some income to that particular company. What happened? The profit reduced and the bonus also reduced. Court realized that the company is being formed just to reduce the profit so as to not take payment of bonus, which is avoiding your legal obligation. If you try to avoid your legal obligation, then we will not consider this as a different company. We will consider this as one only. This will not get this shield or protection that they are different. They will be considered as one and accordingly have to pay bonus. Clear? Okay, ma'am. Now, classification of companies. We have different types of companies about which we have to read. First is on the basis of incorporation. Registered company and statutory company. First of all, what is statutory company? It's like LIC. In common parlance, we say it as statutory company, or that's what is it? It's a body corporate. They are not registered under this act. They are formed under a special act of parliament, directly under a special act of parliament. And for the companies who are registered under this act or previous company law, as I told you, under the definition of company, they are called as registered company, or as of that matter, only company. Fine. Then we have on the basis of liability. See, the members, companies' members, their liability may be limited, their liability may be unlimited, although that's hardly a case that you'll find now. Unlimited company, wherein the most beautiful feature of forming a company, why do you form a company? To avail this particular feature of being limited liability. So if anyone is getting unlimited liability in a company, why will you form a company? Right? So this is not something which is very practical, firstly. Secondly, the member's liability may be limited by shares. It may be limited by guarantee with share capital, by guarantee without share capital. Limited by shares, I have already told you this. Limited by guarantee, I have told you this also. If it is having no share capital and having share capital, supposedly I am a member in a company and my liability is limited to the amount of shares, to the amount I have not paid on shares. I hold 10 shares of 1,000 each. On that, I have paid only 500 rupees each. That means 5,000 I have to pay. So if company calls for that 5,000, I have to pay because I'm liable towards the company for that amount. Supposedly, I'm a company which is a guarantee company. I have taken a guarantee that I am going to pay 1 lakh to the company. So if company asks for that 1 lakh, I will pay that 1 lakh. Supposedly, I'm a combination of this. That means it is a guarantee company with share capital. So I have taken a guarantee of 1 lakh plus I have shares of 10,000. On guarantee, the amount of liability is 1 lakh and on shares, the amount of liability is say 5,000. So my total liability comes out to be 1 lakh 5,000, right? So I hope you have understood that there can be a company which is limited by shares, there can be a company which is limited by guarantee, and there can be an unlimited company also. Okay, next. On the basis of members. On the basis of members, we have 3 types of companies. Private, 2 members at least. Public, 7 members at least, and 1 person company with just 1 member. So these are broadly 3 types of companies which may be formed even according to Companies Act. Section number 3, you will read it later. Now let's read about these type of companies one by one. I'll take you to the charts. Private company. Section 2, clause 68. Private company, what is it? It's a private space. Just like your private parties, no public can, no outsider can enter into a private space, right? Whoever you allow, whoever you invite, only that person can attend your private party. So it's a private company. It has its own private space. Public is not allowed to enter into that private space. So private company is formed with just 2 members. Minimum number of members required to form a private company is 2, and the maximum number of members that is required, that can be in the private company is 200. So minimum 2 and maximum 200. Fine. How do we identify, ma'am, whether it's a private company or it's a public company? See, Reliance Industries Limited. Can you read or can you find a word private? So it's a public company. Reliance Industries Limited. Limited. It's a limited company. The liability of the members is limited and it's a public company. What if I say ABC Private Limited? It's a private company. So where the suffix private limited is added, it's a private company. If the suffix SIF only limited is added, then it is a public company. And if in bracket it's written one person company, so it's an OPC, right? So that's the difference between three types of companies. Now, private company, there are three things in a private company which distinguishes it. In the Articles of Association of a private company, there is a restriction on transferability of shares. There is a limitation on the number of members, that the maximum number of members can be 200, and there is a prohibition on inviting public to subscribe to its securities. See, as I told you, in private company, the shares cannot be freely transferred. I mean, if I have got the invitation to attend my friend's birthday party, I cannot give it to some random person and say, see, I have got the invitation, you take this invitation and you can also go. But if I've got a pass to some public concert and I'm not going there, I can give the pass to someone else also, right? Likewise, the shares of a public company, they're freely transferable, but the shares of a private company, they cannot be transferred to anyone like that. But they can be transferred. There is a restriction, there is no prohibition, fine, but at no cost you will give this general invitation to public. So public cannot subscribe to securities at all. You identify a person, okay, you have been given an invitation, that is okay, but not to the general public, fine. Now see, suffix private limited in articles, you have restriction, prohibition, limitation. One person company is nothing but like a private company. It is a private company with some special features. Small company again is a private company. The number of members minimum 2, maximum 200. Exceptions, present and past employees. That means if there are 160 members in a private company and that company decides to come up with ESOP, employee stock option plan, and wants to give away shares to its 50 employees, the shareholders, the number of shareholders will rise to 200. Will it amount to non-compliance of this section? The answer is no. Why? Because these 50 will not be included when we are counting this limit of 200. So the present employees or the employees who have left the employment but continue to hold shares, that is the past employees, they are also not included. Fine? Okay, ma'am. So that's about private company. See how in-depth revision we are doing. Then we come to public company. Section 2, clause 71. One which is not a private company is a public company. Great. So we add suffix limited. It's not a private company. The number of members minimum 7, maximum there is no limit. 200, 500, 5,000, 5 lakh, 5 crore, no limit at all. The public company can be started with which, how much capital, ma'am? See, there is no requirement which has been prescribed for either public company or private company as of now. No minimum paid up capital requirement has been specified for private company or public company. Okay. In articles, obviously, there is no such restriction, prohibition or limitation. And one special thing about the definition of public company is that the subsidiary of a public company is deemed to be a public company. What do we mean by that, ma'am? Supposedly, we have a public company and that public company holds 60% shares or bought 60% shares of a private company. Now, this particular private company will not get the exemptions of being a private company. because in this company a lot of money of a public company is at stake. So if this becomes a subsidiary, you will read about holding subsidiary later. You have read about all of it, we are just revising although, but still, right, this particular company will be treated as a public company and will have to comply with all the requirements for a public company and will not get any exemption which is given to private companies. Fine. Okay. Moving further. One person company. Section 2, clause 62. One person company are special types of companies. They are it's basically a private company, but it has some unique features. What type of features it has? There is just one member needed. See, earlier also there was a concept called as one man company, and now we have one person company, which is basically to help and promote the individual or sole proprietors, right? So they can also get that status of being a corporate and enjoy the benefits of incorporating a company. No minimum paid up capital required. See, one beautiful feature of a company is perpetual succession. That means no matter who comes and who goes, the company is going to go on and on forever. But in a one-person company where there is just one person who is managing the company, he is the one who is the director also, and if he dies, what will happen to the company? Who will take up the company? What is going to happen? The company will run into financial difficulties and will close down for sure. So to avoid that situation, the Act has come up with an idea and has specified that in a one-person company, you must appoint a nominee. Just like you do for your FDs. If you open an FD, you give a nominee. If you take a policy, you have a nominee. What if I die? All the money should go to my nominee. Likewise, what if I die? All the control should go to my nominee. So the nominee will become the sole person of the company. So that is one beautiful part and one different part about one-person company. Okay. One-person company, a natural person, that means a company cannot form another one-person company. It has to be a natural person. It has to be Indian citizen, whether resident or not. I am an Indian citizen, I am a natural person, I don't live in India, I love to live in abroad. I can form a one-person company. How do you determine whether I am a resident or not? If I am there in the preceding year for 120 days, I am a resident. At least 120 days I am a resident, but doesn't matter whether I am a resident or I am a non-resident. I can still form a one-person company, or I can be the nominee of one-person company. I can still be. Okay, so this is something, natural person, Indian citizen, whether resident or not, I can incorporate a one-person company. Fine. I can incorporate a one-person company. The special thing is that I have to name a special person who is going to act as a nominee. Usually in my classes, I give this classic example that forming one-person company is like finding a girl for your marriage, right? It's like getting married, in fact, right? And we establish the differences and similarities, and it's good. But right now it's kind of same. See, if I take a policy, if I'm taking a life insurance policy, I say if anything happens, whatever amount of policy is should be given to my son. Okay. I don't need permission from my son to make him my nominee, because he doesn't have to do anything. All he has to is to receive money. So it's for his benefit. He's not liable towards anything. But when I am making someone my nominee to run the company, I have to take that person's consent also. His permission also is needed. If anything happens to me, you will become the sole member. So now you will be responsible for non-compliance and all that part, right? So you have responsibility. This is a responsibility that I'm giving. So I need to also obtain consent prior hand. So that consent I have to obtain. That consent may be withdrawn also. After some time, I find that no, I don't want to appoint this person as nominee. Fine. I'll not appoint this person as nominee. I'll change the name of the nominee. He thinks that no, I don't want to run her company. So he can also withdraw the consent that he has given. So that is also an option which is permissible. There is a form, in fact, INC 4, through which you can do that, right? Through which that can be done. Now, only one person as member, minimum paid up capital, no limit. Memorandum is going to indicate the number of the nominee's name. His consent is to be obtained. He can withdraw the consent. This person has the right to form one-person company. Minor cannot be the member of one-person company, and a one-person company cannot be converted into a Section 8 company. What is Section 8 company? Section 8 company is a company which is formed for charitable purpose. Okay. See, a single person cannot do all that task which is needed in charity, so he cannot form a Section 8 company, although he can convert his company into a private or a public company. Right? Now, next, on the basis of control, we have holding company, we have subsidiary company, and we have associate company. What is holding company, subsidiary, and associate? They are basically relative concepts. They cannot be read standalone. Oh, this is a holding company. Oh, this is a subsidiary company. No, you cannot say that. You can say this is a private company, this is a public company, but you cannot say this is a holding, this is a subsidiary. Holding to what? Subsidiary of what? Right? So they are relative concepts. Fine. How are they related? We have two companies. One company holds more than 50% of voting power on this company. This will be called as subsidiary and this will be called as holding. More than 50% means, ma'am, 50.000001% is also more than 50%. Voting power is as good as share capital unless you have differential voting rights shares. Right, so if you have DVR shares, then it's slightly different, Otherwise, voting power is as good as share capital. So if this company holds 60% shares of this company, this is subsidiary and this is holding. We also have another condition. If this company controls the composition of board of directors of this company, then also this is called as subsidiary and this is called as holding. So these are two cases in which the company can become a subsidiary and this company can become a holding company. One company can have a lot of subsidiaries, but layering of subsidiaries is not allowed. That means A has 60% shares of B, B has 60% shares of C, C has 60% shares of D, D has 60% shares of E. This is layering which is not allowed. Fine. Why? Not exactly why, we cannot get into every if and but right now in the revision video, but two layers, beyond two layers, it's not allowed. Okay, ma'am. Now, associate company. What is associate company? See, this company does not have more than 50% shares of this company. So it doesn't become its subsidiary. But it has got 30% shares of this company. So it has good, significant influence. Significant influence is when you have more than 20% voting power. So it has significant influence, although it doesn't become a subsidiary, but has significant influence. So we cannot call this as subsidiary and we cannot call this as holding. In that situation, we call this as associate and we call this as investing company. Okay. Next, on the basis of capital and listing. On the basis of share capital, we have companies with share capital and without share capital. Now, on the basis of listing, we have listed company and we have unlisted company. What is listed and unlisted company? See, if I want to sell my product on Flipkart, how can I do that? Ma'am, you have to list yourself as a seller. You have to get your product listed on the portal, listed on the website, and then you can sell it. Likewise, we have companies. Companies who want their securities, that is their shares, their debentures, to be sold in a marketplace which is stock exchange. They can get their shares listed on that stock exchange. So such companies are called as listed companies, and those companies who do not do this process, they are called as unlisted companies. Fine. So section 2 clause 52 has given us the definition of listed company. Now there was a rule 2A, which came as an amendment rule, and it brought about certain types of companies which will not be treated as listed companies for the purpose of Companies Act 2030. Fine. That means, example, the public companies who have not listed their equity but have listed their debentures, right? So some companies will not be treated as listed companies. So we have that part. Now, moving on to our next company, holding, subsidiary, associate, and then we have small company, right? Section 2, clause 85. Section 2, clause 85, small companies. Okay, what is small company? See, if we have a lot of market players, a lot of anyone, a lot of people, or maybe say we go to a park and there are thousands of people around. I want to protect these people. I know that someone who is of the age of 30-35 can protect himself, right? But someone who is of 3 years or 5 years may not be able to protect himself, right? So I have to protect the children. So maybe I can give them some extra benefits, extra advantages. The children can form another line, they can come to a special area, or whatever like things, right? But if I know that with these children there is some elderly person, I know they will take care of the children, so I don't need to involve myself. Do you get my point? The whole intention is here also. We have some companies who are operating on a very small scale or a very small level. Government wants to encourage them, wants to protect them. So they are being conferred the status of small company and they are given some extra benefits and exemptions and privileges, right? But if you call yourself to be a public company, that means you're not a small company. If you call yourself to be a Section 8 company, we don't see charity being done by someone who has very little. Maybe they can still go out and help others, that's not the point what I'm telling you, but they cannot anyway open a charitable company, right? They cannot do that. So small company will not be a public company, it cannot be a Section 8 company. If it is a holding company, that means you are big enough to hold another company. You're not a small company. If you are being held by some other company, that means you are under protective hands. You cannot be a small company. So if you're not any of these and you're a private company, then if you are within this threshold, then you will be called as a small company. What is the threshold that has been given, ma'am? The paid up capital has to be less than or equal to 50 lakhs or such higher sum as may be prescribed by government. And not just this, two conditions have to be fulfilled. The turnover of that company should be less than or equal to 2 crores or such higher sum as may be prescribed. What is the highest sum which is prescribed by the government? It's 2 crores for paid up capital and it's 20 crores for turnover. Okay, it's 2 crores for paid up capital and it's 20 crores for turnover. That's clear. I hope that's clear. Government has the power to prescribe up to 10 crores and here up to 100 crores. But that does not mean we have to check these limits. What limit we have to check is 2 crores and 20 crores. That means supposedly I am a private company and my paid up capital is 1.5 crores and my turnover is 10 crores. Can I be a small company? Yes. Because this is something which we will check currently. Fine. Okay, moving further. Section 8 company we are going to do a little later. Nidhi companies we will do later. Public financial institutions, LIC, IDFCI, then UTI and the institutions which are notified by the government in consultation with RBI. They are all called as PFIs. Then we come to government company. Like ONGC. It's a government company. Now, government company means the shareholders are government. Ma'am, there can't be any other shareholder. There can be, but at least 51% of the share capital should be held by government. Which government, ma'am? It can be central government, it can be state government, or it can be combination of both. Right? So that will be called as a government company. And supposedly if ONGC acquires 60% shares of some other company, this other company will also be treated as government company. Why? Because a subsidiary of a government company is also a government company. Okay, subsidiary of a government company is also a government company. Okay, ma'am. Then we come to dormant company. What is dormant company? You have heard about dormant bank account, right? What is dormant bank account? When there is no operation, no activity in that bank account, that is known as dormant. Likewise, we have formed a company but there is no activity going on in the company. Nothing raw material purchasing, nothing sale happening, nothing happening. You're just sitting idly. Then why are you wasting time of being a company? Apply to the ROC and get the status of being a dormant company. So now everyone knows that you're a dormant company and you're doing nothing. Fine. So if I have formed a company for some future transaction, I incorporated a company but I have the intention to start the business after 3 years. Or if I am an inactive company, when will I be considered as inactive? If in the last 2 financial years there was no business, or no significant accounting transaction in the last 2 financial years, or I have not filed financial statements or annual return for last 2 financial years. So I am an inactive company. If I am an inactive company or I am a company which is formed for future purpose, I can apply to ROC and obtain the status of dormant company. The question here is that what do we mean by significant accounting transaction? See, if I have taken a building, of course, I will pay building rent. That is not a significant accounting transaction. That is an accounting transaction which has to be done. If I am filing some form with ROC, I have to pay ROC fees. Undoubtedly, I have to do that, right? So again, that is something which is not a significant accounting transaction that has to be done. But yes, if I buy raw material, that is a significant accounting transaction. Why? Because it signifies that there is some business going on. Okay. Now, that is a dormant company. Okay, ma'am. Joint venture, it's a normal joint arrangement. Next, we have illegal association. What is illegal association? See, according to Companies Act 2013, section number 464, if there are 10 people working together, be it partnership or any other form of business organization, you're working together, fine, you can do that. 20 people, again you can do that. 30, 40, you can do that. But, if it's more than 100, you cannot do that. In fact, the current limit prescribed is 50. So for us, 50 is the limit which we have to keep in mind. So if there are more than 50 people doing business as a partnership or anything else, it's illegal. They have to incorporate into a company. Ma'am, supposedly we are 60 chartered accountants, or we are 60 CMA professionals, or we are 60 company secretaries. We have incorporated our partnership firm. Is it illegal? And if we form a company, we cannot become the auditor of anyone, because a body corporate cannot be the auditor and all that like things that we already know. So what are you trying to tell us? See, for professionals who are governed by special acts, it is allowed. It is allowed. Otherwise, any association shall not be formed for carrying out any business unless it is registered as a company. Plus, one exception is also there, which is HF. If a family has 60 people, husband, wife, and maybe, I don't know how many children, they can continue. They will not be treated as illegal association. They are legal only. Fine. So apart from that, other than that, it's going to be illegal association. Clear? Fine, ma'am. Now, we come to an altogether different part, which is about forming a company. So we have read about what do we mean by company, what is the concept of corporate wheel, what are the features of the company, what are the different types of companies, and when registration is mandatory. So if I voluntarily choose to form a company, or I am forced to convert my business into a company, whatever the choice be, I have to now form a company. And how do I form a company? That is what we are going to read and revise now. Section 3 tells us, Section 3 of Companies Act 2013 tells us that a company may be formed as a private company, as a public company, or as a one-person company. Who forms the company? Supposedly, I have this idea, okay, I want to do business and I want to form a company for this. So, I am a promoter. I am a promoter. I will decide the name of the company. I will decide what work company is going to do. I will hire people. I'll prepare documents. I'll do all that part. I am a promoter. Right, later on you can identify me. My name may be found in prospectus or in annual return, or board may be working according to me. Right, so that is what the definition of promoter covers, not an important one. So a person gets an idea, decides to form a business organization. If he decides company, then he has to do that preliminary steps, that is gather people. For one-person company, I am sufficient. For private, I need someone else also. And for a public company, I need at least 7 people to form a company. I also have to prepare documents. See, documents are a must. If I have to apply for PAN card, Aadhaar card, or passport, anything, I need ample of documents here. So here I am forming a one-person company. Of course, I need a lot of documents. Not a one-person company, but a company. So of course, I need a lot of documents. Now, say Mr. Ambani ji, he decides to form another company. So he gets this idea, he gathers people also, but now he doesn't know how to incorporate a company. If I take my example, I have incorporated a lot of companies, right? So I know where to fill the form, how to fill the form, how much fees to pay, everything. I know the whole incorporation procedure, so I can do it. But maybe he'll not be able to do it. So he goes to seek some professional help. And that person assists him in doing the necessary filing and helping him prepare the documents and all that. So is he the promoter? He is the professional who is rendering professional services. Promoter is Mr. Ambani only. Fine. Okay. So he decides the name of the company, does the filing, etc., etc. Okay. This section we'll do a little later. Now, So this is the formation of company overview. Promoter decides what type of company to form, obtain DIN and digital signature. DIN is director's identification number and digital sign. See, the whole process of company incorporation is now online. Nothing is offline. So offline signatures also don't work anymore. We have digital signature certificates. I'm sure you all know about it, right? So that is how you affix signature on the online documents, right? On the documents which are in your system, right? So that is how you affix signature on them. After that, you apply for name. See, name is the most crucial part in a company. Nowadays, if I want to get a Gmail ID, it's difficult because all the usernames have been blocked, and so are the names of the companies. You don't find the name of the company available, or even if you find it available, it may be close to some other company, etc., etc., and you have some name rules. So complying with all those rules, it's difficult to find a name which suits your company and everyone around, right? So you have to apply for a name, and the form that we use for company incorporation is Spice Plus, right, which is divided into two parts, part A and part B. Part A is for name and part B is for other part of incorporation. Both the parts can be filled together also, and they can be filled one by one also. Preference is that you reserve your name and then you fill the other part of incorporation. Fine. After that, you have to prepare documents, and then you file the form and you're being allotted certificate of incorporation. Fine. When we read about documents, we have these two special documents, MOA and AOA. Let's read about them and understand what do we mean by Memorandum of Association and Articles of Association. Fine, ma'am. Memorandum of Association, section number 4. See, association. Memorandum, which is for memory purposes. So we have to record about this association. This is the most fundamental and basic and charter document of a company, which is all about the constitution of the company. What is the name of the company? That is the name clause. Where is the company registered? Not the full address of the company, but where? State of Uttar Pradesh, state of Karnataka, state of Rajasthan, where? Situation clause, that's it. Object clause. What is the purpose? Why the company is formed? The company is formed for construction of bridges. So construction is the purpose, right? The company is formed for providing fashion designing services. So fashion designing is the purpose. So whatever is the object, whatever you write in the object clause, you can do only that part. You cannot do beyond anything, right? Liability clause. The liability of the members is going to be limited to the amount of shares which is unpaid by them, right? Or whatever the case is. Capital clause. With how much capital your company is going to be registered. There is no minimum paid up capital requirement, right? These are the 5 clauses in Memorandum of Association of all types of companies. But in one-person company, we have an additional clause. Why? Because in one-person company, we also have to mention about the nominee. So in case of OPC, you have to name a nominee, which is there in succession clause. Fine? Okay. Now, as I told you, Companies Act has 7 schedules. In schedule number 1, you have this Memorandum of Association and Articles of Association, different formats. If a company is limited by shares, then you can pick the memorandum, you can pick Articles of Association, make necessary changes, and it becomes your memorandum in your articles, right? So forms have been specified there. Your memorandum is going to be signed, divided into paragraphs and all that. It is prepared by every company at the time of registration. And one important point to be noted. If I don't like my name, can I change my name? Yes, ma'am, not advisable because people know you by that name, but you can change your name. If I don't like the name of the company, can I change the name of the company? Yes, ma'am, you can. That means in memorandum name clause, I wrote something. Can I change it? Yes, ma'am, you can. Can I change the city of my company? Yes, ma'am, you can. State of my company? Yes, ma'am, you can. So that means your memorandum of association can be altered later according to section number 13, that is 13. Clear? Fine. Now, articles of association. What are articles of association? They are basically the internal rules how a company is going to be governed, how the company is going to run, right? So section number 5, it is exactly the same thing. They are also specified in tables of schedule 1, and they are also divided into paragraph. They are also numbered, prepared by every company at the time of registration, and can also be altered later on. That means there are a lot of conditions, a lot of clauses which are there in the articles of association. You can change any clause later on by altering it according to section number 14. Fine? Okay, ma'am. Now we come back to the process of incorporation with a little in depth. So this is our steps of incorporation. We'll read it from the charts. We will revise it from the charts itself. That's going to be more helpful. As I told you, it's advisable that first you reserve the name and then go for the process of incorporation. However, you can do both of the things together as well. So you fill Spice Plus Part A. Whatever name you are going to choose, you have to be careful because section 4 specifies certain restrictions to the name you can choose. It should not be identical to any existing company. See, if I also choose a name as Reliance Computers or Reliance, it might give an impression that it belongs to that Reliance group. So I cannot choose a name like that. I cannot choose a name which constitutes an offense. The name itself is an offense, right? And I cannot choose a name which is undesirable according to central government. You may ask me, Ma'am, what is undesirable? Rule 8A has been prescribed for the same, and we don't have to read them. So you just have to keep this in mind, right? Moreover, there are certain words. If we use those words, it gives an impression that this entity, this company belongs to the government. Like if I use Educational Board Sensation Limited. Don't you think using the word board gives an impression that it belongs to the government? So I cannot use some words which are clearly given in Rule 8B. If I want to use these words, I have to get the approval of central government. Right? I have to get the approval of central government for the same. Fine? So keeping all these points in my mind and subject to the availability of the name, I decide one particular name, and if it's available, I file the same with ROC. If there is no defect in my form, ROC will approve it, and if there is any defect in my form, ROC will give me chance to rectify the defect, and within 15 days I can again do it and my name will be approved. If my name is approved, it is reserved for 20 days. So I get a time period of 20 days to fill Part B of Spice Plus and get my name, get my company incorporated. Supposedly, I filled Part A giving some wrong information, and the authorities found it out. They found out that I have reserved this name giving some wrong information. There can be two situations. I have not yet filled Part B, so the company is not yet formed. They will cancel the name that they have reserved and they will put a penalty of 1 lakh on me. And what if the company is also formed? Now the ROC can direct me that change your name within 3 months, or you shut down your company, or I'll remove your name. So these type of orders may also be passed. One more thing, if I am an existing company, that means I have already formed the company. Now I want to change my name. I can again do that, keeping the name restrictions in my mind, and my name can also be reserved for 60 days here. Okay, and I can change the name accordingly. Now, if I have reserved my name, or maybe I have not reserved the name and I'm preparing both the parts of Spice Plus together, both can be the situation. I have to prepare the documents, MOA, AOA, which we have already discussed, declaration of compliance by CA and director, that yes, the person has complied with all the formalities which are necessary, declaration of no offense, that we are not involved, we have not ever been found guilty of fraud information of a company. So we have conditions of offense. We have to give a declaration that no, I was not involved in any of the offense. Particulars of your registered office. If you don't have a registered office ready with you, any correspondence address you can give right now. The subscriber details, directors details, and their consent that yes, they are ready to act as the directors. All these documents are being prepared and the form is being filed with ROC. ROC gives us a certificate of incorporation that yes, your company is now incorporated. It also gives us a corporate identity number, which is unique in all respects. SIN, corporate identity number. Now, just like we read about incorrect details in reserving a name, here also we might have given incorrect details for company's formation, not just for reservation of name but for company's formation. Again, there can be two situations. Company is not yet formed. The person responsible, they're attracted to section number 447, which is punishment for fraud. Since they have fraudulently given wrong information, they are given punishment for fraud, which is there specified in section 447. If the company is formed, they will be liable for fraud, plus moreover tribunal can pass these orders. It may say that we will regulate the management. Your directors are not competent enough to run a company because before formation they are involved in such huge fraud. What will they do after formation of the company, right? It may direct that the members' liability, earlier it was limited but now it will be considered as unlimited. It may direct that no, your name should be removed. It may direct that close down your company or any other order. So such orders can be passed if you give incorrect information and your company is formed on the basis of that incorrect information only. Clear? Fine, ma'am. So this was about incorporation of company. Okay. Now we have effect of registration, section number 9. See, according to section 9, a very small section, this section actually doesn't tell us anything very important. When you form a company, before a company is formed, you have subscribers. You don't have members, because members of something which is not in existence, it doesn't make sense. So you have subscribers who sign the memorandum, and as soon as your company is incorporated, these subscribers become members. Company gets the status of being a company, so now it can hold property in its own name, it can sue, it can be sued and all that part. So that is what is written in section number 9. We have another section, section 3A. See, one thing that we have established so far is that for a private company you need at least 2 members, for public company you need at least 7 members, and for one person company you need at least 1 member, but for that we have a backup called as nominee, so forget that. For private and public company we need at least 2 and 7 members respectively. Now, it may so happen that one member of a private company died. Ram and Shyam, they were doing business together and Mr. Shyam died. So now what is going to happen? Ram is continuing the business of a private company, but in a private company you must have at least 2 members. So should the company shut down, close, what should happen? Ram is given a time of 6 months. Go find another Shyam and then continue the company. Even after 6 months, if he continues the company with just him alone and no other member, what will happen is that whatever contract he enters into, he is going to be personally liable. Fine. So that is the case which is written in section number 3A. Then we have section number 10A, which is about commencement of business. What is this, ma'am, now? See, if you are a company incorporated before the 2nd November 2018, you receive certificate of incorporation, you start your business, nothing to worry. But if now you are incorporated, if you are a new company which is incorporated after this date and you are a company with share capital, then you need to do certain more things. You are a company with share capital. Have you received your share capital? The subscribers who said that I am going to buy 10 shares, I am going to buy 50 shares, have they actually paid money to the company? If yes, that is the declaration which your directors will file with ROC, that yes, subscribers have paid money. So that is the declaration INC 20A which has to be filed with ROC. Moreover, every company, according to section number 12 of Companies Act 2013, must have a registered office from 30th day of its incorporation. When I am forming the company, when I am incorporating the company, I may not have a registered office right now. So I just gave a correspondence address. But after I've incorporated a company, I must have an office to run the company. If I don't have the office, I cannot run the company. So I have to give this office address also within 30 days. So if I do both these things, then I can start my business. Otherwise, I cannot start my business and I have penalty for the same. Section number 12. Section number 12 is simple. Every company must have an office, and outside every office you must affix a board which is going to contain the name of the company, which is going to contain the address of the company, right? And that has to be proper in some characters which you can read, fine, which you can read. That's it. I think that's sufficient for you. Now, Memorandum of Association. Memorandum of Association, section 2, clause 56 gives us the definition. The definition is not at all important, so I'm not dealing with it. And the rest of the part we have already discussed. We have discussed about the clauses of memorandum also. What we have not discussed is the alteration of memorandum. Okay, before we switch on to alteration of memorandum, amongst the chart I also have the one-person company process of incorporation, which is exactly similar to any company's process of incorporation. The difference is that these people can form one-person company. They have to find nominee, they have to obtain the consent of nominee, and they can change the nominee's name later on also by filing INC 4. If one-person company wants to convert itself into private or public, they can do by filing an application with ROC. Okay, now, section number 13 Alteration of memorandum. Alteration of memorandum. See, there are 5 clauses to memorandum, and the first clause is the name clause. So if a company is formed and after that company wants to change its name, can it do so? Well, yes. You have to ask your members. How do you ask your members? You have to call your members. To call your members, you have to hold board meeting. That means all the directors will come together to decide when to call our members, to decide about the general meeting. General meeting is the meeting of shareholders, meeting of the members, right? So when to call the meeting? You call the meeting, in that you seek permission of your members. Not simple majority but special majority, that is 3/4 majority. Special resolution is needed. Fine. After you after you obtain approval from your members, you have to get approval from central government also. Okay, so you apply to central government. After you get both these approval, you give this intimation to ROC, and ROC gives you a new certificate of incorporation. But if you are a defaulter company, that means you have not filed your annual returns, or you have not repaid your deposits or debentures in time, then you are not eligible to change your name. Fine. So if there is no default, then you can change your name. And if you want to change your name, this is the procedure that you follow to change your name according to section number 13. Is that clear? Fine, ma'am. Now, this was when we wanted to change the name. At times, we don't want to change the name, but the government wants us to change the name. Now, this can also happen. Yes, this can also happen. Like ma'am, if I want to change my name willingly, I can change my name, but how can someone else force me to change my name? Central government is like your in-laws place. Your in-laws can force you to change your name, right? Anyways, why are we forced? Because we have not complied with the provisions. So maybe if we have complied with the provisions, when we may not be aware of the prospective companies or same brand name which may be available in the market. So we have taken their name, we have to change our name. If I fill the form part A of Spice Plus and I got the name available, so my company was incorporated. Later on, it was discovered that yes, there is a company which is exactly with a similar name, and it could not be identified at that particular point of time. So government will direct me to change your name. We are giving you a time limit of 3 months. Fine. One more situation. I work under the brand name of Book My Video. It's not a company. Supposedly, you decide to form a company, Book My Video Private Limited. Now, I have a registered trademark in the name of Book My Video. So, although I am not an existing company whose name you have taken to be identical with, but I am a registered trademark and your name is identical with my name. So, if I make an application and oppose this, you will be directed to change the name within 3 months. Fine. Okay, so once you change your name, you have to intimate ROC within 15 days that yes, your new name is this. Okay, ma'am. So alteration to name clause, we have to rectify our name if central government tells us to, and we can voluntarily also change our name by following the provisions. Next is situation clause. Situation clause means what? Situation clause means shifting your situation, physical situation of a company. See, it may so happen that I want to shift from Karol Bagh to Patel Nagar. That means within the city, within the same ROC. Second situation, I might want to change from one city to another, but my ROC remains the same. from some part of Pune to some neighboring city of Pune, ROC remains the same. Then maybe I want to shift from Pune to Mumbai. ROC is changing, but I'm in the state of Maharashtra only. But there might be another situation where I want to shift my office from Maharashtra to Uttar Pradesh. So my state is also changing. So there can be 4 different situations. 4 different situations. What you need to remember? For the first situation, within the same city, pass board resolution, inform ROC about new address. Second, pass special resolution. You need to seek permission from members for changing your city. You are still in the same ROC. You are governed, you are under ROC, that ROC only. But you need to obtain SR and then inform ROC. Next, your ROC is changing. Your state is still the same. When ROC changes, you have to seek permission from regional director. So apart from seeking permission from your members, you also have to seek permission from regional director. And when your state changes, you seek permission from from your members, plus you seek permission from central government, because now you are changing the state. Both the states are under central government. It's not within the powers of regional director to do so, right? So now you have to go to central government, and central government ensures that the interest of creditors, the interest of debenture holders, that does not suffer. For that, you are being asked that you give notices to these people, you receive their objections, and government is going to consider their objection. After considering their objection, then they will grant you approval that you can change your office from one state to another. Okay, so that is how it happens. Fine, ma'am. Next is object clause. It's simple. If I want to do another business, I can. If I don't want to do my existing business, I can change it. Only thing is, SR is needed. Simple. Clear. But there is one special point in change of object clause. What is that special point, ma'am? See, if you have raised money, if you have shown an offer document to public, prospectus to public you have shown, and you have said to people that you give me money, I will invest money in this real estate, do this and that. You've collected money, and now you're changing the object of the company and saying, now I'm going to do this. People might get angry. And don't you think you need their permission to do so? That is the simple case. If the company has unutilized money which you have raised from prospectus, then you have to publish the same in newspaper also. And the shareholders who do not agree, you will give them an exit option, a dissenting option, an exit option, that fine, if you are not in, we return your money, fine. So that is how you can change your objects. Liabilities are ideally not changed, but there are special circumstances of liability and capital alteration that we read in the chapter of capital. Here you don't have to actually read it. Now we come to articles of association. Articles of association. We have read about articles also, right? We know the meaning, we know the form. Section number 14. Alteration of articles of association. How do we change any clause that we want to? Simple thing. SR. Pass special resolution. To pass special resolution in general meeting, you need to call your members. To call your members, you need to hold a board meeting to decide how and when to call your members, right? So that is what happens. Simple. Simple. Now, one more thing, that if you want to convert private company to public company, private to public, that means you need to remove those restrictions from articles, right? You take permission from your members and you submit it to ROC. If you want to convert public company to private company, you also need to obtain approval from central government, right? That is the additional thing. Now, once your company is incorporated, that means the documents that you have prepared, memorandum and articles, they have been registered with ROC. They are registered with the authority. Section 10 tells us what is its effect. Members are bound to the company. If in the Articles of Association it is written that if a member does not pay call on money on 2 notice reminders, their shares will be forfeited. Members have to be bound by this particular clause. If it's written that the company will pay interest at the rate of 6% to the members, they have to pay it. So company is also bound to the members. Members are not bound inter se, and company is not bound to outsiders. What does it mean? If in the Articles of Association it is written that Mr. X will be managing director till the life of the company, and company changes this particular clause, Mr. X cannot sue the company. The articles don't bind the company to the outsiders, they are for the internal rules only, right? So that is what is the effect given in section number 10. Okay. Now we have, my dear, some doctrines. This is section number 17. Simply tells us that we have to give these documents to our member if they request. Simple. So our members will have easy access to memorandum and articles and all the filed resolutions. So if they want a copy of that, the company has to give it. Now we come to doctrine of ultra vires. What is it? First of all, what is doctrine? Doctrines are basically principles, some rules which are formed. These are all formed because of the case laws. See, we have been given the object clause of Memorandum of Association. We have been told that this is what a company is permitted to do. Now what if company does anything which is not given in the object clause of memorandum? The company does it. Has the company done correct? No, the company is incorrect in doing so. So what should be the contract? Is it going to be valid? Is it going to be not valid? And what if all the shareholders are okay to it? They all accept it, that whatever director has done, it's all correct. That is the question which comes to our mind, but this is the question which does not have any answer in Companies Act 2013. So for that we have some doctrines, my dear. These are the principles which have been established to read company law, how we read it, because of the case laws, right? So we have different doctrines, and 3 doctrines that we have to read, of course. Doctrine of ultra vires, doctrine of constructive notice, and doctrine of indoor management. Fine, so let's read them one by one. The meaning of the term ultra vires is beyond the powers of. Beyond the powers of. Beyond the powers of what? See, object clause tells us something. Companies Act tells us something. We cannot do anything which is beyond this, which is not written in this, right? If we do that, it is going to be void. Void means something which is not valid. And even if you want that, okay, I am going to change this object clause later on and I am going to amend this and everyone should agree and we are going to make this act a valid one, you cannot do that. You cannot do that. That means if something is beyond your power, you cannot later on go on to justify it that all my shareholders agree, they have ratified the same, they have accepted the same. No ratification is possible. If you're doing any such thing, stay order can be obtained against you, right? So we have a case law, Ashbury Railway Carriage versus Iron Company Limited and Iron Company Limited versus Ritchie. Now, the company's object was to make, sell or lend or hire railway carriage and wagons which carries it. To carry on the business of mechanical engineer and general contractors. Fine. To purchase, lease, work and sell mine, mineral, land and buildings. Now this is the work which they have been permitted to do. But instead of doing this, the company entered into a contract to finance the railway line. Now you only think that, does this object clause permit the company to finance? They're not permitted to carry out financing activities, right? The contention of the company was that all the shareholders have accepted it. They agree that we can finance. Your shareholders, even if they agree, doesn't make your act a valid one. So you cannot make an ultra vires act to be valid even if your shareholder, even if every shareholder of the company assents to it, right? So doctrine of ultra vires, if you do anything which is not within your powers are defined by your object clause and memorandum of association. So if it's not within your powers, you cannot do it, and if you do it, that is going to be treated as void. It will not be a valid act, right? Okay. Next is doctrine of constructive notice. Okay. What is doctrine of constructive notice? This actually works in the favor of company. See, when I am filing the document, the company is incorporated and the memorandum of association and the articles of association, they are with ROC and they are available as public documents. That means anyone can go to ROC and obtain these documents. They are available to general public. So you must read these documents before contracting with the company. If you are a third party, you must have knowledge of these documents. You are presumed to have notice of these. Whatever is written in this, you're presumed to have notice of this. You're presumed to have notice of this. So whenever you're dealing with the company, you're advised to have knowledge of this. Why? See, let's first read the case law. Kotla Venkateswamy. Articles required that deeds should be signed. If there is any deed, it should be signed by managing director and working director and the secretary. So if I am a third person and I'm dealing with the company and the company is giving me this deed, I must know that a valid deed according to this company will be the one which is signed by these three people. I must know this. Supposedly the company has given me this deed which is signed by working director. Okay, which is signed by working director and which is signed by secretary, but it is not signed by managing director, and I accepted that deed. Why did I accept this deed? It is my mistake or company's mistake? It is my mistake also. Yes, company will get the benefit of it because I have also incurred a mistake. What mistake have I incurred? I must have this knowledge of articles of association, because in this articles of association it was written that this sign should also be there, and if I had this knowledge I would have asked the company to get this signed also, right? So that is going to be my mistake. Now exactly opposite is the doctrine of indoor management, which works in the favor of third party and against the company. How? Royal British Bank versus Turquoise. See, as per the articles of Royal British Bank, the board of directors of the bank were authorized by the articles to borrow funds on bonds, provided the board of directors were authorized by the shareholders in the general meeting. See, what is it? In the articles In the Articles of Association, it was written that board of directors can be authorized by a resolution to borrow. I read this Articles of Association. Fine. According to Doctrine of Constructive Notice, I read about this Articles of Association and know that board of directors can get this power to borrow if they are authorized by resolution. So when board of directors came to me to borrow, I gave them money. But later on, I came to know that, oh my God, these board of directors were not authorized by this resolution. Now you tell me, am I supposed to inquire internally that whether this resolution was passed or not? No. This doctrine says no. This doctrine says no. If any person deals with the company, they're satisfied that whatever transactions they're doing, they're in accordance with memorandum and articles, they're not bound to inquire into any regularity of internal proceedings. Simple. Okay. But imagine, I knew about this. I knew that they have not been authorized by resolution. If you knew this, then you should not have given money to them, na? Right? You should not have given money to them. So if you knew about the irregularity, then you are not going to get this benefit of doctrine of indoor management. Likewise, if you did not know about memorandum and articles, then you should have definitely inquired. Supposedly you do not know that board of directors can be given the powers. Of course, the board of directors don't have the powers, so you must have inquired. If it is a case of forgery, forgery is complete nullity. If it is forgery, no matter who is suffering and who is not suffering, the case cannot be made a valid one. And negligence. If I had a doubt that yes, I had a suspicion, then I must have went deep into the inquiry and tried to find out what is the real situation. So if these things are involved, then I will not get this benefit of doctrine of indoor management. Otherwise, I get this benefit. Okay. Now, moving on to our next segment. In incorporation only, we have Section 8 company. What is Section 8 company basically? What is Section 8 company? See, company which is formed for charitable purpose, that is for promotion of sports, promotion of education, promotion of culture, right? So this is a company that you have formed and your intention is not to make profit out of this company. So whatever surplus is being generated, how surplus will be generated? Maybe you get donation of 1 lakh and you have spent only 10,000 in a financial year. So you generate a surplus of 90,000. That will not be used to fill your own pockets, because you have formed a company for promoting charitable objects. So you are not permitted to take dividend from such type of company. Fine. How do you form this company? This company formation process is again same. The special part is that you need to obtain license from government. Why? Because government gives you a lot of exemptions. When government is giving you benefit for something, it will also ensure that you are the right person to form this company. So it gives you license. So you have to apply for license for running a Section 8 company, for incorporating rather a Section 8 company. Okay, so first thing is that you apply for name, and there is one single application. Earlier you had another application for obtaining license, but now you have one single application for obtaining license also, and for incorporation of that particular company also. Fine. So you make one single application, you have all the same attachments. The extra thing is this: you have to give your estimated annual income and expenditure for the next 3 years which is helpful in obtaining the license, which is needed for getting the license, right? You get the license, your company is incorporated. Now, when you get license to do something, the same license can be revoked also. It can be taken back also. Why, ma'am? And how? See, if you have been given license, you must comply with the conditions on which you have given license, You must comply with Section 8 requirements, right? If you don't comply with it, your license can be taken back by government. If you do fraud or you are violating your objects, you said that I'm going to promote sports, but you're promoting something else, or your affairs are not in the best interest of public, in such situation government can take back your license, and when government takes back your license, you are no more a Section 8 company. Section 8 company may be a private company, may be a public company, right? And once your license is revoked, again you restore the status to a private or a public company, and then you continue to operate. Okay, there are more minute details about that. How do you convert a Section 8 company? Can you convert it? Yes, ma'am, why not? If any other company wants to become Section 8 company, you need license. And if you want to become a normal company, take permission from your members and apply to regional director for approval. So you get these two approvals, you can convert your status. Okay, so other types of conversion I have already told you. We also have Section 18, which clearly tells us that alter your memorandum, alter your articles and file the necessary form with ROC, and you can convert your company. Apart from this, we also have a conversion of LLPs. What is LLP? What is LLP? Limited liability partnership. It is basically between company and partnership. So there is something in between company and partnership. That is what LLP is. And LLPs can be converted into company, although you will not find any such provision in LLP Act. If you come to Companies Act, we have section number 366, which tells us that whether it's a company, whether it's LLP, whether it's partnership, whether it's cooperative society, they all can be converted into a company by following these rules. You don't have to read the rules, but you have to just remember the rule name. Okay, so you can convert yourself into a private company or a public company accordingly. Fine. Now, another topic for revision. Nidhis. What do we mean by nidhis? Nidhis are, what do you mean by nidhi? Nidhi means money, treasure, right? What are nidhi companies? Just like we have Section 8 companies which are formed for charitable objects, we have nidhi companies which are formed for financing, for savings. So their objective, their purpose is slightly different. If I want to form a bank, if I want to incorporate a bank, I can start the business of financing, but that is something which is very difficult given the license that I need to obtain, plus I will be under the regulation of RBI. So the easy thing is form a nidhi company, but here financing activities are restricted to the members only. Non-members do not form part of any give and take. So what nidhi companies do, they take money in the form of deposit from their own members, and they also give loan to their members, right? They are formed with the intention to promote savings amongst their members. Fine, ma'am. We have chapter number 21A, which covers nidhis, and we have just one section, one beautiful and small section, section number 406. However, we have a lot of rules under for nidhis, right? So we have to read about rules. We don't have to basically read a lot in the section. Okay. So, nidhis are also known as mutual benefit societies. They are formed as a public company. So what happens is, you form a public company, the process of incorporation is same just as of a public company. After you form your company, you have a time period of 60 days. Within that 60 days, you have to make an application to central government NDH4 and you have to get yourself declared as a nidhi company. Okay. That means it's not going to so happen that my object clause has this particular object, so I am a nidhi company. No, this is not going to happen. You have to get yourself declared as a nidhi company. So central government will, in the official notification, they will declare you to be a nidhi company. So now your name will be in that list of nidhi companies. That is what is needed now. Okay. Central government has the power that through notification, they don't need to amend some act or they don't need to bring in some rules. Through notification only, they can say that this particular section is not going to apply to nidhi companies, or this particular part of section is not going to apply, or this section is going to apply but with certain modification. So they have this power, and through the notification, central government has actually exempted a lot of provisions on nidhi companies. So a lot of provisions don't apply to nidhi companies. They have their own flexible freedom. Now, this notification has to be approved by Parliament, of course. When we come on to the rules part, Rule 1, you don't have anything. Rule 2. Rule 2 tells us the applicability, that nidhi rules are going to be applied on the nidhi companies which have been declared under the previous act, which have not applied for declaration yet under the previous act, which have been incorporated under the new act, and which have been declared as nidhis under the new act, right? So all these type of nidhi companies, they are going to be under the purview of these nidhi rules. We have certain definitions which we must know for understanding nidhi rules. See, nidhis, what are assets for them? The loans that they give to their members. So they are assets. Now, if I am a member of nidhi company and nidhi company has given me a certain loan, I may not pay it. I may not repay it. That means this is an asset to a nidhi company. This asset may be a standard one. That means constantly they are getting all installments being paid, or it may be substandard. Substandard, that means it is non-performing. Non-performing means for 12 months continuously, no repayment has come. If it extends for 2 years to 3 years, it becomes doubtful, and if it's more than 3 years, it becomes a loss asset. Right, so that is a classification of NPA, which you also know in the banking sector it happens. And nidhis are like banks only, with limited functions and limited scope, right? So that's how they operate. Now, how a nidhi company is incorporated, it is going to be a public company. There is a minimum paid up capital requirement. Unlike a public company, in normal public companies, you don't have any minimum paid up capital requirement, but here you have a paid up capital requirement of 5 lakhs, right? There is a restriction that nidhi companies cannot issue preference shares. It can only have equity shares. That means because nidhi companies are formed for the benefit of the members, so you cannot give an edge over the members to any other holders, right? So no preference, no debt, nothing allowed for nidhi companies. Just like private companies have private limited at the end of their name, public companies have limited at the end of their name, nidhi companies have nidhi limited as a suffix. It may also include mutual benefit in their name, right? Declaration of nidhi, as I told you, the companies which are now incorporated, they have a time period of within 60 days from the incorporation, they have to get themselves declared as a nidhi company. This time period may be extended by regional director. So within that extended time period. Other types of companies, that means which are already existing ones, they have to apply to central government, and central government will notify them as a Nidhi company. When? What is the time limit? Time limit we read in the rules 23A and B, right? So we read it later. If you don't do it, you cannot file these forms. Next is now, although Nidhi companies are formed as a public company with just 7 members, fine ma'am, do you think with 7 members, because they are a public company, they can be formed with just 7 members. With 7 members, you can do a banking business kind of thing. You can do a financing business. No, you need more people. So within 1 year, there are certain requirements which must be accomplished. There should be at least 200 members. The net owned funds of the company should be at least 10 lakhs. What are net owned funds? Paid up capital plus free reserves minus accumulated losses and minus intangible assets. So that is net owned funds. That should reach at least 10 lakhs. Okay. Unencumbered deposits, that means deposits which are definitely not, does not have a charge on it. They should be at least 10% of the total deposits of company plus. The ratio of net owned funds to deposits should not be more than 1:20. What does it mean? Net owned funds, you know. And deposits? What are deposits? See, a member of a Nidhi company may give money to Nidhi company in the form of shares. That is a part of net owned funds. It may also give money in the form of savings account, fixed deposit, RD, right? So these are what? These are called as deposits. Fine. So these deposits should not be more than 20 times of what is net owned funds. Why? Because these deposits may be withdrawn by the members, and if they are withdrawn by the members, the Nidhi company will run into crisis. Okay. Now, this is the requirement that you have to complete within 1 year. So once you complete this requirement, you have to file a form of statutory compliance in form NDH1. It may so happen that within 1 year, you are unable to achieve these requirements. So such time period can be extended by regional director if you make an application. And obviously you will not even be in a position to file this return of statutory compliances if you have not complied with the same. So in that case, you file the statutory compliance return in the next year. Okay, ma'am. Rule number 6. Rule number 6, we have general prohibition. Nidhi companies cannot enter into chit fund, hire purchase, leasing finance, insurance. Why? I have told you in the main class, right? It cannot open current account with its members. Why? Because the reason is to promote savings, right? And current account has nothing to do with savings. Now, it cannot acquire securities of other body corporate. In fact, it cannot acquire that controlling interest. If it wants to make some other company or control its board composition, it has to seek permission from regional director. Otherwise, it cannot do that, right? It can deal only with its members, none other than its members. If the members have taken loan from the company and the members have given gold, maybe against the loan as a security, this gold cannot be pledged somewhere else. Okay, it cannot take deposits or lend money to any body corporate. It cannot issue advertisements for accepting deposits or pay any brokerage on the same, right? So that is something, these are the parts, something which are not allowed. It cannot carry on business other than borrowing or lending in its own name, right? Now, there is one thing which is important. Nidhi companies can provide locker facilities to its members. Nidhi companies can provide locker facilities to its members, but whatever income you are generating, that is the locker rent you will collect, that should not exceed 20% of the gross income. That cannot exceed. Then you can provide locker facilities to your members. Otherwise, you're not allowed to, right? So that is about general restrictions. Every Nidhi is going to issue shares, and the nominal value 10 rupees at least. You cannot admit body corporate or trust as a member, not even a minor as a member, but a person can open FD in the name of minor, that's allowed. Net owned funds at least 10 lakh, I have already told you. Now as the Nidhi company grows, see, if I'm running into losses, I will not open another branch. So if I have continuously 3 years profit, then I can open another branch. And Nidhis operate in such a manner that they are for your known people, right? Not just unknown. You will not go out to invest in just any Nidhi company. You should have some background. It belongs to your area or something like that, right? So you can open up to 3 branches. If you have 3 continuous year profits, you can open up to 3 branches within the district. Beyond that, you need permission from regional director, right? I'm trying to tell you all the logic even in the revision class. I just cannot refrain myself from doing that. Anyways, now deposits. This is the part which is not relevant, so I'm not discussing this. Apart from this, your application form for deposits should have certain things. That if Nidhi company does not repay your deposits, where do you go? You can go to ROC. If you have any other complaint, you can go to redressal forum. Okay. The directors will give a declaration that they have complied with all the rules, and they will also state that government does not take any responsibility. It often happens that people come up to Nidhi company and they feel that, okay, I'm depositing my money over here, it's going to be safe, government is there. No, government is not there over Nidhi company. Government does not insure your deposits. It does not take any responsibility how sound the Nidhi company is. It may run into losses. So government is not involved. And a verification that whoever is making deposits is giving deposits to the Nidhi company at its own risk. Fine. We have a tenure. FD minimum 6 months, maximum 60 months. RD minimum 12 months, maximum 60 months. And in savings bank, you cannot, you will not get interest beyond 1 lakh amount. See, if people put all the money in savings bank, supposedly they have deposited 50 lakh in a savings bank account, Nidhi company might think that, okay, I can give away loan out of that 60 lakhs, but out of that 50 lakhs, but if I demand it back, Nidhi company will be shaken, right? So just like PPF, here also there is a rule that beyond 1 lakh you will not get any interest on savings. Now you put your money, who will put, right? Okay, so if I want to close my FD, I can. But FD matures. Supposedly I have opened an FD for 5 years and I want to close it at 2 years only. Can I? Yes, you can. Within 3 months you just cannot. Up to 6 months you will not get interest. Plus, if you want to close it at 2 years, you will get interest at the rate for 2 years only. Minus 2% penalty. So if my rate of FD for 5 years was 7%, and my rate of FD for 2 years was 5%, I will get 5% minus 2%, that is 3% only, right? But supposedly I died, then I'll get 5%, because that's not my fault of breaking the FD. Okay, unencumbered deposits, I've already told you, the loans can be given to the members only, but there is again a limit of the loan that can be given to a member. Okay, that means to one member you will not give loan beyond this particular amount. See, if your deposit is less than 2 crores, you will not give more than 2 lakhs. If it's 2 crores but less than 20 crores, not more than 7,50,000. If it's 2 crores but less than 50 crores, not more than 12 lakhs. And if it's beyond 50 crores, not more than 15 lakh rupees. That is the limit which has been given. Members can be given loan against security of gold also, against security of immovable property, and against security of FD, NSCs, other government securities and insurance policies also. You have different conditions and limits, small ones, associated with all these type of securities. Now, what rate of interest do you charge on your loan? Supposedly on FD, the maximum rate that you are giving is 7%. So 7 plus 7.5%, that is 14.5% is the maximum rate that you can charge on your loans. The director of a Nidhi company has to be a member. He will be appointed for 10 years. There will be 2 years cooling period, and then he can again be appointed. But he should be qualified to become a director according to section 164 only. Then he will be appointed here also. Nidhi company cannot declare dividend more than 25% or such rate as approved by regional director. But whatever rate be, if a Nidhi company wants to give dividend, it has to comply with 3 conditions: compliance with rules, transfer to general reserves, and no default in repayment of deposits. Auditor, if an individual auditor is going to be appointed 5 years, firm 2 terms of 5 years, again 2 years cooling period, again you can be appointed. Every Nidhi company has to furnish half yearly return in NDH3, and that is certified by CA or CMA in practice or CS in practice, right? Every auditor that is appointed also has to give a compliance certificate about rules. Now we have this rule number 23A and 23B, which talks about declaration as Nidhi. So if you are a company which is incorporated under the old act, you have a time period of 1 year from your incorporation or 6 months from the new rules, whichever is later, to get yourself declared. And if it's otherwise, you have a time period of 6 months, right? That is something that I've already told you. Otherwise, you have a penalty for contravention if you don't comply with it, right? So I think I've told you all about Nidhis, right? Okay. Now we move to producer companies. Producer company provisions are stated in a lot of sections, 378A to 378ZU of Companies Act 2013. But we don't have to read all the provisions, so we will read the selected ones. We will revise the selected ones. Section 378A, I had given you certain definitions. What is producer? Who is a producer? The person who is engaged in any activity connected with a primary produce is a producer, and 10 or more producer or producer institutions can form a producer company. It's for their own benefit, plus they get the advantages of being a company also. Synergies get attracted and they get a lot of benefits because a lot of facilities are being provided by the producer company and given to all its producers. So you get a benefit of being associated with a producer company. What is producer company? It is a company which is registered under this act and has objects as stated in section 378B. What are the objects? Production, all that past process of production, that is right from sowing of crops till actually selling it to the consumer, till it reaches the consumer. All that process involved production, harvesting, procuring, grading, handling, marketing, selling, exporting, importing. You import also a lot of things. Processing involves different process. Not in all crops you need these process: drying, distilling, canning, venting, right? Then even manufacture of machinery which is needed, agricultural equipments, providing education, technical and consultancy services to your members, generation of power, insurance of producers as well as the produce, right? Mutuality, welfare measures, any other activity, and even providing credit facilities to its members. So all these are the objects of a producer company. How a producer company is registered. Just like we have the normal process of incorporation of any other company, we have this producer company also. The difference is that you need 10 or more producer or producer institutions to form a producer company, right? Who can become the member? Someone who has the same interest as of that of producer company. So if your business interest is not in conflict with the business of producer company, yes, you can become the member, and if it is in conflict, you cannot become, right? If you become the member of producer company, you get these things. If you are a member, if I am a member, I supply 100 kgs of apples to the producer company for sale. So I will get the value for those 100 kgs of apples that I have supplied, plus I will also get bonus shares, and I can also get patronage bonus because I've participated in the business activity that the producer company is supplying. Supposedly producer company has opened a storage facility. So producer company is giving storage facility, and I'm using that storage facility. So I have contributed to the business activity of the producer company. So I will also get patronage bonus for participating in business activity, right? So whatever surplus producer company is earning, that may be distributed in the form of bonus shares, that may be distributed in the form of limited return, that may be distributed in the form of patronage bonus, or that may be retained by the company for development or for providing general facilities to the members. Just like every company, producer company also has a memorandum. Okay. In memorandum, you have name clause. For producer company, the suffix has to be producer company limited. You have state, you have object, you have capital, and you have liability. The liability is limited, capital is divided, subscribers subscribe to the capital. Apart from this, you have subscriber details, the director's details, and if your producer company extends beyond one state, then the states to which it extends, that will also be there. Okay, next, Articles of Association, section 378G. Articles also have a very important role in producer company. A lot of things are given in the articles only. The articles of producer company clearly state that the membership is voluntary. Anyone can become the member if you are eligible to be the member. If you are eligible producer, if you comply with the conditions that are specified, if you qualify, the qualifications of members, if you comply with it, then you can be the member. And no matter whether you hold 100 shares or 500 shares or 1 share, you will have single vote. The company is going to be administered by the board of directors, which will be elected. And particulars of limited return. What is limited return? The maximum dividend that may be paid. How the surplus is going to be distributed. That means we have to develop our business, we have to provide facilities, and we also have to distribute it to the members. So how it will be decided, that is given in the articles of the company, right? Moreover, we also have what is going to be the composition of board of directors. Like how are we going to appoint the directors, how are we going to remove the directors, how are we going to fill the casual vacancy of the directors, what is maximum, minimum, how are we going to rotate the directors and all that part, how are we going to elect the chairman, how are we going to conduct the voting process, right? Are we going to do withheld any price? That is, if I supply 400 kgs of apples to the producer company may decide to pay me half a price. So that is withheld price. Sometimes it can be withhold, right? What if the company is unable to make sale? There can be situations. So how the manner in which it is going to be determined. How are we going to distribute patronage bonus, or how are we going to give away bonus shares? How are we going to allot the shares, reserves, the credit that we are going to give to the members? If any member seeks some information from the producer company, how is it going to be given? That is within 3 days, within 7 days, or it's going to be chargeable, it's going to be free. Everything has to be stated in the articles. If the company liquidates, how are we going to dispose of the funds? If the company wants to merge with any other company, is it permitted to do so? Who has the power to take decision in this regard? Is it the members or is it the directors? Right? So all that part is written in articles of the company. Articles of producer company. Then you have number of directors. Section 378O, minimum 5, maximum 15. In general meetings, these are the matters which are going to be discussed. Adoption of annual accounts, patronage bonus, bonus shares, limited return, conditions on which loan may be given to directors, and any other extra thing for which you need permission from members. This is also found in Articles of Association. So any transaction which is reserved for taking permission from the members. So all these points are discussed in the annual general meeting of producer company. Apart from this, to conduct a meeting, you need 1/4 of the total membership as quorum. So if there are 100 members in a producer company, you need at least 25 members. They should be present, only then a meeting can be validly held. Voting rights, I have already told you, 1 member, 1 vote. If there is equality, the chairman will have a second or casting vote, that is a presiding vote, right? So that's it with this particular chapter revision. Thank you.
Let's now revise the chapter of deposits. Ideally, what is deposits? But before that, from where does this chapter come from? It is part of the chapter investment and loans, right? So investment and loans ideally has two components according to our syllabus. One is the deposits, which is read in a separate chapter in company law, which is an altogether separate chapter, right? And has a very few sections starting from 73 to 76A. And other, we also have a topic about investments, which is a part, just a part of chapter that we discuss later, right? So, first of all, deposits. What do you mean by deposits? Any receipt of money. So, company, if it is receiving money in any form, whether you call it deposit, whether you call it loan, whether you call it any form, it will be treated as deposit. However, there are certain categories of receipt of money by a company which will not be treated as deposit. They are the categories prescribed in consultation with RBI. Okay, like basically, if you try to understand the gist of deposits, what is it? If company is receiving money in any form, it must be regulated. That is the main intention of law. Now, if company takes a bank loan, they have an agreement. So it is being regulated, right? So we have terms and conditions, and company cannot unnecessarily exploit the lender. Likewise, when you're issuing shares and raising money from public, then you have proper regulations which are being made under company law. When you issue some securities which are listed, then listed, that is SEBI has made a lot of regulations with which you have to comply. So ultimately, it is important that all the receipt of money by companies should be regulated. However, there are certain unnamed category or receipt of money which remain unregulated because they do not have a name. So that leftover receipt of money, they are actually included in deposits. That means if I say, if you receive amount from government, it's regulated by government. So not deposit. If it is through some foreign source, it is regulated by FEMA, RBI approval and all that. So it's not deposit. If it is from banks, it is not deposit. See, we have certain prescribed category of receipt of money, which are not deposit. So any type of loan, any type of instrument that you issue in accordance with RBI, you take some money from another company, you take some application money which you're bound to either refund or make an allotment in the same regard. If you receive money and you don't make any allotment within 60 days, it has to be refunded in next 15 days, right? If it is not done so, here the time limit is different. If it is not done so, then it will be treated as deposit. Otherwise, that money is not deposit. If you receive from your director of company or from relative of director of private company, it's not deposit. Secured convertible bonds, debentures, listed debentures. So unsecured debentures which are not listed are deposits. So unsecured debentures which are not listed, they are going to be treated as deposits, and you must comply with the provisions which are given for deposits. See, they basically prescribe that if you want to take money from anyone just like that, then you have to comply with certain requirements. That means you must return the money, you must give them proper offer, you must give them interest, right? should be the minimum period, this should be the maximum period. All the terms and conditions are specified. Fine. If you receive amount from employee which this should not exceed your annual salary and no interest should be there on that amount, right? If we hire someone, we might ask him to give a security deposit which is non-interest bearing. Then if any amount is received just in trust, that you keep it, it belongs to me, but you keep it, non-interest bearing. Then as a part of your trade advances, that means you have taken advance for supplying some goods, you've taken advance for selling the immovable property, you've taken advance, you have taken some security just to be sure that the contract will be performed, right? There is some amount that you receive from your customers in the form of warranty that you are going to provide for in future, or you have taken some advance for some publication means maybe magazine, journal, so they subscribe for it annually, so that is not deposit. Okay. If the money is received from the promoters, now, sometimes if I am a company and I go to the bank and request them to give me loan, bank might say that you ask your promoters also to contribute. So banks have placed a condition that if your promoters contribute, then only I will pay the loan. So if the loan is brought by the promoters as a stipulation by bank, so till the bank loan is repaid, the promoters also have to pay that amount, and company cannot repay it back. So till that time, the amount received from the promoters will also be treated as will not be treated as deposits. After that, it will be treated chit fund, nidhi, CIS, not deposits. If the amount is received by startup, because startup companies need a lot of funding, so people invest in the startup, and if they have given at least 25 lakhs in a single tranche, um, which will be later on converted into equity, then that's not deposit. And if you receive from any of these funds which are registered with SEBI, that is alternate investment fund or venture capital funds, right, or real estate investment trust and all that, then it is not deposit. Okay. So company is the one who is receiving money, and there is someone else who is giving money to the company. That someone else is a depositor. That someone else or the depositor can be the member of the company or can be general public. But only an eligible public company is allowed to receive money from general public. Otherwise, all the companies, whether private or public, can receive these deposits from their members subject to the limit and conditions given in this chapter. Right? Okay. So can deposit be accepted? Yes, by a private company from its members, by public company from members as well as public if it is eligible to do so after complying with the provisions and conditions. Fine, ma'am. There are some types of companies which are absolutely exempted from these deposit provisions, but for obvious reasons. If it is a banking company, its core business is to accept deposits. We cannot place restrictions on deposits every now and then, right? So banking companies, NBFC, HFC, that is housing finance, and other which may be specified in consultation with RBI, they are all exempted. Okay, so they can receive any money without complying to this chapter. Fine, ma'am. Now, firstly, section number 73. When you receive deposit from your members, what are the conditions that you have to comply with? First thing, call general meeting and pass ordinary resolution. So when your members permit, then you can accept deposits. Then you have to prepare a circular. What is preparing circular? It is nothing but like an offer document wherein all the details will be prepared. Okay. Then you also prepare a certificate that you have not done any default in repayment of any previous deposit or its interest thereon. File the circular with ROC.
appoint a deposit trustee, execute a deed with them, and then issue the circular to members for inviting the deposits. Okay, once you've accepted the deposits, it's important that the deposits must be secured. So, creation of adequate security. And once you accept deposits, within 21 days, depository receipts should be issued to you. There should be a deposit repayment reserve which will be created. And whatever deposits are maturing in the following year before 30th April, 20% of the deposits which are maturing, you will transfer to that reserve, which will be used for repayment undoubtedly. And every year, a return of deposits is filed, that is DPT3, before 30th June with ROC. And it is very obvious that if you have accepted deposit for 2 years, after 2 years, you have to pay it. Whatever are your terms of interest, you have to pay accordingly. If there is failure, then the depositor can make an application to tribunal and tribunal can pass adequate orders. Fine. Now, there are some clauses which are not applicable to certain company. Now, the certain company I will explain you a little later. We'll revise little later. Fine. And this section also will revise little later. First of all, let's understand other aspects of deposits. Whether it's a private company or it's a public company, if it wants to receive deposits, the minimum tenure or the tenure has to be 6 months to 36 months. That is minimum 6 months, maximum 36 months. More than that is not allowed, and less than 3 months is also not allowed in any case. But less than 6 months but more than 3 months is allowed if you want it for your short-term needs and the amount does not exceed 10% of paid up capital plus free reserves plus securities premium. Ma'am, is this the limit for normal deposits as well? The answer is no. This is the limit on deposits. If you are a private company and you fulfill certain criteria of exemption, that is this, then there is absolutely no limit on you. That means if you are a startup for 10 years, you're a private company which is not a associate or subsidiary and your borrowings are less than lower of 2 times of paid up capital or 50 crores and there is no default in repayment of deposits. Okay, so if you comply with these conditions, then there is absolutely no limit. If you fulfill the criteria of exemption, no limit. You can accept as many deposits as you want to. And for other types of private companies, 100% of your paid up capital plus free reserves plus securities premium. Okay. For public companies, you have to check whether you are eligible or not. If you are an eligible company, then you can receive from non-members also. In that case, from non-members up to 25%, from members up to 10%. If you are not an eligible company, then you have an overall limit. Okay. Now, if you are an eligible government company, then also this bifurcation is not there. Then also you have an overall 35% limit. Okay. Deposits can be accepted in the joint names also, but not exceeding 3. This can be a question of MCQ. And the rate of interest will not be more than the rate specified by RBI for NBFC. I hope that's clear. So these are the conditions of deposits. Now, how do you accept that deposit? If you want to accept it from members complying to that condition, follow section number 73. If you want to accept from general public, then follow section 76. Section 76 is nothing but a replica of section number 73 with slight addition. Okay. It actually gives reference to section number 73 only. So if you are an eligible company, only if you are an eligible company, all public companies are not allowed to receive deposits from general public. Only eligible public companies are. So they can accept deposits from public after complying with above conditions. So resolution,
what is additional, credit rating mandatory, and the circular will not be given to members, because here you are giving offer to general public, so it will be issued in the form of an advertisement. So advertisement will be published on in newspaper, on website, right? It also has validity, and thereafter the deposits will be accepted, charge will be created, deposit receipt will be issued, everything is the same. Then question is, who is an eligible company? If you are a public company and you have net worth of more than equal to 100 crore or turnover of more than equal to 500 crore plus, you get consent from your members. If you want to accept deposits within the limit of Section 180, consent can be a simple ordinary resolution, otherwise SR. So if these conditions are fulfilled, then you become an eligible company. And only an eligible public company is allowed to receive deposits from from non-members or general public by following these provisions. Apart from that, deposit register will be maintained, which will contain all the details. It will be preserved for 8 years. It will be kept at the registered office. There are two disclosures which must be made in the financial statement: amount that you receive from directors, and in case of public company, an amount which you receive from directors as well as relative of directors in case of private company. You have to appoint a trustee for depositors. So before issuing any circular, you have to find a deposit trustee who is not disqualified, obtain his written consent, prepare a trust deed, file this trust deed also, and then issue the circular along with the statement that we have received the consent of the requisite person. He will discharge the duties which are prescribed. He can be removed before his term also, subject to following of conditions. Now, who is disqualified to become the deposit trustee? That means who cannot become deposit trustee? If you are a depositor, if you are a director or KMP or employee of company holding subsidiary associate, if you're indebted to company holding subsidiary associate or subsidiary of holding, if you have a material pecuniary relation, if you have given guarantee of some deposits, or if you're a relative of above. Okay. Of course, in the chapter of deposit, you have a lot of things which you have to learn. In case you haven't learned them yet, it will be difficult for you to connect with me at this pace. So in case you don't remember these limits, you don't remember this tenure, you don't remember the flow, please learn it also. Then you will be able to revise well with me. Right? Okay, so then there is contravention. That if you contravene the chapter of deposit, then you have penalty on company as well as officer in default. And if the intention, if fraudulent intention is proved, then also liable under section 447, right? Let's now revise the chapter of dividend. The dividend chapter, it is chapter 8 of Companies Act 2013 and contains very few sections, section number 123 to 127. First of all, we need to understand what do you mean by dividend. If we go by the definition, it is defined in section 2 clause 35. However, it only tells you dividend includes interim dividend. So what exactly is dividend? We are unable to identify. We only get to know that all the provisions of dividend should apply equally to interim dividend as well, because dividend includes interim dividend. Fine. What is dividend? Whenever a company earns profit, if there is no profit, of course, there will be no dividend. Whenever a company earns profit, it has two choices to make: whether to retain the profits or to distribute it, or how much to retain and how much to distribute. When it decides to distribute the part of profits to shareholder, this can be done in two ways: distributing it in cash or distributing it by capitalizing some shares in the form of bonus shares, which is absolutely a separate topic and is a part of the chapter of share capital according to section number 63, which we are not discussing right now. right? We are discussing about that part of cash profits which is distributed to the investors, distributed to the shareholders when the company earns profit. Okay. Now, there are certain types of confusion which the students have. Confusion number one is with respect to preference dividend and equity dividend. Preference dividend, you have to remember certain things. Rest, forget everything. The chapter revolves around equity dividend. Okay, what things you have to remember for preference dividend? Whenever the company wants to go for any declaration of dividend, they have to first give the dividend to preference holders. Their rate of dividend is fixed. They are being given dividend which is part of profits. So obviously if there are no profits, preference dividend also cannot be paid. However, if it is a cumulative preference shares which have been issued, then the preference dividend which is unpaid for any year will be added and will be paid in the next year. However, if it is non-cumulative preference shares, then the dividend, if not paid, goes in vain, right? It's not added, it's not accumulated. So if the company doesn't earn profit, it may waive off the payment of dividend. But in any case, before paying dividend to equity shareholders, dividend to preference shareholders will be done. Fine. Now, when we talk about the dividend, they can be of two types, final and interim. Final dividend is proposed by the board and declared by shareholders only at annual general meeting by passing ordinary resolution as it is a matter of ordinary business. Interim dividend is declared and proposed and declared, everything is done by board when it is declared between the annual general meetings. So right, not exactly between, yeah, you can say between annual general meetings. So the duration ideally is from start of the financial year till the end of the financial year, and even after that till holding of annual general meeting. So ideally board has to take a call whether to pay dividend or not. If yes, at what rate dividend should be paid, for which financial year dividend should be paid, and how do you want the dividend to be paid. If you want the dividend to be paid as a final dividend, then it will be declared by shareholders. So the board will propose the same. The shareholders can reduce it, they cannot increase it, and it will be declared. If the board wants to do it themselves, then they can propose, they can declare it. Okay, fine, ma'am. No equity dividend will be paid if there is a default in the repayment of deposits. Okay, section 73, 74 default. If there is, if that default persists, then you cannot pay dividend to your equity shareholders. Now, Section 123 has a lot of things incorporated into one. However, we will read first the segment of interim dividend and thereafter we will proceed the whole section. Because for interim dividend, you just have to remember two different things declared by board, and secondly, the sources of payment of dividend are different. Apart from that, every provision of dividend applies to both the types of dividend, whether it is interim or it is final. Okay. So it can be declared during financial year or even after financial year till annual general meeting by board. What are the sources? There are three sources. For this chapter of dividend, P&L account and free reserves are two different things. Ideally, they are the same for us, but for this chapter, they're two different things. P&L means the undistributed profits. However, the profits which are transferred to reserves cannot be used so easily for payment of dividend. So point number one, the sources. Whatever profit is lying in your P&L account, whatever amount is lying in your P&L account, that can be used for paying interim dividend. Secondly, the profit which has been earned in the financial year or for the financial year for which you're paying interim dividend. Fine. Thirdly, supposedly, we're talking about financial year 22-23. and after the financial year ends, we're paying interim dividend for that financial year. Possible? Yes, ma'am. So, in which year we are paying? We are paying in 24-25, right? So, we are paying in the next year. In this year also, till this date, till the preceding quarter, the company must have earned some profit. So that profit can also be used for the payment of interim dividend of preceding financial year, ideally. Okay, so these three profits can be used. Now, when you are paying dividend after the end of the financial year, then preceding quarter has to be checked. If preceding quarter has witnessed a loss, then law puts a limit on how much maximum dividend you can pay. What is the maximum interim dividend that you can pay if the previous quarter has witnessed a loss? Then what is the maximum interim dividend that you can pay? Not more than average of preceding 3 financial years. Fine. Okay, fine, ma'am. Now we ideally come to section number 123, and these are the sources that we are talking about the final dividend, because for interim dividend we have read separate sources. So these are the sources of dividend that we are discussing for the final dividend. Fine. Out of current year profits, after providing for depreciation, out of past year profits. Now, past year profits are of two types. As I told you, if it is undistributed, stays in the P&L account. If it is transferred to reserves, they are different. And for utilizing that, you need to fulfill the conditions of Rule 3. Okay. So the three things, the three sources of dividend without any condition compliance are the current year profits after providing for depreciation, the balance lying in P&L account after providing depreciation, and the money which CG or SG has provided as a part of guarantee. So if central government or state government takes any guarantee, in the case of government company, of course, that investors, you invest and we guarantee you that we'll pay you this dividend. If the company doesn't make profit, then we will provide you the money to pay dividend. So the government provides money, and out of that money, dividend can be paid. Fine. Dividend will always be paid after setting off the losses and depreciation. Fine. If the company does not have sufficient profits in the current year or in the P&L account and wants to use reserves for paying dividend, can it? The answer is yes. So even in case of loss, you can pay dividend using the past year profits which have been transferred to reserves by complying with 4 conditions given in Rule 3. What are the 4 conditions? The rate of dividend will not exceed the average of last 3 years. Whatever amount you draw from the reserves, it's not going to be more than 1/10 of paid up capital plus reserves. The amount that you draw will be first utilized to set off losses, and then it will be used in the payment of dividend. And fourth, after withdrawing from the reserves, the balance of reserves should not fall below 15% of paid up capital. So if these 4 conditions are satisfied, then money can be drawn even from reserves for payment of dividend. Fine. The depreciation shall be computed according to Schedule 2. Okay, fine, ma'am. How the dividend will be paid? The dividend will be paid only in check, cash, electronic mode, or dividend warrant. The dividend has to be deposited within 5 days. Whenever the dividend is declared, whether interim or final, whenever it is declared, it has to be within 5 days transferred or deposited in a separate bank account, and within 30 days of declaration, it has to be paid. If it is paid, great. If not paid, then you have certain consequences given in section 127. Apart from that, if it is not paid for certain reasons, of course, there can be genuine reasons that the person did not claim. We wanted to pay, but we could not pay. The person did not claim. So within 7 days, you have to open a special account named unpaid dividend account in a scheduled bank, and you have to transfer the amount over there. If you don't transfer, then there is an interest at the rate of 12%. If you transfer it Within 90 days of transfer, you have to prepare a statement about the last known names and addresses of the investors, which we consider as prospective, and they should have been there to collect the dividend, or they are entitled to dividend, but they haven't collected it yet. So a statement of the same is going to be prepared and put on the website. Now, any investor who comes to know of it later on can apply to the company. The company will make the payment accordingly after verifying the identity and everything. If in that unpaid dividend account the amount remains unpaid for 7 consecutive years, then it is going to be transferred to IEPF. It is going to be transferred to IEPF. If it is paid, great. If it is unpaid for 7 consecutive years, it is going to be transferred to IEPF. What is IEPF? Investor Education and Protection Fund. Investor Education and Protection Fund. The question is, what is IEPF? We read about it in section number 125. Central government establishes a fund, and which has a authority is constituted, which administrates or which administers the fund, right, which manages the fund. In very simple language, it maintains all the accounts, that from where the money is coming, from where it is going, prepares an annual report, the audit is also done, everything is done. Now there are some credits and there are some uses of this fund, that is from where the money comes to this fund and from where it is used. Not a very important section, however. See, government grant from unpaid dividend account, just like we read. In the same manner, there are a lot of investments, there are a lot of application money, there are a lot of deposits. The deposits have matured, the debentures have redeemed, but there is no one who claims them. So ultimately, it is not the government's money. Government owes it to the people, and the people are not there to claim. That doesn't mean that the government will leave the company. Okay, fine, you keep it and enjoy. No, you have to transfer it to IEPF, and IEPF, from there also people can claim later on. If they come to know that they have to take something from the company which has been transferred to IEPF, they can make an application to IEPF, provide the adequate proof, and they can take money from there also. Okay, so all that part is credited to the fund, and the fund is utilized for refunding money, of course, for promoters education, for reimbursement of legal expenses and all that part. Okay, now section 127 is an important section which provides the punishment for failure to distribute dividends. If the dividend is not paid within 30 days as it is supposed to, then there is penalty. The director and the director who is knowingly a party is liable to imprisonment as well as fine. Imprisonment can extend up to 2 years, and the fine for 1,000 per day, and the company is liable to pay a simple interest at the rate of 18% per annum. However, in certain cases, the company is not liable. Why the company is not liable? Because the company tried to pay dividend, but the company could not, because of maybe operation of some law. That is, there is a foreign investor and we have to make dividend payment, but the provisions of FEMA are not letting us do that. We cannot. It's not our fault, it's not company's fault. See, company will be penalized or punished only for its fault. This is not company's fault. Secondly, the shareholder gave us a direction which cannot be complied with. The shareholder told us to issue a dividend warrant only, and that warrant returned at the address mentioned by the shareholder. What is our fault? There is a dispute. We do not know the shares belong to Mr. A or Mr. B. The shares have been transferred, they haven't been registered in proper name, the document is inadequate or something like that. So we do not know who to make payment. So we have refrained the making of payment, not our fault. We have to take something from the shareholder. Maybe call money is due from the shareholder. So we have adjusted the dividend against that call money. Rightfully done. And any other thing which is not our default. So if we are not at fault, we will not be penalized. Otherwise, we will be penalized. Right? Dividend, once it is declared, it cannot be revoked. This is simply the time limit, just to make you revise the same. Let's now revise the chapter of accounts of companies. Now, this is chapter number 9 of Companies Act and contains section 128 to 138. Right. What is it all about? The first thing, company has to maintain books of accounts and books and papers. Now, this the first chart that you're seeing is nothing but an intro chart. This is not any section chart. Okay, so company has to maintain books of accounts, books and papers for whole year. The question is, what do you mean by books of accounts? If I talk about books of accounts, it means your details with respect to expenditure and income, your details with respect to assets and liabilities, your details with respect to sale, purchase, and cash records. So that is books of accounts. Now, books and papers ideally includes books of accounts plus deeds, voucher, the supporting documents. So they have to be maintained for the whole year. And at year end, you prepare financial statements. The question is, what do you mean by financial statements? Balance sheet, P&L, cash flow statement, statement of changes in equity, and explanatory notes. Cash flow statement is not required to be made by one person company, small company, dormant company, and a startup private company. Right? So every company, whether private, whether public, whether small, whether big, every company has to maintain books of accounts. Books of accounts and books and papers for whole year. And financial statements at year end, which is first approved by the board, signed by the board, then given to auditor for audit, then audit report is obtained, it is circulated at an annual general meeting, it is laid before the members, and it is adopted by passing ordinary resolution as it is a matter of ordinary business. After it is adopted, it is filed with ROC. The books of accounts may be reopened according to section number 130. Okay. So this was the general view of the whole chapter. Now, if we go section by section, section number 128, that is the first section that we read in this chapter. Every company has to prepare books of accounts, we read earlier. For every financial year, they have to be prepared on accrual basis, as in when they accrue it on double entry system by complying with accounting standards, which must give true and fair view. Now, these accounts may be prepared physically or even electronically. But if it is prepared electronically, we must follow the rules prescribed. Like it should be accessible in India, retained in original format, it should be unaltered, there should be proper storage and retrieval things, right? The details of service provider, and this is now 23. Audit trail feature is also mandatory. See, if you're using an accounting software like maybe Tally, SAP, ERB, whatever accounting software, QuickBooks you're using, you must ensure that it has an audit trail post 1st April 2023. Okay, so you have to ensure that. Fine, ma'am. Now, the books have to be preserved for 8 years. There is penalty for contravention. Supposedly investigation is going on, then it will be preserved for even longer tenure till investigation. Where do you maintain these books of accounts? The books of accounts will be kept at the registered office of the company. If it relates to some branch, then it can be maintained at the branch, and then the periodical returns will be sent to the head office. If it is a foreign branch, then quarterly returns will be sent. Supposedly, the board of directors don't want to maintain books of accounts at the registered office. It is completely the discretion of board. You don't have to confuse between register of members and the books of accounts. Register of members may be kept at a place where 1/10 of the board members reside, etc., etc. Right, here we are talking about books of accounts, and books of accounts may be kept at any place which the board may decide. So it will be shifted there, but within 7 days in AOC form, AOC 5, you have to notify this to ROC. Your books of accounts, which are kept maybe at a registered office or some other place, and the summarized returns of the branch or other financial information from outside India, this is all open to inspection by the director or his agent during business hours. And it is the duty of all the employees to give proper assistance. Then we come to next section, that is financial statements. I already told you what are financial statements. So company has to prepare financial statements which shall give true and fair view. There is a schedule 3 which prescribes the format, but this format is not applicable to banking company, insurance and electricity company, as they have their different format of reporting. Okay, so you have to comply with the AS, and you don't have to you have to comply with all the accounting standards. In case there is any deviation, it must be disclosed. Why there is deviation, that also must be disclosed, and what is the effect of this deviation, that also must be disclosed. Apart from this financial statements, if the company has subsidiary or associate, then it will also prepare consolidated financial statements in the same form and manner. But if it is an intermediate holding, that means ultimately there is another holding which is actually consolidating and preparing CFS, then you can skip it. Okay, then that is then CFS is not required. Now financial statements, CFS and a statement of subsidiary, you can say that all is going to be the set of financial statements and laid at annual general meeting. Your financials, your CFS, before it is handed over to the auditor, it is first approved by the board. Now, how will the board approve it? It is signed on behalf of the board. If the chairman is authorized, then the chairperson signs it. If he is not authorized, then 2 directors, one of whom shall be MD, and CEO, CFO, and CS if appointed. Okay, in case of one person company, it is just signed by one director and handed over to the auditor for audit. Okay, now once the audit report is prepared, it is the right of every member, debenture trustee, and every person who is entitled to the notice of general meeting to receive the set. What set, ma'am? Financial statements, consolidated, audit report, board report, and extras, everything. Okay. So it has to be sent. When it has to be sent, at least 21 days before AGM, along with the notice of AGM, it is usually sent. But if you obtain the consent of these people, then it can be sent at a lesser period also. In case of listed company, it's not important or mandatory to send the whole set. You can circulate it as above, or you can keep this available for inspection before 21 days and send a brief statement containing salient features of the same, unless some member asks for the full statement. Okay. And if you're a listed company, undoubtedly your shares will be in electronic mode only, so you have to send it electronically. And if there's a public company with this net worth and the shares maybe they are not in demand, then you can obtain the consent and send it electronic mode. Otherwise, you have to send it physically. Fine. Okay. Now, reopening of the accounts. Supposedly, the accounts that were made and they were finalized, they were fraudulent, or the affairs were being mismanaged, basically fraud. It is the case of fraud. Central government, SEBI, income tax, any other statutory body or any person concerned identifies that fraud, makes an application to the tribunal. NCLT sends the notice to all these authorities to seek their observation, to seek their representation, and order the company to reopen their books, but not earlier than 8 years. So 8 previous years, the books may be reopened and the accounts shall be revised or recasted, and that recasted account shall be final. There is another section, section 129A, which is made for ideally unlisted companies, which has given power to central government. The central government can ask the unlisted companies that you prepare financial results on some periodical basis, maybe quarterly, half yearly, and they have to give reports that way. Okay. We have another section 131, which talks about voluntary revision. So here the directors ideally pass the board resolution and they apply to NCLT. Why do they apply to NCLT? Because the accounts that they have prepared, the financial statements that they have drawn, they do not comply with section 129, or the board's report that they have made does not comply with section number 134. So for past 3 years, they can make an application. Again, NCLT will give notice to income tax authorities and CG to seek their representation and then pass the order for revision. It is like filing revised return, but you are given just one option to revise. So once a financial year, that's the maximum that can be done, but only on these two grounds. Now, what do you mean by board's report? We have a section 134, which talks about board's report, and there is a huge list. Obviously, I am not going to read the whole list over here. You can read it. There is a lot of content. It is ultimately the responsibility of the board, which the board is addressing to the shareholders, and has to speak about all these matters. For OPC and small company, we don't have such elaborate board's report. We have an abridged form. So there are lesser contents which are needed in the abridged report or in the board's report of OPC and small company. Okay, I think that's clear. Right. Now, after that, we have a section 135, which is the 134 we have discussed. 135 is corporate social responsibility, CSR. Now, what do you mean by CSR? And which companies are required to go for CSR? So every company which has net worth of more than 500 crores, turnover of net worth of more than equal to 500 crores, turnover of more than equal to 1000 crore, or net profit of more than equal to 5 crores during the immediately preceding financial year has to formulate a CSR committee. CSR committee is not required if your expenditure does not exceed 50 lakh. So you have to prepare a CSR committee. Now, the CSR committee is responsible for preparing a CSR policy, that where should we spend, because it is mandatory. It is made mandatory by law that out of your net profits, at least 2% of your net profit, average net profit that you have made immediately preceding 3 financial years, the average 2% net profit must be spent towards society. We have Schedule 7, where there is a huge list of CSR activities, possible CSR activities which you may undertake. So it depends upon the CSR committee to formulate this policy and recommend to board, who is going to approve and thereafter undertake CSR activity. Who shall be the part of CSR committee? 3 or more directors, out of which at least one shall be independent director. Okay. So this CSR policy will be placed on the website also. How CSR activities can be implemented? Through any company, any NPO which is established by the company itself. Like we have seen in case of Reliance, right? Any company, any Section 8 company which is established by CG, or which is established by some government, or any under any other act of parliament, or any other company, Section 8 company, if it has 3 years of track record of similar activities. There is another form which has been introduced, Form CSR 2. So it has to be filed. Earlier, we only had to give information about CSR in our board's report. Now we also have to file a report with ROC in CSR 2. If you do anything just for your employees, or if you do anything outside India, or if you contribute to some political party, or if you're doing the activity as you do in the normal course of business, then that will not be treated as CSR. Now, we have another provision of set off for CSR. Sometimes it happens that we want to do something good which will take time. So we want to spend money in a project which will take for 2 years. So we have spent that amount, but only half of it is utilized. The remaining is unutilized because the project goes on for 2 years. So whatever is the unspent money, that has to be transferred within 30 days to some scheduled bank, and then you can, or if you have spent it excess, then you can later on set it off. If it is not any ongoing project and you had to spend 1 crore, but you ended up spending only 70 lakhs, so the remaining 30 lakh you must transfer it to some fund which is specified in schedule 7, and it will be treated as your CSR expenditure. Okay, fine, ma'am. Okay, coming back to a section that we missed. Section 137 talks about filing of financial statements, filing of documents. Annual general meeting, if it is held, then in these cases you need XBRL reporting also, AOC4 XBRL. Otherwise, financial statements, CFS, other documents, all that annexure, all that set, plus accounts of subsidiary, they all would have been laid at AGM because AGM is held. So it would have been adopted. If it is adopted, file the set with ROC within 30 days of AGM. In case it is not adopted, then also file it. ROC will keep it as at provisional records, and at an adjourned AGM when it is adopted, then you will refile it. Supposedly AGM is not held for whatsoever reason, then also you have to file the whole set and also state the reasons why AGM was not held. Of course, this does not apply to one-person company, because in one-person company you don't have to conduct any annual general meeting. Once your financial year ends, within 180 days, you file the financial statements. Okay. We also have a section of internal audit. Internal audit, section 138. So we have these prescribed companies. Every listed company, unlisted public company fulfilling any of these criteria, private company fulfilling any of these criteria, they are going to appoint an internal auditor who can be a chartered accountant, cost accountant, or any other professional. He can also be an employee, individual or partnership, and he is going to discharge the functions within scope as determined by audit committee, or if the audit committee is not there, then of course the board of directors. Okay. Chapter of audit and auditors. Chapter 10 of Companies Act and contains sections 139 to 148. Right. Okay. So what is audit? In this chapter, we talk about statutory audit, which is mandatory for every company. Right. So audit is mandatory for every company, every financial year. So if you have a company which is incorporated under this act or under any previous act, then it is mandatory for it to find an auditor who is eligible to get the accounts audited, right? Okay, fine. Who can be the auditor? Only an individual if he's a CA in practice. If you go for the firm or LLP, where the majority of partners are CA, but only CA can sign the audit report, provided they are qualified under section 141. So section 141 subsection 3, we read a list of disqualifications, very important for examinations. If a person is not disqualified, then only he can become the auditor. And when he is doing the statutory audit of the company, he should not render certain services. So certain services are prohibited, which are given under section 144. How the auditor is appointed, of course, we find the auditor, we see whether he's eligible or not, we check whether he's disqualified or not, we check whether his appointment is as per term or not, we check whether he is doing the audit within the ceiling limit or not. So we take that certificate and all that from him, and also obtain his consent, and thereafter appoint the auditor in the manner which is prescribed in this given chapter. We inform the auditor that you have been appointed. We also file the notice of appointment with ROC. The auditor can be removed. He can also resign. He has certain duties and rights which he can exercise, and he has to discharge. Okay. Now, how the auditors are appointed, that is the first thing. We all know that it is the management which prepares the financial statements, they are approved, and thereafter they are handed over to the auditors for audit, for obtaining a true and fair view on the financial statements which have been prepared, right? Section 139 is a huge section. It talks about the appointment procedure. It also talks about some rotation, and it also talks about if there is casual vacancy in the office of auditor, how that is going to be filled. And it makes a distinction between the normal types of companies and government company, because the auditor of government company is appointed by CAG, that is the authority, comptroller and auditor general of India, right? So by CAG. So that is why everywhere we will read this difference and distinction. Now, one more thing before I start. Although audit committee right now we don't discuss, it is discussed in section number 177. However, what is audit committee? Audit committee is nothing but a group of directors who are dedicated for this audit purpose, right? So they supervise the whole audit process going on in the company. So in case audit committee is not mandatory in all types of companies, if you exceed a certain threshold or if you're a listed company, then audit committee becomes mandatory. In case your company has audit committee, then all the decisions will route through audit committee. So first audit committee will recommend and thereafter board will do. But if there is no audit committee, then directly from board. So this is the distinction that you have to keep in mind. After you keep this in mind, we are good to go to start with the appointment of auditors. Okay. So first of all, let's talk about the non-government company, that is the usual case. When we are appointing the auditors for the first time, there can be two cases. Company has audit committee, there is no audit committee. If the company has audit committee recommends a suitable name to the board and the board appoints. Board appoints within 30 days of registration. If the board fails to appoint, then the members call EGM and they appoint within 90 days, who are going to hold office till the conclusion of first AGM. So whenever they are appointed from there till first AGM is concluded, the auditor holds the office. Thereafter, subsequent auditor will be appointed. But supposedly we don't have an audit committee. Now, in case we don't have audit committee, directly board comes into picture and board appoints. If board fails, members appoint. Simple. Right? Now, the first auditor retires or leaves the office at first annual general meeting. He can be reappointed. That means the same person can be reappointed for another term from first AGM to sixth AGM. But we can also appoint someone else as the auditor. Again, there are two cases. If there is audit committee, the board committee recommends name to board recommends to members. The first auditors are appointed by the board. However, the subsequent auditors are appointed by the members. Appointment of auditors is a matter of ordinary business and requires ordinary resolution. Okay, if there is no audit committee, then the board directly recommends the name to the members and members recommend to the, members appoint it. Okay. If you want to reappoint the same auditor, you must ensure that no resolution has come to you for his non-appointment. No special notice has been received for not appointing him and he's not disqualified. Okay. If at annual general meeting an auditor could not be appointed or reappointed, he will continue. He will be deemed like existing auditor shall continue. Now, when we come to government company, in government company, the first auditors are appointed by CAG within 60 days. If they fail to appoint board within next 30 days, if they fail to appoint members within 60 days at AGM. Subsequent auditors within 180 days from the close of financial year. by CAG, no other option. Okay. So this is undoubtedly something that you have to learn. You don't have a choice. Next is rotation of auditors. Rotation of auditors. What is rotation of auditors? And rotation of auditors means one auditor cannot continue for a long tenure. But obvious reasons are there, but this is not mandatory for the small type of companies. Listed and prescribed companies. What are prescribed? If you are unlisted public company with paid up capital more than equal to 10 crores, private company with paid up capital more than equal to 50 crores, or company which has a public borrowing or public deposits more than equal to 50 crores. Okay, so these are the companies which are prescribed, or if you are listed, then you must follow the provisions of rotation. That means you cannot continue with the same auditor for a longer tenure. If you are appointing an individual as the auditor, he can be appointed for maximum one term of 5 years. If firm, two terms of 5 years each. After completion, there has to be a cooling period again. And thereafter, cooling period of 5 years, thereafter they can be reappointed. And in that cooling period, you also have to keep something in mind that if there is an audit firm which has a common partner, then that audit firm is also disqualified. Okay. Members internally can resolve that, okay, fine, we will rotate within the firm. That is something which is possible. But again, the condition of firm will remain the same. Right? How the rotation is going to happen? In the same manner. If the tenure of an individual auditor has expired, then audit committee will recommend a name. The name will be recommended to board. Board will propose the name to members. Members will appoint. Okay, fine. If the casual vacancy arises in a government company, it will be filled by CAG within 30 days. If it is not, then by board. If it is a non-government company, then it is important to know the reason of casual vacancy. If the auditor has resigned, there might be some conflict with the management, and therefore he must have resigned. So it is important that you take the approval of members. So casual vacancy will be filled by the board within 30 days, but they has to be approved by the members within 3 months. But if it was for some other reason, maybe the auditor died, if the auditor has died, then the vacancy can be filled by the board within the time period specified, right? So it will be filled by board within 30 days, of course. Okay, so I think that's clear. Okay. Now, here also you can write within 30 days, not to be confused. Disqualifications of auditors, section 141(3), very important. A body corporate cannot be the auditor. Only an individual or LLP can be the auditor. Moreover, officer or employee can be the internal auditor but cannot be the statutory auditor. The partner or employee or of officer or employee of the company, they cannot be. Then comes your next point. Any person who, his relative, his partner, holds security in company, holding, subsidiary, associate, or subsidiary of holding, not eligible to be appointed as the auditor. However, relatives are allowed to hold security up to 1 lakh. Supposedly, relatives are holding security 1 lakh and it exceeds 1 lakh, then you are given a time period of 60 days to take the corrective action. And thereafter, the disqualification will be attracted if the corrective action is not taken even within the tenure of 60 days. Next, if they are indebted in excess of 5 lakhs to company, subsidiary, holding, associate, subsidiary of holding. If you have given guarantee or security of some third person to company, associate, subsidiary, holding, subsidiary of holding. Okay. If you have a business relationship with any of this plus subsidiary of associate also, or if you if there is a person whose relative is a director or is in employment as a director or KMP. Fine. Or if you have been convicted by an offense involving fraud and 10 years have not elapsed, or if you render the service which is prohibited, or if you exceed the ceiling limit of 20 companies which is given for any given auditor. So if any of the above disqualification attracts, vacation also attracts. That means immediately you have to vacate the office of director, and it amounts to casual vacancy which is going to be filled by the board or CAG as the case may be. Right? Okay. Now, removal of auditor before the term. Before annual general meeting, that is before annual general meeting, the board wants to remove the auditor. They can do it by passing BR, but they require CG's approval. So application within 30 days is made in the form ADT2 to central government, obtain their approval, and within 60 days thereafter pass special resolution at general meeting, and the auditor will be removed. He will be given an opportunity of being heard. If the auditor himself wants to resign, then they have to file ADT3 with company registrar and CAG if it was a government company within 30 days, indicating the reasons why you are resigning. There is also an option that NCLT can also remove an auditor in case of fraud. Okay. And you can also be removed at annual general meeting when a special notice is received specifically stating that we do not want to reappoint the retiring auditor. This special notice has to be received by eligible members. Who are eligible members? The ones who hold at least 1% of total voting power or 5 lakh paid up share capital. Now, they are the eligible members. Whenever AGM is going to take place, obviously you don't know that, so pre-hand you have to send, or if you have received the notice of AGM, you have to ensure that at least 14 days before AGM you send the special notice in which you are requesting to appoint some other person or expressly stating that this will not be reappointed. So whenever company receives such special notice, company sends a copy to the retiring auditor who is eligible to make representation to the members that we have. I have done so much for you all, and you are now removing me, or whatever they want to, right? And this representation will be circulated. If it cannot be circulated, it will be read out at the meeting. And auditor also has a right to make oral representation. But sometimes auditor tries to defame the company and tries to abuse this right. In such a case, any aggrieved person can apply to the tribunal, and tribunal, if satisfied, then the tribunal will say that, okay, fine, there is no need to make the representation. So the representation will neither be read out nor be circulated. Okay. As I told you, the tribunal also has the power to change the auditor. So if any person is concerned, they can make an application to tribunal. And if tribunal is satisfied that, okay, this auditor is doing some fraudulent manner, we also have NFRA now. NFRA constituted under section 132 of the Act, which is overseeing the quality of professionals. Right, apart from the body that we come from, that is our CA Institute, because only CAs are eligible to do statutory audit. So they also supervise us, and over and above, NFRA also supervises us. And if somebody makes a complaint, then NCLT also can remove us if we are involved in fraud. Okay. And then another auditor will be appointed. What do we do as an auditor? What is our duty? To make report, to make inquiries, to follow all the auditing standards, to exercise reasonable skill and care. And what is our right? Right to have all the books, right to receive notice, right to be informed, right to receive remuneration, right to make inquiries, and right to lien. I can retain the audit report if you don't pay my audit fees. So right of lien also. Then there are certain special types of audit of government company. CAG shall direct the manner, and the government company's audit will be done. CAG appoints the auditor, that we have read before also. Whoever auditor is appointed has to submit a copy of audit report to CAG. Okay, and within 60 days of the receipt of audit report, they can order supplementary audit or comment upon the audit report to supplement the audit report. That is something which is possible. Branch audit. See, if there is a branch also, the audit of branch can be done separately by some other auditor, which is very well possible. And that auditor will give his report, and the main auditor, the statutory auditor of the company, will compile it. Okay. So such branch auditor can report and give to company's auditor, or the company's auditor can also do that audit. Okay. Now, one important section over here is reporting of fraud. While doing the audit, if auditor comes to know that there has been a fraud in the company, it is the duty of the auditor to report the fraud. If the fraud is of lesser quantum, that is less than 1 crore, then you report it to board and audit committee, and they will disclose it in their board's report and take corrective actions. However, if the fraud is 1 crore or more, then you will immediately inform. Within 2 days, you will inform to board and audit committee and seek their reply. Once you receive their reply, then inform to central government also that this is the report, this is my finding of fraud, and this is the committee or the board's reply. If you don't receive their reply, then also you send the details to central government. So they are bound to reply within 45 days. But supposedly they do not reply, then also you send the details to central government. Section 144, if the auditor, if any person is the statutory auditor of the company, he cannot do internal audit, actuarial service, investment banking, other financial service, design the financial system, investment advisory, no, management service, no, accounting, bookkeeping, although a lot of CAs do that, but it's not permitted. If it is a company, if it's a proprietorship firm, there's no governing law as such. Others as may be prescribed. Now the last section, section 148, cost audit. Cost audit is not mandatory in all the cases. It is only mandatory for certain types of companies. Which types of companies? The companies maybe which are involved in manufacturing, so they have to maintain cost records. So the companies which are prescribed to maintain cost records also have to hire a cost accountant to do cost audit. They will prepare the report in CRA 3 within 180 days from close of financial year and give it to board, and board shall furnish it to central government with explanation. CG may ask for further information, right? Section 147, we have punishment if you contravene it. Section 146, section 145, all that is auditor's right plus duties, right? Okay. Okay. Revision of the complete chapter of directors, appointment and qualification of directors, containing section number 149 to 172. So we have a lot of sections along with the relevant rules, and we are going to revise the same now. Let's begin. First thing is, what do you mean by directors? See, directors are someone who are appointed to the board of the directors of the company. Directors do not have any power individually, they have collectively power, right? They have collective power, which is, you can say, the board of directors or the directors or the board. These all three terms are synonymously used, and they have the power. Why do we need directors? Because company is an artificial person and company cannot run on its own, so we need someone to direct the company. All the company directions cannot decisions, actions, directions, they cannot be done by the shareholders who are the investors of the company. Simple reason being because they are in huge number and everyone cannot be interfering in the management of the company. That's why we need directors to manage the company. So Companies Act has divided the whole powers of company into two authorities. One is the board of directors and other is shareholders. So at times we need permission from shareholders, and the day-to-day management is being handled by the board of directors. Section 149 mandates that every company must have board of directors. Section 149 tells us that minimum number of directors and maximum number of directors, what are they?
Minimum number of directors you need 1, 2 and 3. 1, 2 and 3. 1 for OPC, 2 for private and 3 for public. And maximum number of directors for all types of companies is 15. This 15 can be increased. That means a company may have even 20 directors provided it passes a special resolution in this regard. So by passing SR, the maximum number of directors can be increased by any company, right? This particular requirement does not apply to Section 8 company as well as government company, not applicable to government and Section 8 company, right? That means if a Section 8 company wants to have 20 directors, it can have without even passing special resolution, So minimum 1, 2 and 3, maximum 15, which can be increased. Now, that was the first proviso. This was the first proviso. It can be increased by passing SR. Second proviso to Section 149(1). So we are talking about one subsection and its second proviso, which is very important. That's why you must learn this. Second proviso to Section 149(1). Now, what does it mean and what does it talk about? It talks about woman director. Every company needs a woman director, ma'am? No. If it is a private company, there are 2 directors just, out of which one should be woman. This will be harsh on the directors, harsh on the companies. So this is not the requirement which has been imposed by the Act. What has been imposed is that certain set of companies need at least one woman director. You are such a huge company, you have so many board of directors, out of which at least one director can be a woman director. So this is the mandatory requirement which is imposed on listed company, and listed company means listed public company only pursuant to the definition, pursuant to amendment in Section 2 Clause 52 definition of listed company, which I'm not discussing here again right now. And if it is other type of public company, then it has to satisfy either of the 2 criteria. Paid up capital more than or equal to 100 crores or turnover more than or equal to 300 crores. Fine. So if it's a listed company, one woman director must. If it is an unlisted public company, if you come under these 2 categories, any of these 2 categories, then you must have one woman director. Fine, ma'am. Now, if it is a new company, newly incorporated company, and it's paid up capital, the turnover will not be, you will not be able to get to know turnover within 6 months of incorporation undoubtedly, but yes, the paid up capital and the listed criteria it may meet. So the whole intention is that the company pre-hand knows that I have this requirement of woman director, and so it has to appoint woman director within 6 months of incorporation. Otherwise, we don't have any specific clarification or law given as to if the threshold increases by when woman director should be appointed, right? All the directors are being appointed in general meeting, and so this woman director will also be appointed. If we look at the financials, and if we find the financials, yes, it is crossing the threshold, thereafter this will be appointed. But what if it is a listed company and a woman director was appointed for a tenure of 5 years, but before that only the woman director died? This gives rise to intermittent vacancy, because if it is not filled, it has to be filled. Because if the woman director has died, there is no woman director and it is non-compliance of law, so it must be filled. Who has the power to fill it? The board has been conferred the power to fill it. By when? Immediate next board meeting or 3 months, whichever is later. So intermittent vacancy has to be filled within this particular time limit. Okay, within this particular time limit. Now, Section 149(3), resident director. This is for all types of companies. Even if you are a private company, you are a public company, or a one-person company, you need at least a resident director. Who is a resident director? Someone who stays in India. For how long? For more than or equal to 182 days in previous financial year. More than or equal to, that means if a person stays for even 182 days, he will be called as a resident. He will be called as a resident. So a director who is also a resident of India is known as resident director, and every company must have at least one resident director. Fine. Every company must have at least one resident director. Now, basically, if you try to recall, there are two types of directors. One are executive directors and one are non-executive directors. Executive directors who are in the whole time employment of the company, non-executive directors who are not in the employment of the company, that is independent director or part-time director. And executive directors, we have example managing director, whole-time director, right? Ma'am, women director have to be appointed as executive or non-executive. It can be appointed either ways. It's not a requirement that they have to be appointed as executive only. No, even if an independent director on the board of a company is a woman, it is sufficient compliance for second proviso of section 149(1). Okay. Likewise, ma'am, the resident director, has it to be executive only? No. Again, no such requirement has been given. So it can be executive, it can be non-executive, that does not matter. But every company must have at least one resident director. Okay. I hope that is clear. Fine, ma'am. So we know the requirement of directors. Now, how do we appoint directors? See, section 149 is not over yet. It has a huge part of independent director, which we will do a little later. Why? Because I teach you in that manner only in the regular class as well, right? So we will revise it also in the same manner. Now we are talking about the appointment of directors. How the directors are going to be appointed. See, the directors are to be appointed by members, by shareholders in general meeting. That is what section 152 tells us, right? However, in certain cases it can be appointed by the board of directors also. It can be appointed by NCLT also, and it can be appointed otherwise also. So we will discuss how can we appoint the directors. Section 152 gives us three things. How first directors are going to be appointed, the requirements of being a director, and the rotation of directors. So it has three concepts involved in it. Fine, ma'am. Who can become a director? An individual. A company cannot become a director. An individual who is holding in, who is not disqualified, who has given his consent, right? And who has furnished MBB1, right? So such a person can be appointed as the director of the company. Fine. Supposedly I fulfill all this criteria. What are the methods? How can I be appointed as a director in the company? The appointment of first directors is given in section 152. The appointment of subsequent directors is given in section 160, and the appointment of retiring directors is given in again section 152. So that's how the appointment is spread over different sections. Okay, ma'am. So every director who has to be appointed to the board of the company must have DIN. What is DIN? It is an identification number which defines who you are, right? So anyone who wants to become a director in a company must have DIN, director's identification number. Without DIN, you cannot be appointed as a director in the company. So you must have DIN. How do you get it? There are two sources of obtaining DIN, DIR 3 and SPICE Plus. We'll read about this later. Okay, fine, ma'am. So you obtain DIN, you give this DIN, and you give a declaration that you're not disqualified, DIR 8. You give your consent, DIR 12, to the company. The company in turns file form DIR 12 for your appointment within 30 days of appointment, right? Section 170 mandates the requirement of filing return, DIR 12, for appointment and wherever there is change in the appointment or change in the directorship or KMP. Okay, fine, ma'am. So anyone who is an individual, anyone who has DIN, anyone who is not disqualified, anyone who gives the consent can be appointed as the director in general meeting by the shareholders unless otherwise provided in the act. So something else can also be provided in the act. In that case, that will apply, but otherwise this is going to be the appointment. However, for the first directors, we cannot wait till general meeting because we are in a hurry. We need directors immediately when the incorporation happens, right? Because we cannot, for one day also, who will manage the company? To call general meeting, who will call the general meeting? So we need directors as and when the incorporation takes place, and that's why the first directors of the company, the appointment cannot be deferred. We need immediate appointment of the same. So what is given? According to section number 152, the names should be mentioned in the articles of association. So the articles of association are going to clearly specify that these will be the first directors of the company. Supposedly the articles of association don't specify. They will specify the manner. How will they be appointed? Supposedly they don't even specify that. So we will check whether table F can be applied or not. If we have specifically striked out table F that it shall not apply, then it shall not apply. Otherwise, it will be applicable if our articles are silent. What is table F? Table F is the model articles of association for a company limited by shares. So if our articles give the name Mr. X and Y will be the first directors, they will be. If it has given the manner, they will be elected in such a manner, elect in that manner. If first 2 points are not applicable, table F will apply. What does table F tell us? Table F tell us that it will be decided by the subscribers. It will be decided by the subscribers, whoever has subscribed to the memorandum. Supposedly, no name is given in articles. We don't say provide the manner, and we say that the table F shall not apply. In that case, the individual subscribers become the first directors of the company. See, the subscribers may be individual, they may not be individual. A company can become the member of another company, right? So maybe on the memorandum of association of that company, a company has signed, right? A company's common seal is affixed or their representatives have signed. Quite possible. A company cannot become the director for another company. Only individuals can become the director, because again, company will be an artificial person. So all the individual subscribers become the first directors of the company. Okay, fine, ma'am. First directors are going to hold office till the ensuing general meeting, and after that they can be reappointed or they may leave. If they want to be appointed again, they have to give their candidature. Because for appointment in general meeting, how appointment at general meeting is going to happen? When you give your candidature under section 160, your name is proposed, and general meeting, the shareholders pass OR and appoint you as a director. So now that is going to happen. That is going to happen. Fine, ma'am. And after that, you can be appointed as rotational director or non-rotational director in case you are a director of a public company. If you are a director of a private company, you can be permanent directors also, that's not a problem. But if we are talking about the directorship of public companies, then you can be appointed either as rotational director or as non-rotational director. Fine, ma'am. Now, before I move to this particular part, DIR 2, that is the consent part, it is not required in case of not-for-profit organizations, that is not-for-profit companies, as well as for government companies. So they have this exemption from filing DIR 2. Okay. Now, if we are talking about a public company, from the total number of directors, minus your independent directors. Supposedly, a company has total 14 directors and 5 are independent directors, 9 are left. Out of this 9, 2 by 3, 2/3 of 9, that is equal to 6, will be rotational directors. And out of the 6, 1 by 3, that is equal to 2, will be retiring. Will retire at every annual general meeting, right? So, whatever is your total number of directors in a public company, its 2/3 have to be, at least it's 2/3 have to be rotational director, whose office is going to be determined by rotation, right? Out of this 2/3, 1/3 is going to retire at every annual general meeting, right? So here in this case, as on our example, 2 directors will retire at every annual general meeting. How they will retire? The person who has been in the office for the longest will retire first. Supposedly 2 people have been appointed on the same day. They will mutually decide who is going to retire in this general meeting. If they cannot decide, then some lots will be drawn. And they will decide. Okay, they will decide. Fine. Supposedly they have to retire at general meeting. That means they will go. They can come back also, but the chances are they will go also, right? So they can go, they can come back. Supposedly the directors did not call general meeting. Can they continue? They cannot. If AGM is not held, they will have to vacate the office on the last day. AGM ought to have been held. If AGM is held, then the 2 directors, that is 1/3 of the rotational directors, will retire. They can be reappointed, or in their place someone else can be appointed, or the company may resolve that they don't want to fill the vacancy. Either of the three will happen. Supposedly none of the resolution is passed, then the AGM will be adjourned. It will not be conclusion of AGM will be adjourned. When AGM is adjourned and the vacancy is not even filled at the adjourned AGM, it amounts to automatic reappointment of the retiring director. That means he will be automatically reappointed. But there are certain cases of exception where he will not be treated as reappointed. Supposedly Mr. X is retiring and Mr. X has clearly said that I don't want to be reappointed. So he has expressed his unwillingness in writing that he doesn't want to be reappointed. We cannot reappoint him. Supposedly he is disqualified. He has become of unsound mind. How can we appoint him? Specifically in the act is written that we need OR or SR for his appointment. We cannot appoint him. There is contravention of section 162. When Mr. X was appointed, his appointment was only void. That means he was appointed through a single resolution, wherein appointment was needed by a separate resolution. 2 appointments were made by a single resolution. So it amounted to contravention of section 162. Now since your appointment itself was void, you cannot be reappointed. And we tried for your reappointment. So we proposed a resolution in front of the members to reappoint you, but this resolution was lost. That means our members do not want you to be reappointed. So no automatic reappointment will apply to you. Okay, fine, ma'am. Now there is one more point over here. What does it tell us? See, some public companies may say that no, we want a transparent vision in our company, and we want all our directors to retire at every AGM. So all the directors retire, someone who's good comes back, and the others leave the company. Companies Act tells if you have such strict provisions, way more stricter than what law says, great, follow them. So if your articles say that all the directors are going to retire at annual general meeting, so be it, right? But if they don't say it, then this is something that you are going to follow. Right? So section 152(6) tells us about rotation, and section 152(7) tells us how the vacancy will be filled pursuant to this retirement of rotational directors. Ma'am, what if they don't follow? If they don't follow these provisions, we have a section 159, which gives us the penalty. Section 159 tells us that if you contravene section 152, this penalty will be attracted. So the penalty is not given in section 152, rather it's given in section 159. The rotation part does not apply to unlisted government company or its subsidiary. Fine. Okay, ma'am. Section 160. Section 160. What is it? It is a section for new candidates. That means, see, who will be the first directors? They will either be the subscribers or they will be someone who is known to the board. Supposedly, I am incorporating a company and I know an efficient person. I will take his consent and I'll write his name as the first director. So I know that person knows me. That's why he could be the director. But section 160 gives a chance to anyone. If you want to be the director, you can propose your candidature. You can propose your candidature. So anyone can propose candidature. Just to screen out or just to have those serious applications, there is a deposit. A refundable deposit of 1 lakh. It's not refundable in all cases, but it's refundable in these two cases. So what you have to do is, if I am a member and I want to become a director of my company, or if I am not a member, or if I know someone, I can propose his candidature also. So we propose someone's candidature. How do we propose candidature? We give it to the company. We say that we want this particular person to be appointed as a director in the upcoming general meeting. What you have to do is, you have to give a 14 days notice to the company. That means whenever company is going to hold its general meeting, 14 days prior to that, you must give that notice, plus 1 lakh rupee deposit. Now this deposit will be refunded if the person is elected as a director, or even if he is not elected but his votes are 25%, more than 25% of the total votes which have been cast, it shows that he was a serious and eligible candidate. So in this case also the refund is made. Fine. So you serve this notice to the registered office of the company. What does company do? Company sends this notice of candidature at least 7 days before general meeting to all the members. It can be done by sending individual notices or a public advertisement in 2 newspapers, English and vernacular. And it also has to be placed at the website of the company. Fine. So all the members receive this notice that someone has been proposed to be a director. At the annual general meeting, simply by passing ordinary resolution, they can appoint the director, or if the resolution is not passed, the person will not be appointed. The section does not apply to a private company, because in private company, not everyone gets the power that they can nominate themselves. No. It does not even apply to a 100% government company, wholly owned subsidiary of such 100% government company, and Section 8 company where election is happening by ballot system. Right? Okay, fine, ma'am. In certain cases, you don't need deposit. Why? Or in what cases? In case of independent director. If independent director is proposing his own candidature, independent directors are someone who are anyway highly knowledgeable, highly professional, highly qualified people. You cannot doubt and you cannot say this is not a serious application. Of course, it's damn serious. So they don't need deposits. Moreover, if a person is recommended by board or NRC, probably they are the people who have much knowledge, and if they are recommending someone, he is a deserving candidate only, right? So in this case, you don't need a 1 lakh deposit. Now, supposedly, someone who has retired, a person was appointed as a rotational director in a public company and he retires according to section 152(6). Now, he wants to be reappointed. The question is, do we need to send the notice and 1 lakh deposit under section 160 for his appointment? Answer is no. Section 160 does not apply for the case of reappointment of retiring director. It clearly says that a person who is not a retiring director in terms of section 152 shall also be eligible to be appointed as the director if he gives a notice plus 1 lakh deposit to the company at the registered office, etc., etc. So that's how the process begins. Fine. Okay, ma'am. Now, we know that individuals who are holding DIN and who are not disqualified can be appointed as the director. So the next question comes out is, what is DIN? DIN, Director's Identification Number. How do you obtain DIN? How do you get DIN? DIN can be obtained in two ways. See, the provisions of DIN are covered in section 153 to section 159. 159 is that last penalty part. Any individual who wants to be appointed as a director, you cannot be appointed unless you have DIN. How do you obtain DIN? You can file an application in DIR 3 with these attachments. There is also an option that Spice Plus. Supposedly, I'm forming a new company and I have never been a director of any company. So what choice I have is in Spice Plus only I can fill my details, and it is going to work as an integrated form and will also provide me DIN apart from incorporation of the company. Right, so this is also a method of obtaining DIN. Otherwise, the general form and the regular form that we have for DIN is DIR 3. Now, just like you can obtain PAN as and when you need, you cannot obtain DIN as and when you need. For DIN, what is required is that you must be a director of some company. Ma'am, how can we become the director without DIN? You must be proposed to be a director of some company, and only then you can obtain for DIN. That means government needs to know that where do you want to be appointed as a director, and then only they will give you DIN. Why? Because in attachments there is a need for board resolution. So the company which is proposing you to be appointed as a director will give a resolution, and then only you can submit this application. Once your application is submitted, central government examines your application. Central government examines your application. Just a second. Central government, if they find that your application is not defective, then what are they going to do? They are going to allot you the DIN. But if they find that yes, your application is defective, then they are going to intimate you via mail or via website, and you have to rectify the defect within 15 days. So you get a chance to rectify the defect within 15 days. Supposedly the defect is rectified, then again you can be allotted DIN, and if you do not rectify the DIN, then it has to be rejected. Right, so the application will be rejected. Now, whatever DIN you have obtained is going to stay with you for your life. No matter in which company you become a director. You become a director in XYZ, PQR, X Limited, Y Limited, doesn't matter. One DIN for all the companies and one DIN for your life. It's not going to change. It's never going to change. Fine. Okay, ma'am. Only one DIN is allowed for every individual. Just like you cannot have a duplicate PAN, you cannot have a duplicate Aadhaar, likewise you also cannot have a duplicate DIN. Okay, so first thing, you make an application for DIN in DIR 3. Second thing, central government allots you the DIN when they find the application is in order. Third thing, you're prohibited to obtain more than one DIN. Okay, whatever DIN you obtain, supposedly, if now you want to become the director of any company, you cannot become without DIN. But for the directors who were already directors, before these rules came into picture, before this concept of DIN came, they were already directors. Now they are also being given a time limit that they have 1 month from the receipt of DIN. They have to inform central government. Okay, they have to inform the companies. And the company in turn will inform the ROC. So existing director has to intimate into the company and the company to ROC. That is section 156 and 157. Okay, fine. This is clear. Now, any director, if you have DIN, wherever you are quoting that you are the director of ABC Limited or whatever like that, you must state your DIN. Your name is not sufficient. To identify you, we need that DIN. Just like we quote membership number wherever we are doing that, right? CS membership number, CMA membership number, CA membership number, we quote that, right? That is important. So likewise, directors also have to quote their DIN. Okay, fine, ma'am. Now tell me, ma'am, something that can we surrender our DIN once we have obtained the DIN? Can we surrender the DIN? The answer is no. You cannot surrender the DIN just like that. Supposedly, I have worked as a director in a company, I have done enough fraud, and now I simply surrender my DIN and I go away, and now I take another DIN and I become the director of some other company. So whatever frauds I'm doing, I'm never traceable. Can I do that? The answer is no. The answer is no. But supposedly I have unused DIN. Unused DIN. That means, ma'am, how can that be the case? I was being proposed to be appointed as a director in some company, and that's why I made an application in DIR 3 to obtain DIN. I obtained DIN, but in this company OR was not passed for my appointment, and so I could not be appointed. And thereafter I have not been appointed in any company as a director, but I have DIN. I know that I'm not going to use this DIN, so I want to surrender this DIN. Can I? Yes, you can. If you have unused DIN, you can surrender that DIN to the government, and the government is going to deactivate your DIN, right? Otherwise we don't get this power. Then what happens, ma'am? RD or central government can cancel or deactivate our DIN. When? If we have duplicate DIN. If our DIN is being obtained in some wrongful manner, that means we have given some misinformation and we have got DIN, or we have got DIN with the intention to deceive someone. In both cases, our DIN can be cancelled. If we die, if we turn out to be of unsound mind, if we turn out to be insolvent, if we surrender our DIN, or if we fail to do KYC. If we fail to do KYC, that can also lead to deactivation of DIN. What is KYC? What is KYC? We have a rule 12A. Earlier you had to read a lot about KYC, not now. What is KYC? Know your customer, right? So know your director. Basically, it is an annual e-verification. Whenever you become a director of some company, every individual who holds DIN, no matter you are a director or you're not a director, you are holding DIN, you have to file this form DIR 3 KYC. And every financial year there has to be a simple verification DIR 3 KYC web through that, right? So all your records are available. It is an online facility. You just approve the same. Why? Because the government records cannot be updated. We're talking about directors. We're talking about the corporate world. The records cannot be old, right? So they have to be updated from time to time, and the responsibility is being conferred on the person holding DIN. If you have DIN, it's your duty to do that. If you don't go for annual e-verification, your DIN will be deactivated. Fine. Okay, ma'am. We also have another rule, Rule 12, which talks about the changes in DIN. So whenever there is any change, not in DIN exactly, in our details, maybe my address has changed. So it is my duty that I intimate the company within 15 days. Moreover, I file DIR 6. I attach the proof of change. It is verified. That is the DSC of CA, CS, CMA is attached. I submit the form for verification. Central government incorporates all the changes and informs ROC also. Ma'am, why this is happening? Why don't we directly file the form to ROC? See, you are doing an online filing only. So you are filing this DIR 6 also on MCA website, but it goes to the central government and not to the ROC. Why? Supposedly, I am a director in a company of Kolkata, Mumbai, Delhi, Karnataka. So I am a director of 4 companies in 4 different states. To which ROC it will go? So the DIN cell intimates it to the concerned ROCs. Fine, ma'am. Number of directorships. What do you mean by this? Supposedly, I am an eligible person, I have DIN, and I want to become a director in 50 companies. Can I? Why not? 50 companies. If you have that caliber, why not? Well, this is not like eating a donut eating competition or a puchka eating competition or something like that. Uh, it is becoming a director in companies, which requires time, effort, energy, efficiency, everything. And the government itself has given a very generous limit of 20, out of which 10 can be public companies. So if you are a director in 20 companies, you should know that you are highly efficient, like Rajnikant or something, right? You cannot be holding 20 directorships in active companies just like that, right? So we have a limit. What is the limit? Maximum number of directorships in all companies, 20. So I can be a director in maximum 20 companies. But this does not include section 8 or dormant company, but includes alternate directorship, out of which maximum 10 public company directorships I can hold, right? So if I am a director in 20 companies, and I have 9 public companies and 11 private companies, this is something which is allowed. But 11 public companies and 9 private companies, it is something which is not allowed. Now, when I am computing which is the public company directorship, I have to make sure that I include this also. What is it, ma'am? Private company. Private company which is either a holding to some public company or it is a subsidiary to some public company. This is going to be treated as public company. This is going to be treated as public company for the purpose of, for the section 165, for computing this limit. Okay. Now, supposedly before commencement, there was a person who was a director in 50 companies and there was nothing rule like this. There was no provision like this. When this provision came into picture, he has been given a time period of 1 year, that you choose in which companies you want to stay as a director, and the rest of the companies you have to leave. So you resign in the rest of the companies and you intimate your choices to ROC. Okay, fine, ma'am. But after commencement of act, this is going to be the maximum number of directorships. Now, some companies, they do it that if you want to be the director of my company, you cannot hold more than 10 directorships. Ma'am, can the companies do so? Yes. By passing SR, you can have strict provisions in this regard. So you can reduce the maximum number of directorships. You cannot increase it. You can reduce the maximum number of directorships. Fine. So that was section number 165. Section 164. This talks about the disqualification. See, this section is divided into 3 parts. Part number 1, that is section 164(1), which talks about 9 grounds of disqualification. If any of the ground of disqualification is attracted to the person, he is disqualified to be appointed in any company as a director. Okay, ma'am. And supposedly, after his appointment, some ground of disqualification is attracted to him, then he has to vacate office according to section 167 of the Act. So we have 2 different sections. One is for disqualification and other is for vacation, but they go hand in hand undoubtedly. Okay, fine, ma'am. Section 164(2) also talks about 2 grounds of disqualification, but these disqualifications are attracted to the individual because the company in which they are holding directorship has done some default. These disqualifications are attracted to an individual. These disqualifications are attracted to a director. If you are not a director of any company, there is no point of this particular subsection. And Section 164(3) talks about additional grounds of disqualification. That is, a private company has been given the power that you can provide additional grounds of disqualification also. Okay, ma'am. Let's read them one by one. First of all, the 9 grounds of disqualification that have been given in section number 164(1). First is unsound mind. It doesn't matter whether I consider myself of unsound mind or not. It is that I have to be declared by the court. Undischarged insolvent. The court has declared you as insolvent, but you have not been discharged yet. So in that period, you are undischarged insolvent. Third, if you have applied for insolvency, but you have not been declared by the court as insolvent or not solvent or solvent, whatever, that means your application is not disposed of yet. You have applied. So during that tenure also, disqualification is attracted to you. Next, if you have been convicted by court, that means you have been found guilty by the court. See, you have done some offense. The offense is moral turpitude or otherwise. You have been found guilty by the court. The court has given you a sentence of imprisonment. The imprisonment is 6 months or more. Imprisonment is 6 months or more. Then you are disqualified for 5 years. Okay. See, if your imprisonment is less than 6 months, you are not disqualified even for a single day. If your imprisonment is 6 months or more, you are disqualified for 5 years. But supposedly the imprisonment is 7 years or more. 7 years or more. Then you are disqualified for life. You can never be appointed as a director in any company. Any company, any time in the future, you cannot be appointed. Fine. Whatever disqualification we are checking is, of course, at the time of appointment of director. So whenever you want to appoint, you check whether the person is of unsound mind, discharged, insolvent, is his application pending, has this disqualification attracted to him. For 5 years, he will be disqualified. 5 years from the date of, not court's order, but from the date of expiry of his sentence. So when he has completed his tenure of imprisonment of 1 year, 6 months, 2 years, whatever it is, after that 5 years, he has been disqualified. After that 5 years, he will be disqualified. Next, court's order. If the court has given you an order that you are disqualified, you are disqualified, simple. Unpaid call till 6 months. Now this is for shareholders. See, a director may be a shareholder, he may not be a shareholder. It's not imperative that he has to be a shareholder only. If he is a shareholder, or if a shareholder wants to become a director, then he has to check this disqualification also. I am a shareholder of the company. The share price of the price of one share is equal to rupee 10. Out of which 6 I have paid to the company, 4 is unpaid. The company calls for this rupee 4 and I fail to repay it. I fail to pay it. Now imagine appointing someone like me as a director who cannot pay her own call money. You think I have the capability to collect other people's call money, to be responsible for the compliances? No, this shows my responsibility, how irresponsible I am. Right? But this irresponsibility cannot be checked at the immediate moment, right? So we have been given a time period of 6 months. 6 months, right? So during the 6 months, if I pay, the disqualification is not attracted to me. The disqualification gets attracted to me when the tenure of, or when the period of 6 months has elapsed from the last day fixed for payment. Okay, then I am disqualified, and this particular disqualification attracts only for company in which call money has not been paid. In which call money has not been paid, and not in other companies. So in other companies, I am qualified to become a director. Only in this company, I cannot become a director. Now, supposedly you are already a director. So I vacate the directorship according to section 167 and I cannot be reappointed. Reappointed till when? Till I pay this call. Offense under section 188, related party transactions offense. So if I have been found guilty for this offense, I cannot be appointed till when? Preceding 5 years. So we check for preceding 5 years. If preceding 5 years this offense is existing, I cannot be appointed. If in preceding 5 years this offense is not existing, I can be appointed. He has not been allotted DIN. Without DIN, you cannot be a director. And if your directorship limit is exceeding 20, you cannot be a director undoubtedly. So on all these 9 grounds, you are disqualified. You cannot be appointed as a director. You cannot be appointed as a director. Fine, ma'am. Then we come to section 164(2). From examination point of view, this is very important, but although it's very small one. Supposedly, I'm a director in some company, and that company fails to file its financial statements or annual return for a continuous period of 3 years. Or it does not pay its deposits, debentures or dividend. They remain unpaid for 1 year or more. Either of the two situation gets attracted, the company becomes a defaulting company. And if I am the director of the defaulting company, I become disqualified. That means if I want to be appointed in some other company, I cannot be appointed. I cannot be appointed. And ma'am, you have to vacate office also from this company? No. This is the catch over here. Not from this company. Not from this company. See, vacation has 8 grounds. If a director is disqualified under any of the ground of section 164(1), he vacates the office. If you are disqualified under section 164(2), then also you vacate the office, but not from the defaulting company. That means if a person is a director in 4 companies, A Limited, B Limited, C Limited, D Limited, and A Limited has not filed its financial statements, the directors of A Limited are disqualified. They cannot be appointed in any other company. And whoever is the director of A Limited is also a director of B, C, D, you have to vacate office, but in A Limited you will continue the office. Right? Because you are responsible for all this. Okay, fine, ma'am. Now, supposedly there is a new director who joins, and before he could actually analyze what's happening in the company, this default gets attracted. And when the default gets attracted, all the directors of the defaulting company, they become disqualified. So Mr. X cannot be appointed in any other company. Oh, very unfair, right? So this disqualification does not apply for 6 months from the date of appointment. So a new director gets the benefit, he gets the time to, he can rectify the defaults, whatever is going on in the company. So he gets a benefit of 6 months. Okay, fine, clear? For this, you also have to give a declaration, the IR 8, that I have told you a number of times. Now, vacation. Grounds of vacation, section 167. First 2 grounds I have already told you. Third is, if the director is absent in all board meetings during 12 months, see, not in the financial year, not in the calendar year, we check for any 12 months, any 12 consecutive months. So, the director skips the first board meeting, from there we check for a tenure of 12 months. If he does not attend any board meeting, doesn't matter how many board meetings are held during that particular time, if he does not attend any board meeting, he has to vacate the office. He vacates the office, can he come back? Why not? Because this is not a ground of disqualification. So when we want to reappoint him, when we want to appoint him again, we check the grounds of disqualification. We don't check the grounds of vacation. So again, he can start. These 2 grounds both relate to one section, section 184. What is section 184? It talks about interested contracts. A director may be interested in some contract. If he is interested, he must disclose it pre-hand to the board of the directors. So he has to disclose it. Moreover, if he is interested, he will stay away from that particular contract. He will not participate in that board meeting. He will not vote, etc., etc. So there are two requirements on part of the director that he has to do. So if you fail to disclose your interest, or if you participate in that meeting of interested contract, both are an offence under section 184. And if you contravene these two, you have to vacate office of director. You have to vacate office of director. Okay, ma'am. Next is if you are disqualified by court. If you are disqualified by court, it is included in this. So you vacate office. If you have done an offence, imprisonment 6 months or more, disqualified, included in this, vacate office. Why? Given separately. Because in such situation, the vacation of office is postponed till disposal of appeal. See, whenever anyone passes a court order against us, we get a time period. What time period? We get certain time period to file an appeal. This is our right. So if court has said that you have done an offence and you are being sentenced to imprisonment for 1 year, this is my fundamental right, I can appeal. And when I appeal, will this disqualification be attracted to me? Do I need to vacate office? What is going to happen? So I have made a beautiful chart for that. Let's discuss this. Order of court. So we have a court order and the court order finds us guilty. I have two choices. I can either file an appeal or I don't file an appeal. If I don't file an appeal, I get a chance to file an appeal within 30 days. If I don't file an appeal, on the 31st day, I vacate. If I file the appeal within 30 days, then I will not vacate office till this appeal is disposed of. See, if the court has declared me as guilty, I am disqualified, I cannot be appointed in any other company, but the directorship that I am holding is going to be delayed if I file the appeal. So I don't have to vacate immediately. I will vacate when the appeal gives its order. Okay, so next court order I receive, I'm not guilty, I don't vacate. And if I am guilty, I again get a chance to file an appeal within 7 days. If I file the appeal within 7 days, if I don't file the appeal within 7 days, I vacate on the expiry of 7th day. But if I file the appeal, again I will not vacate the office till this appeal is disposed of. And after this, I don't have a chance for further appeal. So if I'm guilty, I have to vacate. If I'm not guilty, I'll not vacate. Okay. So that's why these 2 points are given separately. Then, if I am removed in pursuance of the provisions of the Act, Section 169 gives the power to shareholders that they can, by passing ordinary resolution, remove the director. So, if a director is going to be removed, he has to vacate the office undoubtedly. And moreover, if he is appointed by virtue of holding office, if he is the CEO of a subsidiary company, and he has been appointed as MD because he is the CEO. If he ceases to be CEO, he will cease to be MD also. Simple. There can be a situation that all the directors have vacated the office. Now, the company again cannot run on its own. So, we need the directors. Where will we go? We will go to the promoters. The promoters will appoint the directors. In their absence, we will go to the central government, and central government will appoint the directors. They will hold office till the general meeting, and in general meeting we will the regular directors can be appointed, or these directors can only be regularized, right? Just like a private company has the power to provide additional grounds of disqualification, it also has the power to provide additional grounds of vacation also. Okay, fine, ma'am. Now, Section 161, a very important section. Even from examination point of view, it is divided into 4 parts and you have to remember all 4 subsections. Section 161(1), additional directors. 161(2), alternate directors. 161(3), nominee directors, and 161(4), casual vacancy. 161(1), additional directors. Who are additional directors? Anyone. See, if you appoint first directors, if you appoint the directors in general meeting, if you appoint additional, alternate, casual vacancy, whatever type of director you appoint, if you appoint nominee director, if it is appointed by NCLT, whatever it be, one thing is must, or the basic requirements are must. Such person must have DIN, such person must give consent, such person must not be disqualified, and these are basic requirements. Okay, so even when you are appointing someone as additional director, you have to ensure these things. General rule given in section 152 is that the directors will be appointed by the shareholders in general meeting. This is an exception to that. So section 161 here, the appointment is not happening by the shareholders in general meeting, it's happening by the board of directors, right? So the board of directors are appointing here. For additional director, the board of directors can appoint by passing BR, provided they have an authorization in AOA. If AOA is silent, table F can also authorize. Okay, ma'am. So if the board has authorization, they can appoint someone as additional director by passing board resolution. Now this additional director is going to hold office till AGM only. Supposedly AGM is not held, last date on which AGM should have been held. Okay. Supposedly Mr. X, he was proposed in the general meeting and he could not be appointed because his resolution was lost. Now he approached the board of directors and they appointed him as additional director. This is something which is not allowed. Someone who has been rejected by the members cannot be appointed by the board. So a person other than someone who failed to be appointed at general meeting can be appointed as additional director. Alternate director. Alternate director. If a director goes out of India for 3 months or more, right, the board has the power. From where do they get the power? They get the power from either articles of association or through ordinary resolution in general meeting. So if they have this power, they can fill the vacancy of that director by appointing someone else. How? Simply by passing ordinary resolution. Now, he is a replacement. Although you have to understand that alternate director is not a proxy of the original director, he is not the agent of the original director, he is having a separate terms of employment with the company, but it is just that he is appointed to fill that vacancy. So if the original director returns, he vacates. If the term of original director expires, he vacates. So he cannot hold office beyond that particular period. Moreover, a person who is going to be appointed as an alternate director has to be someone who is not already a director of the company, and one person cannot hold alternate directorship for more than 1%, right? Alternate director is not an agent of the original director. It has its own duties and own liabilities. Okay, ma'am. Section 161(3), nominee director. See, okay, before that, one more point for alternate director. Supposedly, alternate director is a retiring director. He is a rotational director. And he has to retire at annual general meeting. So he retires. At annual general meeting, there was no ordinary resolution was passed for his reappointment or appointing someone else or resolving not to fill the vacancy. So AGM was adjourned. At adjourned AGM also none such resolution was passed. So it leads to automatic reappointment of retiring director. Now this retiring director is out of India and we have in its place an alternate director. So who will be reappointed? Alternate director or original director out of India? Original director out of India. So the reappointment is not automatic. Reappointment does not happen for alternate director. It happens for original director. Okay, ma'am. Now, nominee director. Nominee director. For alternate directors, you have to remember all those basic points, that it does not matter whether the original director is going to out of India for whatever purpose. So the purpose is not important. When he comes back, he has to vacate, right? So all these minute points also we have to remember. And now fine, nominee director. Nominee director, section 161(3). See, the board, if he gets the board gets a nomination, that means supposedly the company has taken loan from a financial institution and they have an agreement that we are going to give you loan only if you allow one person who we are going to nominate to be a part of your board of directors. So financial institution is nominating a person and the board has to appoint that person as a nominee director on their board. Likewise, it can be nominated by central government if they have a shareholding, of course, in a government company. So that is a situation, and it can also be in pursuance of some law. So if the law states or mandates, that is also going to be nominated. So whenever financial institution or other institution or government, they nominate a person by virtue of their shareholding, by virtue of law, or by virtue of an agreement, the board, by passing board resolution, appoints such person as a nominee director, subject to articles. Clear? Fine, ma'am. Then we have casual vacancy. Casual vacancy is not like intermittent vacancy. The director who has been appointed by the shareholders in general meeting, it is for the director appointed in general meeting and not for the director appointed by board or any other manner. It is for the director appointed in general meeting only. Supposedly his office ends otherwise than in normal course. He was appointed for a tenure of 5 years, but before 5 years only, after the expiry of 2 years, he dies. This is a casual vacancy. This is not intermittent vacancy. Why? Because in intermittent vacancy, it is imperative. It must be filled. Otherwise, it will lead to non-compliance of law. Here, a director has died. It is not non-compliance of law, right? So it may be filled by the board. It may not be filled by the board. Okay. So this is known as casual vacancy. If board has power through articles, it can fill this vacancy. How? By passing a resolution at board meeting. Now, it is a casual vacancy. For 2 years he worked and for remaining 3 years he could not work. So his vacancy is for 3 years only. This is casual vacancy. So whoever fills this position is going to hold office only up to the date which director in whose place he is appointed would have held had he not vacated. That means this particular date. So anyone who is filling the vacancy, casual vacancy, is not going to hold office beyond this tenure, beyond this date. Beyond this date, he cannot hold office. He cannot hold office beyond this particular date. Is that okay? Is that fine? Okay. Now, there is one more requirement in case of casual vacancy, because he is going to hold office for a very long tenure. Say for 3 years, 4 years, 5 years, it could be anything, right? For the remaining tenure, it also needs approval from members. So although board has the power to appoint anyone wherever casual vacancy arises just by passing board resolution, they have to seek subsequent approval from the members also by passing OR in whichever next general meeting comes. Okay? Clear? Fine, ma'am. Now, section 162. Appointment of directors to be voted individually. This section applies not to a private company. It does not apply to a private company. What does this section tells us? It tells us that appointment of a director, two or more directors, appointment of two directors or more directors cannot happen by a single resolution. I cannot say that I propose to appoint or resolve that Mr. X and Y be hereby appointed. The members are being deprived of the freedom of choice over here, because either they have to appoint X and Y both, or they have to reject X and Y both, which is not allowed. So for every appointment of director, we must have a separate resolution. Appoint X, yes, no. Appoint Y, yes, no. Appoint X and Y, yes, no. Doesn't work. So separate resolution is something which is allowed for appointment of two or more directors. However, single resolution may also work when ma'am, when can it work? When a prior resolution is passed. That means before the single resolution, another resolution is passed which tells us, resolve that appointment of X and Y is going to take place by single resolution, whether you approve or you disapprove. So you are taking prior permission from the members for proposing single resolution, and when you obtain this prior permission, it's not going to be OR, it's not going to be SR, it's going to be a resolution with no vote against it. That means there shouldn't be any objection raised to the passing of single resolution. Before single resolution, there has to be another resolution which has to be passed. Okay, fine, ma'am. Supposedly, you did not meet these conditions, you did not meet this requirement, and without meeting these requirements, single resolution was passed. Without taking this permission, single resolution was passed. Then all the appointments will be void. And this section 152(7) deemed reappointment shall not apply. We discussed this as an exception. When the retiring director automatically reappoints in adjourned AGM, there is an exception. This is an exception. I told you before only that section 162 does not apply to a private company. It does not apply to a 100% government company and wholly owned subsidiary of such 100% government company. Wholly owned subsidiary of such 100% government company. Okay, ma'am. Section 163. Proportional representation. What is proportional representation? See, if there is being given the power in article, some companies may choose to appoint their directors by proportional representation. Normally what happens, a person is proposed, OR is passed. If we get simple majority, he is appointed as a director. But in PR, we have a special voting method. This is by majority, simple majority. The minority shareholders might have to say that we cannot propose someone, our proportion is not being represented, etc., etc. So we have differential voting methods. What are the three voting methods which are recognized by this section? Single transferable vote, cumulative voting, or otherwise. So you have to remember these three names. The procedures are explained in the regular classes. Now, if your articles permit you, the company may resolve to appoint the directors by proportional representation, right? If you choose PR, then at least 2/3 of your directors are going to be appointed by PR, which cannot be removed by using section 169. Okay, this is an overriding section. So if you choose PR, all other things get stagnant. No rotation, nothing. Okay. The appointment is like the elections. It happens for 5 years, again election will happen. So likewise, here the appointment is happening for 3 years, again after 3 years, again PR. Again after 3 years, again PR. Right? The same people can be appointed, that's not a problem. Okay? Now, This section is again not applicable to 100% government company or wholly owned subsidiary of such government company. The directors who are appointed by using this particular section of proportional representation cannot be removed using section 169. They cannot be removed using section 169. Clear? Okay. Next we have section 168, the resignation of directors, a very simple section. Before we go on to resignation, let me discuss with you, what do the directors do? What are their duties? The directors have to act in accordance with the Companies Act. They have to act in accordance with the articles of the company. They must act in good faith. They should not be negligent towards the company. They should have due diligence. Their interest and the company's interest should be common. They should not ever have a conflict of interest. They should never attempt to have any undue advantage of any situation or gain anything which make secret profit or anything like that, right? And more importantly, prohibited to assign office. This is the most important duty which is covered under section 166 of the Act. Prohibited to assign office. You cannot transfer your office of directorship to anyone else. If you do, or if you do not follow or diligently perform any of the duties of the director, then you can be attracted to a fine starting from 1 lakh to 5 lakh. Right? So all the duties of the directors must be efficiently discharged by the directors who are appointed to the board of the company. Okay. Fine. Now, resignation by director. Director may resign. Director cannot be stopped by anyone else. If it wants to leave the company, he or she may leave the company. What they have to do is, they just have to give a notice in writing to the company, right? The company, it is company's duty to further inform ROC that their director has resigned. So there is a form DIR 12, within 30 days of receiving that resignation, you have to inform ROC. Whenever a director is giving resignation to the company, the resignation is going to be effective from the date when the company receives the resignation or the date you have specified in the notice, whichever is later. So from that date, your resignation will be treated to be effective. Okay, fine. And when the board comes to know about the resignation, they have two duties. They have to intimate ROC, plus they have to also include it in their board's report. As and when it will be made. Now, there is an optional requirement given in section 168 which tells that a director who is resigning may also inform ROC, although it is not this duty of the director who is resigning to inform ROC, it is the duty of the company to inform ROC. But you may also voluntarily inform ROC within 30 days of giving resignation in DIR 11. Okay, fine, ma'am. Now here also there may be a possible situation that all the directors have resigned. So again we will go to the promoters. The promoters will fill the position of directors, and if it cannot be filled, then the central government is going to take charge, right? Central government will appoint the directors. Next is section 169, which talks about the removal of directors. What happens? Supposedly the board wants to remove any of the director. It cannot. The power to remove director is with the members. How can they do it? By just passing ordinary resolution. Now, Removal before expiry of their term, because when their term has expired, they automatically leave and vacate the company. Before the expiry of their term, the members have the power that they can remove the directors, right? But for removing the directors, you must send special notice to the company. And to send special notice, you must be eligible. How do we come to know whether we are eligible to send special notice or not? Section 115, right? So it tells us that the members who are holding at least 1% of voting power or 5 lakh paid up capital in value is eligible member. So if you have the eligibility to send a special notice, send a special notice. This is just a name, nothing very special about it. It's just that this notice has to be sent 14 days before general meeting to the company. General meeting, any meeting, AGM or EGM. This special notice can contain two things. One, remove, we propose, or the intention, we intend to propose for the removal of Mr. X as a director. Point number one. Or it may say, we intend to propose to remove Mr. X as a director and appoint Mr. Y in his place. So there are two situations. One is you just want removal and the second is you want replacement. So when you want replacement, you suggest a name also. And when you want removal, it's just removal, right? So there can be two probable situations. So you give this special notice to the company. Now what does the company do? The company sends a copy of this notice to the concerned director, for whose removal the notice has been received. This concerned director gives a written representation to the company, what he has to say to its members, right? This written representation is being requested by the company to be forwarded to the members. But what happens sometimes? The directors, the concerned director tries to misuse this power. He has been given an opportunity that he can convey his message to the members. But instead of using this opportunity, he is misusing the power and writing all the bad things that he can about the company, about its directors, about its management, etc., etc. Now, when the written representation reaches to the company reads it, they get disturbed. And they feel that how can we let this be circulated to our members? So to seek a solution, they may move to tribunal. So they make an application and they say that we understand that the director has a right to make a representation, but such type of representations that he is making cannot be circulated. So the tribunal might order that there is no need for circulation of this written representation, or reading it out at the meeting, right? So in such case, this written representation may not be circulated. Otherwise, it will be circulated. Fine. So eligible member sends special notice to the company forwards the copy to director gives written representation to the company sends written representation plus notice 7 days before general meeting to the members. Quite possible there is time constraint or any other thing, and the meeting and the notice as well as the representation could not be sent, so it will be read out at the meeting. That's not a problem. And quite possible it is sent. Whatever the case be, general meeting is held. By passing OR, the director can be removed. Now, when he is removed before the expiry of his terms, it again leads to vacancy which has been created, right? Ideally, this is a case of casual vacancy, but supposedly we got the special notice of replacement and Mr. Y's name was also proposed. So, by passing OR, Mr. Y can be appointed. Supposedly, he was not appointed or no name was proposed. Then it will amount to casual vacancy which can be filled by the board by using section 161(4). Okay. So, we are removing directors just by passing OR. There are certain type of directors which cannot be removed by OR. What type of directors? Director who has been appointed by the tribunal, the director who has been appointed by proportional representation, the nominee director, and. See, independent director, he is appointed for 5 years by passing OR. He can be removed by OR. He is appointed again for 5 years, that means for his second term, by passing SR. He can be removed also only by passing SR. He can be removed also only by passing SR. So independent director in second term removal requires SR. Clear? Okay. Now, broadly we have completed the chapter and we are left with two important topics, independent director and SSD. Before that, section 170. What is 170? It tells about the maintenance of register. So every company has to maintain a register of directors as well as KMP. This is going to be maintained at the registered office, which shall also be open for inspection by the members according to section 171. They can inspect this. It will also be available in every annual general meeting where members can come and see it. They can take extracts. It is company's duty to provide extracts within 30 days. If you fail to do so, an application can be made to ROC and ROC will order you immediate provision of the same, right? So that is something. Section 171 talks about inspection. Section 170 talks about maintenance of register. Apart from maintenance of register, section 170 also talks about DIR 12. That whenever you appoint a director or whenever there is a change in director or KMP, file DIR 12 within 30 days. Section 170 as well as 171, they both are not applicable to government companies. Section 172, this talks about punishment. So if you contravene section 149 to 171 and there is no specific punishment provided in that particular section, example, non-maintenance of register, non-appointment of woman director, all this is, no specific punishment is given in that respective section. So you follow the punishment of leftover section, that is section 172, which states that minimum penalty 50,000, 500 per day continuing default, and maximum penalty 3 lakh and 1 lakh. 3 lakh for company, 1 lakh for officer in default. Okay, 3 lakh for company and 1 lakh for officer in default. Clear? Now we move to independent directors. Who are independent directors? Someone who is a highly experienced, highly knowledgeable person and who is not connected with the company. So when he comes to the company, he brings high level of expertise, and since he is not connected with the company, he will bring an unbiased opinion. We don't need independent directors in all types of companies. They are needed in certain limited companies. Listed company, if it's listed, we don't need to check any threshold. Listed companies straight away have to have 1/3 of their directors to be independent. If it's not listed, we have to check 3 criteria: 10, 100 and 50. Paid up capital more than equal to 10 crores. Turnover more than equal to 100 crores, or loans, debentures, deposits more than 50 crores. If either of these 3 criteria is satisfied, then you have to appoint 2 independent directors, at least 2 independent directors. Okay. So every listed company, at least 1/3 independent directors, and unlisted public company, if you meet the threshold, at least 2 independent directors. Whatever independent directors you are appointing have to be subject to the requirement of audit committee, NRC, any other law. That means if audit committee says you need 4 directors, independent directors, and this section says 2, appoint 4. Okay. Supposedly, the company is an unlisted public company and has crossed the turnover of 100 crores. So 150 crores is the turnover, you appoint independent director. Next year, the turnover comes down below 100 crore. Again below 100 crore, again below 100 crore. So if for constant 3 years you fail to meet that threshold, then there is no requirement for appointment of independent director. There is no requirement for appointment of independent director. Just like the vacancy in the office of woman director is filled immediate next board meeting or 3 months, whichever is later, like that here also the intermittent vacancy which is created in the office of independent director has to be filled up immediate next board meeting or 3 months, whichever is later. To appoint anyone as independent director, what is needed is the person should be an individual. He should not be disqualified. He should have given in. He should have given consent. He should meet the criteria of independence given under section 149(6). Apart from all that, and his name should be included in the data bank. What is this? We will read it a little later. Okay, so all these requirements, if they are fulfilled, then his name can be proposed, and when his name is proposed, he is appointed in the general meeting by passing ordinary resolution. Okay, ma'am. To be an independent director, independent director comes under the category of non-executive director. So you cannot be MD or whole-time director or nominee director. You cannot be these 3. And if you are not these 3, then if you meet the criteria of independence, you can be appointed as independent director. So not MD, not WTD, not nominee director, and satisfying all conditions below can be appointed as independent director. Point number 1. He should be the person of integrity, experience and expertise. Not in our opinion, but in the opinion of board. If it is a government company, in the opinion of respective ministry. He should not be the promoter of company holding subsidiary associate. This you can call as CHSA, this you can call as cash, this you can call as group, however you may learn it. Not related to PD, that is promoter director of cash, PD of cash. Someone should not have a pecuniary relationship, that is a monetary relationship with cash or with PD of cash during preceding year or 2 preceding years, during financial year or preceding 2 years. Now this has an exception. It is quite relaxed that if your pecuniary relationship does not exceed 10% of total income, it's okay, you may have it. Still you will satisfy the criteria of independence. Right, still you will satisfy the criteria of independence, integrity, experience and expertise, not related to PD of cash and not a promoter, not having a pecuniary relationship. So these are the first 3 clauses, easy ones. Then comes D, which is for the relatives. So your relative should not be holding security in cash, that is CHSA. Your relative should not be holding security in CHSA. There is a limit that if it holds security up to 50 lakh or 2% of paid up capital, it is allowed. Your relative should not be indebted to CHSA or PD of CHSA. If it is indebted in amount of less than equal to 50 lakhs, it is allowed. Your relative should not give guarantee to CHSA or promoter of CHSA or director of H. If it gives a guarantee for an amount less than 50 lakhs, it's okay. It's okay. You can write for an amount of 50 lakhs or more. Right? It's okay. Your relative should not have a pecuniary relationship with CHSA. For an amount 2% or more of turnover or total income. Pecuniary relationship, again monetary relationship. We have done a detailed discussion on all these points, right? So now I think you are well in a situation that you can quickly recall this, and this is learnt by you, right? Okay, so clause D was for relatives, 4 points. Not holding security, 50 lakh, 2% paid up capital, not indebted, in excess of 50 lakhs, not guarantee for 50 lakhs or more, no pecuniary relationship, 2% or more of turnover or total income, right? So these are the 4 points for relative. Now, you or your relative should not have been a KMP or employee in CHSA preceding 3 financial years. However, relative may have been an employee. You or your relative should not have been employee, proprietor or partner in audit firm of CHSA, CS firm of CHSA, cost auditor firm of CHSA, or such a legal firm which is getting 10 or more % of its total income from CHSA, right, in preceding 3 financial years. You with your relative should not hold more than 2% of the voting power of company. You with your relative, you or your relative should not be a director or executive of such NPO which is getting 25% or more of its receipts from CHSA or the director or promoter of the company, or holds 2% or more voting power. Who possesses other qualification as prescribed? What are the other qualification prescribed? You can be an expert in finance, you can be an expert in law, management, sales, marketing, administration, research, any other discipline, etc., etc. Fine. Now, every person who is going to be appointed as an independent director must give a declaration that yes, he has fulfilled the criteria of independence. So whenever you are appointed as independent director, in the first board meeting that you participate, in the board meeting of every financial year, and wherever there is a change in circumstance, you have to give a declaration. It is your duty. We have a code, Schedule 4, code for independent directors, how independent directors must react to the situations, how they should behave. You must follow that. You must follow that. What will you get? Because you cannot get salary, you are not an employee. You would get profit related commission. Even if there is no profit in the company, then also you will get commission. Then also you will get some amount. You will get sitting fees. Right? You will get reimbursement of expenses. Okay, but you will not be entitled to stock option. That is one thing that you need to remember. You will be appointed for 5 years. For 5 years. You may be appointed for a shorter term also, but you cannot be appointed for more than 2 consecutive terms. And any term shorter than 5 years will also be treated as one term only. So here you can be appointed for 5 years by passing OR, again for 5 years by passing SR, and then you need to have a cooling period. Then you need to have a cooling period for 3 years. Cooling period for 3 years. Again you can be appointed for 5 years. Okay, during the second term, if the company's shareholder want the independent director to be removed, they have to pass SR for removal. OR will not suffice. OR will not suffice. Okay. Now, whoever is the independent director or any non-executive director, he cannot be held liable for everything that's happening in the company. He will be liable only for those acts where he has given his consent, he had knowledge, or he had not acted diligently. Only for those cases he will be responsible. Only for those cases he will be responsible. Independent directors don't retire by rotation. Don't retire by rotation. Now, as I told you about data bank, right? What is data bank? Section 150. Section 150 basically tells us about data bank, that central government, see, every company, it is mandatory for listed companies and the companies which are meeting this criteria, it is mandatory for them to appoint independent directors. From where will they get these independent directors, for which central government has maintained a data bank. Now this data bank has been maintained by the notified institute of government. What is the notified institute of government? Indian Institute of Corporate Affairs has been notified by central government. So any company who wants independent director, they can go to that data bank, they can select a person, they have to perform their own due diligence, and if he meets all the criteria of independence of your company, etc., etc., you may appoint such a person as independent director. Fine. Okay, ma'am. Now we have a rule 6. If I want to be the independent director, or I have been the independent director, I have to comply with this rule 6. What does it tell us? What does it tell me? That I cannot be an independent director unless my name is included in the data bank which is maintained by this institute. How do I include my name, ma'am? I have to make an application to the institute along with the relevant fees, and my name will be included. Okay. That means before this rule came into picture, there were many independent directors. They also have to include their name. Yes. They have been given a time period of 13 months within which they can apply to the institute for inclusion of their name along with the fees. The name can be included for 1 year, 5 year, or for lifetime. And after this rule, anyone who wants to be appointed as an independent director, that means some companies proposing you to be appointed as independent director, you must before your appointment include your name in the data bank. And supposedly I'm not being appointed by anyone as independent director yet. I find this as a career opportunity and I want to include my name voluntarily. I don't even have DIN. I'm not a director of anyone. Can I? Yes, you can. So voluntarily also you can apply for your name as an inclusion in the data bank. Now, when you apply for your name as an inclusion in data bank, within 2 years you have to pass a test, online proficiency self-assessment test, OPSAT. With 50% passing criteria, there is no limit on the number of attempts. So within 2 years you have to pass it. You have n number of times. So within 2 years you can appear for the test n number of times and you can pass this test. You have to. If you don't pass it, your name will be removed from this particular data bank. If you pass it, great. Supposedly you enrolled your name for 5 years only. The tenure expires. Within 30 days, you can renew it. If you don't renew it, your name will be removed. Fine. Now, what has to be, what else is there in this rule which needs to be remembered is the exemption. What exemption, ma'am? Now, some very proficient people are not required to appear for their test. They will apply to the institute for inclusion of their name, and this step is excluded. They don't have to appear for their test. Who, ma'am? Someone who has 3 years of experience as a director or KMP in listed public company, unlisted public company with paid up capital to 10 crores or more, in any body corporate which is listed either in India or in such a country which is a member of FATF or IOSCO. Any body corporate which is incorporated outside India but having paid up capital more than equal to 2 million US dollar, any other statutory corporation. Or if you have 3 years experience in the pay scale of director or above in the Ministry of Corporate Affairs, Ministry of Heavy Industries, Ministry of Public Enterprises, Ministry of Commerce, etc. Right? Or if you have been in the pay scale of chief manager or above in SEBI, IRDA, RBI, PFRDA, so all these are excluded from appearing for test. Moreover, if you are an advocate in practice, if you are a CA in practice, if you are a CS in practice, if you are a CMA in practice, and you've been practice for 10 years, at least 10 years, then also you are exempted from the test. Then also you are exempted from the test. Okay? Fine. And this is probably the last section that we have to discuss, that we have to revise. We've covered all the sections. SSD, Small Shareholders Director. Who are SSD? SSD. The directors who are elected by the small shareholders. Who are small shareholders? Small shareholders are the shareholders who have less than or equal to 20,000 face value of shares of the company. So they are considered as small shareholders. Now this section applies to listed company and it is discretionary. It's not mandatory. So if a listed company wants, it may suo motu, that means on its own or on receipt of a notice by the eligible small shareholders, it can have one SSD who is elected as who is elected by small shareholders. Who is eligible to send notice? 1,000 small shareholders or 1/10 of small shareholders, whichever is lower. Right. So they will send a notice to the company that we are proposing the appointment of this person as SSD. And this is his DIN, this is his consent, and he has given a declaration that he is not disqualified, right? So along with these details, they send a notice to listed company. Listed company may have one director elected by SSH. Now this is not a normal election which is happening by all the shareholders. So it's not an ordinary resolution in general meeting. It is the election by small shareholders only. So they meet. Only their meeting happens, and in their meeting by majority votes such a person is elected who is going to be non-rotational, who is going to be independent. So he also has to meet the criteria of independence, section 149(6), and he also has to give a declaration in that regard. Okay, and he is going to be non-rotational. He has a fixed term for 3 years. Can he be reappointed after 3 years? No. Then 3 years will be cooling. Again, then he can be appointed after 3 years. During this cooling period, he cannot be appointed or be associated in the company in any manner. In any manner. Okay. Fine. If small shareholders director, someone who is appointed as SSD, is disqualified under section 164 or grounds of vacation are attracted to him, or he fails to meet the criteria of independence, he has to vacate. He has to vacate the office. One person can be SSD in maximum 2 companies, but the 2 companies should not be competing business, should not be in the competing business, okay, or their business should not be in conflict with each other, okay. And no reappointment allowed, that is something that I've already told you. SSD can be removed under section 169. This is something which is allowed. SSD can be removed under section 169, right? So I think we have revised everything. Okay. Hi everyone. Let's now revise our chapter of appointment and remuneration. of managerial personnel, right? This particular chapter has sections 196 to section number 205. Not a lot of sections, but two very important sections of your curriculum, that is section 196 and 197. So we will start with the appointment part. Every company has some executive directors as well as some non-executive directors. The executive directors, that is MD, WTD, along with the manager, is termed as managerial personnel, although not defined in the act, yet we come to know that we are going to talk about their appointment, we are going to talk about their remuneration along with remuneration of other directors as well. The direct appointment of other directors we have already discussed in the chapter of directors. Moreover, if it's a managing director or whole-time director, there also we have discussed the appointment already. Now, appointment has to be in accordance with section 152. Undoubtedly we know that. So we have section 152, we have section 160 for the appointment, and here the appointment is going to be in accordance with section 196. Clear? A manager plus whole-time director is possible. Manager plus MD is not possible. Managing director plus whole-time director is possible. So you cannot have a manager and a managing director at the same time. Simple reason being because manager is someone who has almost all the powers of the company, and managing director is also someone who has substantial powers of the company. So I made that chart for you, right? Made that diagram for you, rather a circled diagram in which we are able to understand who a managing director is and who a manager is and why they are not possible at the same time in the same company. So no company can appoint a manager as well as a managing director at the same time. Whoever you appoint, their tenure is going to be maximum for 5 years. This does not apply to a government company. Right, so a government company may have MD which is going to hold office for 10 years, not a problem, right? But otherwise in all other companies, including a private company, you cannot have MD, WTD or manager for more than 5 years. So at once you can appoint for a maximum tenure of 5 years only, but before this 5 year ends, when 1 year is left for ending these 5 years, you can have reappointment. Right, so reappointment not earlier than 1 year before expiry. That means you cannot do that you have appointed a managing director on 21st Jan and on 22nd Jan you reappointed that person for another term of 5 years. No, it cannot be so quick. See, after 4 years we come to know, yes, about the work, how they have performed, how they are performing. So once we very well know about the work, then is the right time when we can go for reappointment. Reappointment is permissible before expiry of term, simple reason being because we don't want to hinder the flow of work. These are people who are involved in the core work of the company, right? Not exactly the core work, I would say the core management of the company. So the company cannot function without them, and that's why their reappointment is possible even before expiry of their term, but not earlier than 1 year. Section 196(3) tells us about disqualifications of appointment. That is, who can be appointed as MD, WTD or manager. Such person has to be within this age limit. Should not have attained the age of 70 is the language of law, although here I have mentioned 69 is the maximum because ultimately that comes out to be the solution. However, what you will write in examination is that at least of 21 years age and not attained the age of 70. Lesser than 21 is not permissible in or any case at all, but supposedly we have a very experienced person who is more than 70 years of age, who has attained the age of 70 or is even more than that, his appointment is also permissible provided SR is passed. Supposedly SR could not be passed, but the votes that he has got are more in favor than against, then we can take the approval of CG and we can still appoint such person. Okay. What are the other disqualifications? Someone who is undischarged insolvent, someone who has ever done suspension with the creditors, someone who has been convicted for imprisonment for more than 6 months, such person becomes disqualified for life. He can never be appointed as MD, WTD or manager in any company. Okay. Now, appointment requires approval. There are 3 stages, my dear: BR in BM, OR in GM, and central government approval sometimes, not always. So there can be two stage process also: board resolution in board meeting, ordinary resolution in general meeting, and that's how the appointment of these people will be made, right? This section of approval does not apply to private company. So in private company, you don't need this approval by central government or this approval by in general meeting. No, nothing required at all. In case of government company also, this subsection does not apply. So if it is a government company and someone needs the approval of CG according to this particular section, for that company it will be exempted, right? So by far, MD, manager cannot be appointed together for 5 years at once. Then certain disqualifications, that is minimum age 21, maximum age 69, it cannot be 70 or more. If it is 70 or more, SR needs to be passed. Undischarged insolvent, not allowed. Suspension done with the creditor, not allowed. Then you have been convicted for more than 6 months, not allowed. After that, what is the process? The first step is to call a board meeting. Now, in the board meeting, you pass a board resolution, you appoint MD, WTD or manager, and in the next general meeting, you need their approval. So, in the next general meeting, you take approval. So, whoever is appointed by passing board resolution is being clearly told that this appointment is subject to the approval in general meeting. If it is approved, then great. If it is not approved, then you have to vacate the office. However, your prior acts, whatever you have done as the managing director or whole-time director, shall be considered to be valid. Okay. Whenever you appoint someone as managing director, WTD or manager, you have to file a form. For appointment of KMP, for appointment of director, we have a form DIR 12 for filing within 30 days of appointment. However, this form is not required because for managerial personnel, these 3, you have a form MR1 which has to be filed. MR1 has to be filed within 60 days of this board resolution. Within 60 days. This marks the appointment of managerial personnel and it is the intimation to ROC. Now, in certain cases, you need the third approval as well. 3 stage I told you now: BR, OR and then CG. CG approval is not needed in all the cases. CG approval is needed in certain cases only. If you comply with conditions given in part 1 of Schedule 5, no need for central government approval at all. But if you don't comply with these conditions, then also you can be appointed subject to approval by CG. How do we get approval by CG? For that, we file the form MR2. It has to be filed within 90 days of board resolution, and when we file that form, CG will either approve our appointment or it will reject our appointment. If we don't get the approval, then the person so appointed cannot continue as the managerial personnel. Okay. So what are the conditions which are given in part 1 of Schedule 5? There are 19 acts. If someone has been imprisoned even for a single day under these 19 acts, you have not complied with the conditions of part 1 Schedule 5, and hence either don't be appointed as MD, WTD or manager, or if you want to be appointed, seek government approval by filing MR2 with central government. Clear? Moreover, if you have been fined under these 19 acts for an amount exceeding 1,000, then also the same thing applies. What are the 19 acts? Central Excise Act, Customs Act, GST, Wealth Tax, Income Tax, FEMA, PMLA, SCRA, SEBI, Companies Act, Competition Act, IBC, Stamp Act, SICA, Food Adulteration, Essential Commodities, Fugitive Economic Offenders, Foreign Trade Act, Industries Development and Regulation Act, right? So you don't have to learn every act name by name, but you should be able to recall whether this is, if you hear a name, you should be able to recall whether this particular act is under those 19 statutes or not. So that is something which is important for you to learn. Next, if your convicted person is appointed as MP with approval of CG, no approval required for any subsequent appointment. Simple meaning that once you have taken CG approval, you don't need this approval again. You don't need this approval again. Second thing, so we have basically 4 conditions given in part 1 schedule 5 which needs to be complied with by a person who is proposed to be appointed as a managerial person. If he does not fulfill these conditions, then his appointment is made subject to CG's approval. If CG doesn't approve, his tenure will terminate immediately, right? What are the 4 conditions? First is imprisonment or fine under 19 statutes. Second is detention under Conservation of Foreign Exchange and Prevention of Smuggling Activities Act. So even if you have not been imprisoned, you have not been fined, but you have been detained for any inquiry or for any purpose, then also you have not complied with the conditions. If you have completed the age of 21 years and not attained the age of 70 years, that means if you're below this or if you're above this, you have broken the condition. You must be the resident of India. So if you comply with these 4 conditions, that is no imprisonment, no fine under 19 statutes, no detention, attain the age of 21 and not attain the age of 70 and a resident. If you comply with all these 4 conditions, then you can be appointed without CG's approval just by passing BR plus OR. Otherwise, you need CG approval as well. Otherwise, you need CG's approval as well, right? Apart from this, what do we have in appointment part? See, whenever you are calling a board meeting or a general meeting for the purpose of appointment, then you will clearly specify in the meeting that what are the terms and conditions of appointment, what is the remuneration that is being proposed, and other important details, right? Section 196(4) and Section 196(5) does not apply to a private company. Section 196(2), 4 and 5 does not apply to a government company, as I have already told you that. Whatever appointments you're making, rather whatever forms you're filing, be it MR1 or MR2, it has to accompany the mandatory attachments. In MR2, you also have to furnish the copy of board resolution plus the copy of OR or SR. You will tell to the government that our board has approved, our members have approved the appointment, and now it's your turn because he is not complying with the conditions of part 1 of schedule 5. So you give the permission so that he can continue the appointment. And when you're filing MR1, it has to have board resolution along with it, and it is going to be, of course, certified. Fine. Okay, so we proceed further. Next is our managerial remuneration. Managerial remuneration, we don't get exact how much should we pay to our directors, rather we get an upper capping or upper limit as to what is the maximum remuneration that we can pay to our directors, to our manager, to our non-executive directors. There are 2 cases of remuneration. One is profits and one is loss or inadequate profits. We have in detail discussed about what do you mean by inadequate profits and when can we identify whether the profits are adequate or inadequate. Moreover, you understand profit and loss very well. So if there are ample of profits, there are adequate profits in the company, the overall maximum managerial remuneration limit is 11% of net profits. What do we mean by net profits over here, ma'am? Net profits will be computed according to section 198. Okay, fine. Supposedly we want to pay more than this particular limit, we need to get authorization in general meeting if we want to pay more. Authorization means simple resolution. Now, this 11% limit is the overall limit. We have 4 sub-limits also. 5, 10, 1, 3. When we are paying to our managerial personnel, if there is just one of them, 5% to him, maximum that can be paid. If there is more than one, then 10% is the maximum that can be paid to all of them. To other directors, if there is managerial personnel, that means he is there to work, so only 1%, and if there is no managerial personnel, 3% of net profits is the maximum that can be paid to them. Supposedly, we want to increase this limit. We can increase this limit by passing SR. But we want to pay our directors more. We want to pay our directors more than the limit which has been specified in the Act, but we don't have money to pay to our debenture holders, to repay our creditors, to repay our loan. In such a situation, Companies Act doesn't allow you. It tells you that first you obtain the approval of people you haven't paid their money. So if there is a default in repayment of dues to bank, public financial institution, to the debenture holders, to the secured creditors, so take their approval and then you take the approval of members for paying more. Okay, so prior approval of bank or PFI, in case it is applicable, and SR if it exceeds the above specified rate, if it exceeds the above specified rate. Okay, fine ma'am. Now, supposedly the company does not have adequate profits. There are losses in the company. Then whatever payment is going to happen will happen according to Schedule 5. Schedule 5 has different parts, Part 1, Part 2, Part 3, Part 4. Part 1 relates to appointment, we have discussed. Part 2 is divided into further 5 sections. We have Section 1, we have Section 2, which is the most important one over here. Section 1 tells us that if company has profits, pay according to Section 197. But if company doesn't have adequate profits or if there are losses, then pay according to this schedule, Section 2, Item A and Item B. What is it, ma'am? Item A is the limit given based on effective capital. What is the limit given, ma'am, based on effective capital? If your capital is less than or negative or less than 5 crore, then you can pay maximum managerial remuneration to your executive directors plus managers 60 lakhs, to others 12 lakhs. If it is 5 crores or more but less than 100 crores, then 84 lakhs, 17 lakhs. So exactly divided by 5 comes out your limit to other directors. If it exceeds 100 crore, if it is 100 crore or more than that but less than 250 crores, then 120 lakhs and 24 lakhs. If it exceeds 250 crore, 120 lakhs plus 0.01% of whatever is the excess to 250 crores. Likewise, 24 lakhs plus 0.01% of excess. Right, so this is the limit which has been given under Item A. How do we calculate effective capital? Effective capital means paid up share capital, securities premium, your loans, your reserves and surplus, minus your investments, minus your losses, minus your preliminary expenses. So you get the figure of effective capital. Right, so whatever is the effective capital, supposedly you want to appoint a person as managing director, but you know that your company has been into losses for the past 10 years. Now, whenever you are going to fix his remuneration, you know that you cannot give him remuneration 11% of net profits. How? The company doesn't even have profit. So you know the maximum remuneration that you can pay to him in case of losses is calculated according to Schedule 5, Part 2, Section 2. So you come here, you check the effective capital of the company. Supposedly the effective capital of the company is 2 crores. So now you know that you can maximum pay him 60 lakhs per person per annum. 12 lakhs per person per annum. That is for other directors, and this is for executive directors plus manager, right? But these limits can also be increased provided you pass a special resolution, right? Okay, fine, ma'am. Now, what is item B? Item B tells us about the appointment of director or managerial person in the professional capacity. What is professional capacity? Someone who is not holding the shares of the company or holding a subsidiary except for ESOP. And that too just 0.5% of the paid up share capital. Just a second. So if you are not holding any shares in the company, if you're not connected to the promoters, if you're not connected to the directors of the company, you're not related to them, and basically we are trying to eliminate the promoter group, and you have that graduate level qualification. So if you have all these three, then you can clearly say that I am a director who is working in the professional capacity. If a person is working in the professional capacity, then he can be paid remuneration according to item A. That clearly means that in case company doesn't have adequate profits, they are suffering from losses, then they can pay remuneration to their directors, who are working in professional capacity. Like if we have Reliance Industries Limited, there may be Mukesh Ambani. He is not a person who is working in professional capacity. Why? Because he is connected to the company, he is related to the company, right? So someone who is working in a professional capacity can also be paid remuneration in case of losses, in case of inadequate profits, when SR is passed. So for such appointments, you need SR. I have told you the whole history, why law is harsh over here, what is the logic behind everything. But as of now, the only thing that you need to remember, just a second. The only thing you need to remember over here is that if you fall under item A, you have to pay, the company can pay maximum managerial remuneration based on effective capital. And if you don't fall under item A, if you fall under item B, then also the maximum managerial remuneration that can be paid to any director is according to item A. So ultimately what you have to remember is the chart of effective capital, right? So effective capital, whatever category you fall into, you will pay remuneration according to that effective capital. Clear? Okay. So that is item A and item B. Now moving further, because we have a lot in schedule 5, first of all, let's try to wrap up schedule 5 and then we will switch to other points given in section 197. We have certain special cases also, certain special cases as in the remuneration. Okay, before that, certain special cases, if the company has inadequate profits, or if the company, this I have already told you, if the company has loss or inadequate profits, then if the director is employed in professional capacity, then he also may be paid remuneration according to item A only. What is item A? Item A is according to effective capital, right? If you want to increase even beyond that, SR is needed. If you want to pay within the limit given in schedule 5, no SR is needed. But if you are falling in the item A, then SR is needed even if within the limit. Fine. Now, limits under A or B are going to be available if, or you can say pay according to item A and B if. So these are the 4 conditions which must be satisfied, then only you can pay according to section 2 of part 2 of schedule 5. That means if a company has inadequate profits, you can pay within the limit of 60, 84, 120 and 120 plus 0.1%. Likewise 12, 17, 24 and 24 plus 0.01% to executive plus manager and to other directors if these conditions are complied with. That means you obtain the approval of NRC or board, there is no default in payment of dues, and if there is default, then prior approval of there is obtained, OR or SR. If it is within the limit, OR. If it exceeds the limit, SR. And details in explanatory statement. So there are certain general disclosures, certain information about the company, about the appointee, etc., etc. All that has to be given in the notice of general meeting. Okay, fine. Then we have some special cases. In these cases, the remuneration can be paid even more than given in section 2 of part 2 of schedule 5. If the remuneration is being paid by other company and in that company it is within the limit of managerial remuneration, plus you can say that it complies with the conditions of section 197, right? So if it is so and the remuneration to this company's directors are being paid by some other company, then that is permissible. If it is a new company, then for the first 7 years it is permissible. If it is a sick company and has been referred to BIFR, then for 5 years it is allowed. If it has, if a resolution plan has been approved with respect to a company under IBC, then for 5 years it is allowed. If the remuneration is fixed by NCLT, then it's allowed. Provided all these cases, remuneration will be allowed if the remuneration is not being received by some other company. If I am a managing director at 2 places and at some other place I'm receiving remuneration, then I cannot be paid extra remuneration if I fall into this category also. Certificate of no objection from creditors for extra payment. Certificate of no default to creditors. So these are the 2 certificates that will be made by the company secretary, and these are the 2 certifications that we need apart from a confirmation that the person to whom remuneration is being paid is not deriving remuneration from any other company, right? Of course, all these cases that I am discussing with you are not so important ones. Now, one more thing that is given in schedule 5, although it is given at the end, but I'm discussing it with you right here. Okay. A person is a managing director in 2 companies. We usually think that we have to check limits for the respective companies only. That means he is an MD of A Limited. We have to check the maximum managerial remuneration in A Limited. And if he is the MD of B Limited, we have to check the maximum managerial remuneration in B Limited. Mr. X can get maximum from both places. It is not so. He cannot get maximum from both places. His total remuneration cannot exceed the maximum of the highest of all the companies from which he is getting remuneration. So this is one small point that you have to keep in your mind. Now, apart from that, we have section 4, which talks about the perquisites. Perquisites which are not part of managerial remuneration. One disclaimer I'm giving right here, this is just revision and recalling of all that we have studied in absolute depth, right? So if you have forgotten the provisions, please refer to the original videos, then only you will be able to recall the complete concept. If you remember the concept, then this revision is going to help you in immense manner. Now, perquisites, some perquisites which are being paid to the director do not form part of the managerial remuneration. What are they? If there is contribution to PF, gratuity up to a certain limit, leave encashment. So these 3 perks will never form part of managerial remuneration, just like sitting fees doesn't form part of that, right? But if it is an expatriate person, then children's education allowance, holiday passage, as well as that leave travel concession, that is also not going to form part of the managerial remuneration. Okay, so that was about schedule 5, a lot of content. Now we come back to section 197. Section 197 tells us the case If you have adequate profits, you have a limit. If you have inadequate profits, you go to Schedule 5. And we have read about the whole Schedule 5 over here. Now, what else is there in section 197? Because it is a huge section. How can we pay remuneration? We can pay it as monthly, we can pay it as percentage of profits, or it can be a combination of that. How do we determine remuneration? If it is given in articles or 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 SR, if articles say so. Now, excess remuneration, supposedly any director receives excess remuneration, that has to be refunded to the company within 2 years. This refund can be waived if SR is passed, but before passing SR, you need approval of bank or PFI if there is default. Okay. Whatever you are being paid other than or whatever you are being paid in professional nature, that is not going to form part of your managerial remuneration. Usually the rule is that whatever company pays has to be within that limit of 11%, because it is considered as managerial remuneration. But your sitting fees is not considered as managerial remuneration. Your amount that you are paying in excess of in your professional capacity, that's not considered as managerial remuneration. Example, a doctor is also MD. So as MD, whatever he is drawing is managerial remuneration, but as doctor, if he gets some visiting charges, that is not managerial remuneration. That will not be considered as a part of a managerial remuneration, right? So when it will be considered as professional, if the services are of professional nature and director has such requisite qualification according to board or NRC. Now, sitting fees that can be paid over and above remuneration, we have to keep in mind maximum sitting fees that can be paid to anyone is 1 lakh. But one more thing that we have to keep in mind is that whatever you pay to a woman director as well as independent director should not be less than what you pay as sitting fees to other directors. So this is also one thing that you have to keep in mind. Okay. Section 197 is not applicable to government company when there is no default, of course, and Schedule 5. It's not applicable to government company. Section 197 is not applicable to government company, and this is only for, of course, public company, because in the very beginning it's written that the remuneration payable by a public company shall not exceed. So, of course, this section is not for private company as well as not for government companies. Now, apart from that, we have certain certain requirements, disclosure requirements, which is for every listed company. So listed company has to disclose that median remuneration, the increase in remuneration, increase in median remuneration, the permanent employees, average increase, that is average percentile increase, then whatever remuneration you are paying according to the remuneration policy or not, the name of top 10 employees who are drawing the highest salary, the names of employees, names and details of employees who are drawing salary more than equal to 102 lakh per annum. If they are employed for part of the year, more than equal to 8.5 lakh per annum, per month, right? So all these details are also needed. These are disclosure requirements which are needed. Now, apart from that, any insurance premium that is paid by the company to secure the liability of directors shall also not form part of managerial remuneration till the time the director is proven guilty. Okay. And then you have punishments, penalty for non-compliance, etc. Okay, moving on to our next section. Before we move on to section 199, let's quickly recall section 198. What is not to be or what is permissible credit? We have 4 things. What is allowed as income? What is not allowed as income? What is allowed as expense? What is not allowed as expense, right? So government subsidy allowed.
Securities premium not allowed. Whatever you get from profit from reissue of forfeited shares not allowed. What you get on profit on sale of undertaking not allowed. Then profit on sale of immovable property, fixed asset over and above the original cost not allowed. If there is change in carrying value, not allowed. If this is revaluation profit, notional gain, not allowed as a credit. Now we come to debits. What is allowed as a deduction? Working charges, depreciation, bonus, special tax, interest on debentures, on secured loans, on unsecured loans, charitable contributions, whatever repairs are there, brought forward adjusted losses, compensation, insurance, bad debts, all these are allowed. What is not allowed? Income tax, not allowed. Any voluntary compensation that you are paying, that is not allowed. Then change in fair value and loss on sale of undertaking, that is also not allowed. So you have to keep in mind what is allowed and what is not allowed. Then we have a section 199 which talks about recovery of remuneration, not in the case where you have paid excess remuneration because you could not ascertain net profits in advance, but this is a case when the restating of financial statements occur. So in case of fraud, in case of non-compliance to accounting standards and all, you have a chance that there is a possibility of revision of financial statements. That means you're recasting your financial statements. It may lead to a situation that your net profit is reduced and thereby the overall limit of remuneration is also reduced and you come to know that you have paid excess remuneration. So in such a situation, company has been given the power that can recover the remuneration from MD, WTD, CEO, manager, whether past or present. So it can be past also. Maybe the person is now gone and now you are revising the financial statements of some old tenure and you come to know that okay, we have paid excess remuneration. So that is something which has been given power over here. Now, apart from this, section 200, a very small section again, it empowers the company to fix a limit. A limit on what? A limit on the remuneration. Supposedly the company has inadequate profits or losses. In that particular situation, company can fix a limit. Company can say that okay, Schedule 5 gives us the maximum limit of 60 lakhs, but we say that you are being appointed at a remuneration of 5 lakhs per month, but we will not pay you more than 2 lakhs if there is a case of losses, right? So they can do this while granting approval with respect to appointment or remuneration of MD, WTD, manager. Then we have a section, compensation for loss of office, section 202, an important section from your examination point of view. Who is entitled to compensation? MD, WTD, manager and no other person. When is entitled to compensation? When there is a loss of office. When there is a loss of office, fine. So if their office expires before their term, they have been appointed for 5 years, but they are being removed by the company after 3 years. So for 2 years, they will be paid compensation. What is the maximum compensation that can be paid to them? Lower of your unexpired tenure or 3 years. So if your unexpired tenure is 4 years, you have just completed 1 year and 4 years are remaining, you will get compensation only for 3 years. But if your 2 years are remaining, then you will get compensation for 2 years only. So whatever is your unexpired term or 3 years, whichever is lower. What remuneration will I get actually earned? How do I calculate it? Based on average of 3 years profit. If I have not worked for 3 years, such shorter period. Okay. There are certain cases where this remuneration will not be allowed. What are the cases? When the director has got another office pursuant to amalgamation or reconstruction, when the director has himself resigned, when the director, any disqualification is attracted to him and he has to vacate the office, when due to the negligence of director winding up has started, when not due to negligence of director, winding up has commenced either before leaving or within 12 months of leaving, and the amount after repaying all liabilities are not even sufficient to repay share capital. So in such a situation, his compensation will not be paid. And if he is found
guilty of fraud or breach. Okay, if he is found guilty of fraud or breach. Again, an important section from examination point of view, appointment of KMP. This actually does not prescribe us the whole process of appointment, rather tells us the requirement of appointment. Listed company and public companies with paid up capital of more than or equal to 10 crores, it is mandatory to have these three people. Three for different set of things: to manage the business, to manage the finance, and to manage the compliances. MD, WTD, manager or CEO, any one of them, and CFO and CS. Moreover, there is a rule which tells that private company with paid up capital more than equal to 10 crores has to appoint a CS. Only a CS, not others. Others are not needed. So a private company may or may not have MD. There is no requirement that you must have MD. And even in public companies, there is no such requirement. But if your public company has paid up capital more than equal to 10 crores, or it is a listed company, then certainly there is a requirement, right? How are they going to be appointed? Of course, we have read about the appointment of these people. It's going to happen according to section 196 only. However, CFO, CS, they all will be appointed by passing a resolution at board meeting. If the office of any of these becomes vacant, that is the situation of casual vacancy which has arisen, it is going to be filled by the board within 6 months of the vacancy, at board meeting only, fine. Now there is one more requirement, that one person cannot be MD as well as chairman at the same time. However, it is permitted if the articles so provide, or if the company does not carry multiple businesses, or even if the company carries multiple businesses and it has appointed CEO for each business. It has appointed CEO for each business. Okay. Now, a person can be maximum MD in 2 companies, and that too if specific notice is sent and unanimous resolution is passed at the board meeting of the second appointment. And if you talk about KMP, one person can be KMP in only one company. It can be KMP in more companies also, provided those companies are only subsidiaries, right? However, he can become director with the board's permission, that's not a problem. And lastly, we have one more section, secretarial audit. It is again needed for certain big companies only. So we have listed company, we have public company with paid up capital more than equal to 50 crores, and we have public company with turnover more than equal to 250 crores, or we even have it is also applicable to every company having outstanding loans or borrowings from banks or financial institutions more than equal to 100 crore. So in such a case, they have to get their secretarial audit done by a CS in practice. The report is going to be in form MR3, which is going to be annexed with the board's report. And just like an auditor gives a qualification or remark, the board replies to it, gives his explanation. Just like that, if CS also brings a qualification or remark, the board, it is the duty of the board to give an explanation on the same. After that, we have section number 205, which talks about the duties of company secretary. What company secretaries have to do. See, company secretaries are the king of compliances, right? So they have to check the compliances undoubtedly. So they will guide the board of directors about the compliances. They will also be responsible in convening the meetings, obtaining necessary approvals, presenting themselves in the front of authorities or regulators. Whatever board tells them, they are going to perform that. Whatever articles, whatever act tells them, they are going to do that. They have to ensure two compliance with the act and compliance with the secretarial standards. That's very important. And of course, perform the duties which are being entrusted to it through act or through board. In this particular chapter, we have discussed one case law of Bell versus Lever Bros, which you have to remember. Okay, fine. Hi everyone, let's now revise the chapter Meeting of Board and its powers. So this is a huge chapter containing a lot of sections and very important from your examination perspective. It commences with section number 173. But before we start section 173, let's have a basic understanding of how board takes its decisions. Now, why do board need to take any decisions? Because company is an artificial person and company cannot take decisions on its own. Hence, the decision making powers are being distributed over board of directors as well as the shareholders, right? Whenever board has to take any decision, that means any issue comes up in front of all the directors collectively known as board, they have to resolve the decision. They have to resolve the problem. So a resolution is passed. What is resolution? Majority or you can say voting happens, right? That is, all the directors have to give their assent or dissent, whether they agree that this should be done or they disagree. If majority of the directors who are present and voting agree, then we consider that board resolution is passed. However, if they don't agree, we consider that the board resolution was put forward but it is lost. So, the decisions of board of directors are taken by a board resolution. Now, sometimes section 186, section 203, you also have unanimous board resolution. There is a difference between board resolution and unanimous board resolution, that is UBR. This is that whoever is present at the board meeting, so all the directors present, they cannot refrain from voting, they cannot abstain from voting, they have to vote and they have to vote in favor. So when all the directors present vote in favor, then a UBR is passed. The UBR is not required at all times, it's required in 2 sections in Companies Act, and in fact it's required under a rule also, but that is not something that we are going to consider right now. Now, how this board resolution will be passed? Undoubtedly, ma'am, all the directors should come together, then the issue will be told to them and then they will resolve the issue. That's how things happen. There is another way of passing board resolution, which is by circulation. That means the decision of board can be taken either at the board meeting or by passing the resolution by circulation. Now, this board meeting may be virtual, it may be physical. It may be virtual, it may be physical. Earlier, we had this provision that some matters cannot be dealt in at a virtual board meeting, but now there is no such restriction and all the matters can even be dealt at virtual board meeting or the board meeting that's being conducted through video conferencing, right? So this is the general thing. Now, one thing which is imperative from this discussion, which we come to know, is that we must meet, that the board of directors must meet in order to take decisions. And since their meeting is mandatory, they must meet. Companies Act has put in some mandatory requirements about board meeting. Starting from section 173(1), we come to know about the minimum number of board meetings which every company must conduct. See, board meeting is, the matters can take place or they can, directors can vote directly from their place also through circulation, resolution by circulation, but that is something which is not allowed for every matter. There are certain matters for which it is clearly specified that you must meet to take decisions. Okay, you have read section 161. In section 161, there are 4 parts. Section 161(1), additional director. Section 161(2), alternate director. Section 161(3), nominee director, and 161(4), casual vacancy. Now, out of these 4, only 161(4) says that resolution at board meeting. That means this is a section which clearly specifies that the resolution has to be passed at board meeting only, and the resolution cannot be passed through circulation. So a lot of times matters are being specifically reserved for board meeting. So for all the other three cases, you may have a resolution by circulation, but not for this one, right? So there are restrictions which have been imposed. Moreover, we have a section 179, which says that certain powers are exercisable by the board only at the board meeting. Okay, so although decisions can be taken through circulation also, but still it is imperative that the board meet, so that all the directors are aware about what is happening in the country, and moreover to take the decisions which are being specifically reserved for board meeting. Okay, now what is the requirement? First board meeting has to be held within 30 days of incorporation, and thereafter every company is going to have a minimum 4 board meetings in every calendar year. The gap between 2 board meetings is not going to be more than 120 days. So maximum gap 120 days. This is the general rule that we have for all types of companies. However, there are certain exemptions. Now, before I go on to exemptions, you have to understand that even if the meeting is adjourned, that also has to happen within the time limit specified. That means if you call a board meeting, it is adjourned and held after 4 months, the gap between 2 board meetings should not exceed 120 days. So this applies to adjourned meeting also. Now, for Section 8 company, we have the requirement minimum 1 meeting in every 6 months. I hope you understand and remember the difference that I have told you in classes. 6 months and half year. So that's a difference, and you must understand and remember that. So Section 8 company, 1 board meeting in 6 months. OPC, small or dormant company, 1 meeting in half year. Minimum gap should be 90 days. Minimum gap. Here maximum gap was specified, here minimum gap. Now, private company which is startup, again the same thing as of OPC, small company, and dormant company. OPC with 1 director only, the section doesn't apply. See, meeting, introspecting, all this does not happen when you're talking about company. When you have to take the decisions of company and you are the only one to take decisions, why you will call a board meeting and meet with your own self? Obviously no, right? So you will not meet. Then comes your section 173(2), which talks about video conferencing. That means a board meeting may also happen through video conferencing. I'm not telling you over a telephonic call or a teleconversation. No, it has to be AV, audio, visual, both. So it may so happen. That means a director, if he is unable to attend the board meeting physically, he can also attend the board meeting virtually. So we have a whole procedure which is being listed when the meeting is happening virtually, or when the directors are participating virtually. So what is the procedure that's going to be followed? What are the requirements that are going to be followed? What is needed? So section 173(2) read with rule 3 and 4. So that's how we are going to read it. I mentioned this before that earlier there was rule 4 which prescribed certain matters which could be dealt only at a physical board meeting, but now those matters have been removed. That has been omitted. So now we don't have any matter which is specifically reserved for a physical board meeting. Okay, fine ma'am. So a director can attend in person or can attend through video conferencing only. The only requirement is that whenever a company is going for a virtual meet, it has to ensure that whatever setup it is establishing, it is capable of recognizing the people and recording the director's presence and storing everything along with date and time. Moreover, the chairperson and this company secretary who are responsible for convening a board meeting, they have to make necessary arrangements to avoid any type of failure and should take reasonable care for these. See, whenever a board meeting is happening virtually, it's a welcome move. Undoubtedly, it's a welcome move by the government. But there are issues with respect to confidentiality, security, and other like matters, right? If we are in a closed compact conference room and a board meeting is taking place, we are sure that no one else who is not entitled or authorized is listening to us. But if we are sitting here out in open and everyone is participating through different places, there might be some insecure surroundings. There might be, right? So this raises a doubt on the confidential matters of any company. However, duty has been imposed on the director as well as the company. That director also has to ensure that you are not around anyone, and the company also has to ensure that the director is sitting alone and only authorized access is being given to the in the board meeting. Right? Fine. So what has to be taken care of? Security and integrity, availability of equipment. All the proceedings will be recorded and thereafter minutes will be prepared. You have to safely keep the records for future. You have to ensure authorized attendance only, as I just mentioned. However, if a person is disabled and requests for an attendant, then that person will be allowed one, and ensure proper audio visual. Okay, so these are the requirements which must be fulfilled, and then only you can go for VC. What is the procedure? And one more thing, is AV mandatory? If a director is unable to attend a board meeting, he requests the company to provide for audio visual facility, and the company ignores and rejects the plea. Is it valid? I would say no. It is mandatory that you provide audio visual or video conferencing facility to the directors if they want that. Okay, for this we also have a case law, Achintya Kumar. Now, what is the procedure? Because normal board meetings, people come, we count, we see things, right? We see things, we hear things, we are in a closed compact room. How the things are going to happen over video conferencing, that is also the procedure which has been laid down. What is the procedure? The first requirement. Well, if you want to call someone for your birthday, for your anniversary, for anything, you must give an invitation, right? Or even if it's not a very formal invitation, you must at least notify. If I want to call you for a class, I will at least have to notify when that's going to happen, where it's going to happen, at what time, place, all these details, right? Likewise, when company wants to call its directors, either physically or virtually, it's their choice. They have to at least inform the directors. How do they inform the directors? By sending notice. What is to be included in the notice? That we will read in section 173(3). Later on, in the same section, we have the provision of notice also. But right now, I am concerned about one particular part in the content of notice, that is an option of VC. So when a director receives the notice of board meeting from the company informing when board meeting is going to take place, he's also given an option that the meeting may be, you can participate in the meeting through video conferencing, and this is the information with respect to that, right? So this is the disclosure that's given in the notice. I have received the notice, so I will attend the meeting. But this is something which is not very common. Although it's becoming common, but I have to intimate the company that I am going to attend through VC, so that company can make adequate arrangements. If I don't intimate anything, it is deemed that I'm going to attend in person. Fine. So I informed the company made adequate arrangements keeping all this in mind, and I attend the meeting through video conferencing in the mode as has been specified by the company. What happens is that at the board meeting, the chairman is going to ensure quorum. The next question arises, what do you mean by quorum? Quorum is the minimum number of directors which are required to constitute a meeting. Only then the meeting can proceed. The question is, ma'am, do the quorum need to be physically present or it can be virtually present? See, it may be a situation that all the directors are virtually present. It may be a situation that some are physically present and some are participating through VC. Never mind. The directors who are physically present as well as the directors who are virtually present, they both are counted for the purpose of quorum. So we count the physical directors. If they're present, it's a physical board meeting, right? And that we don't need to compute further, right? So that is how the case is. Once quorum is there, the meeting begins. Then happens the roll call. Roll call is like an attendance. You must have seen a lot of CBI inquiries or police inquiries in movies and web series. What happens? They ask or they interrogate, and the first thing that they ask the accused is that, tell your name. Although I know the name, but still I ask them to tell the name for the record. Right, same thing is happening here also. The directors are being asked to tell their name, the place from their attending the meeting, the fact that they have received the agenda, and the confirmation that no one else is around. So they have to give this for the record. Although the chairman clearly knows that particular director, but still a roll call happens for the record. Then what will happen? Of course, the meeting has started, there will be people discussing, and then there will be voting. So when the people are discussing, there might be these directors also who want to participate and contribute to the discussion. So whenever they contribute, they will identify themselves, and if their voice gets disturbed by any means of disturbance, they will repeat it. Okay. And then voting happens, voting again, roll call, voting. That's how it happens. The chairman at the end announces the summary, and everyone, if they have any objection, they can raise it. After that, the minutes are drafted. That is the true and fair correct summary is being recorded or is being put in writing. Once it is written, it is circulated to all the directors who attended the board meeting. Okay. So they have the chance, they have the option of raising or of commenting on the accuracy within 7 days. If they don't comment on the accuracy, or if they don't have anything to say, it is deemed approval, and if they have anything to say, accordingly they raise that objection. After that, it is going to be entered in the minutes book. The minutes book is prepared under section 118 and is open for inspection under section 119, right, and is signed by the chairperson. Clear? Fine, ma'am. Then we have section 173(3), which talks about the notice of board meeting. See, what are you concerned in the notice? You have to inform the directors. What do you have to inform? Date, place, time, venue, option of VC, and agenda. What are we going to discuss in the meeting? Right. And when we have to inform? That means if the meeting is commencing at 1 p.m, I cannot call at 12 and say the meeting starts in 1 hour at this particular place. Right, a lot of cities where the traffic is huge or commuting takes time, they will not even be able to reach, even if they are willing to and they leave immediately, then also they might not be able to reach, right? So there has to be a sufficient time given to the directors to prepare themselves for the meeting, to make themselves available for the meeting. So ideally 7 days time is required. So company gives 7 days notice to all its directors. To all its directors. No particular form of notice, 7 days notice in writing to every director, either by hand delivery or by post which has a proof, or by electronic means at his address which is registered with the company. At his address which is registered with the company. If you don't give notice, then 25,000 fine on officer in default. Fine. Now I said one particular point with a lot of emphasis, that is agenda. What is it? Agenda is the matter which we are going to discuss. Now, Companies Act does not make it mandatory to give agenda along with the notice. However, as a part of good secretarial practice, it must be sent, and if we talk about the practical world, it is always sent. Because the directors must know what are we actually going to discuss. However, this may so happen that 3 agendas are specified and the chairman wants to take up another matter which is required, and a board meeting is already in existence, so they can take up that matter, right? Simple reason being because the agenda is not mandatory under law. Fine, ma'am. Now, a lot of times this also happens that we don't have time. We don't have time to wait for 7 days to discuss a particular matter, and that's why we want the directors to come together at a shorter notice. So this is also something which is permitted for urgent matters, but there is a requirement. What is the requirement? That one independent director must be present in such a meeting which has been called at a shorter notice. Now, this may so happen that that no independent director is available or no independent director attends that meeting. So there is another solution. What is the another solution? It is supposedly a shorter notice is given, meeting called, no ID attends it, no independent director attends it. So circulate the decision to all the directors, and if at least one independent director ratifies it, then it's going to be valid. Ma'am, what about the companies in which we don't have independent directors? This is not the requirement, so you can call the meeting at a shorter notice. Simple. Okay. So this restriction has been placed on those type of companies only which have independent director. Okay. Sometimes students have this confusion that, ma'am, can board meeting be held on a holiday? Yes. Can it be held outside business hours? Yes. Can it be held outside the city or registered office? Yes. It can be even held outside India. Okay. So board meetings, that is something which is very well possible. Okay, fine. Now, Section 173(4) is only about the penalty that I've already told you. Moving on to the next part, Section 174, that is quorum of a board meeting. Quorum is the minimum number of members which are required to constitute or to validly conduct a board meeting. 1/3 of total strength or 2, whichever is higher. Although articles may specify an even larger or higher quorum, articles don't have the power to specify a lower quorum as it will be non-compliance of law, but it can specify a higher quorum. So articles may say that in my company the quorum will be 5 directors. So irrespective of what section 174 says, you have to have at least 5 directors to constitute to conduct a board meeting. Fine. Okay, fine, ma'am. Now, what if the quorum is not present? What is going to happen? The meeting will be adjourned. If quorum is not present, the meeting will be adjourned according to what articles say. If the articles don't say anything, it will be adjourned to same day, same place, same time next week. Supposedly at the adjourned meeting also quorum is not present, the meeting will be cancelled. In general meetings, we have read the opposite. What we have read in general meetings is that if in the adjourned meeting also quorum is not present, the members who are present shall be deemed to be the quorum. This is not the case in case of board meetings. Fine. So in board meetings and general meetings, this particular provision is different. Fine. Okay. Now one more thing that you have to understand, that what is interested directors? Who are interested directors? We have a section 184, in which we talk about the disclosure of interest and like things. See, there might be a situation that I am a director and the company is entering into a contract with my father. So I would definitely want that this contract should take place because I'm interested. Somehow I have an interest, and therefore my discussion, any contribution to the discussion, any contribution to the voting cannot be unbiased. Or even if I am so competent to be unbiased, others might not believe it, right? They will still have the feeling that I will give a biased opinion only. So Companies Act prevents such a situation and tells the directors who are interested to not be a part of such meetings, to refrain yourself from participating in such meeting and voting in such meeting in which you are interested in any contract. Okay, fine, ma'am. Now, supposedly there are 9 directors, and out of which 2 directors are interested. So 1/3 of 9 comes out to be 3 or 2, whichever is higher. So out of these 7 remaining directors, you can have at least 3 directors who are present and they will constitute the quorum. That's not a problem, because interested directors, since they cannot participate in the meeting, they are also not a part of quorum. Fine. But let's imagine a situation. There are 9 directors and out of which 7 directors are interested. So if I calculate 1/3 of 9, it will be 3. We don't even have 3 directors who are not interested, because 7 directors are interested. We just have 2 non-interested directors. So in such a situation, there will never be a quorum. So for this situation, it has been specified that if the interested directors at any time is more than or equal to 2/3 of the total strength, then higher of number of disinterested directors or 2 directors shall be the quorum. Okay, it shall be the quorum. Now, one relaxation in private companies, because in private companies you will be interested in almost all the contracts and you are only the member, you are only the director. So if you are interested, you are allowed to vote. It's just that you have to give proper disclosure. So this does not apply to a private company. Now, for section 8 companies, quorum is different. 25% of total strength or 8 directors, whichever is lower. However, in no case it shall be less than 2. Okay. Now let's imagine a situation. Ma'am, my articles say that you need 5 directors to be the quorum and I have only 3 directors. So how? Because my 3 other directors have died. So how can I get 5 directors? How can I conduct a board meeting? In such a situation, you can call a board meeting even with lesser number than the quorum to increase the directors or to call general meeting. So for these 2 purposes, even if there is no quorum, the directors may act. Okay. Section 175. Passing of resolution by circulation. One thing that I have already told you, that resolution by circulation is not allowed in all cases. For the cases where it has been specifically mentioned that you have to deal with this item at board meeting only, then board meeting is needed. We are reading about the notice, we are reading about the quorum, all for the board meeting, not for passing resolution by circulation. So here we don't have any such requirement. What is the process then, ma'am? You draft a resolution, attach necessary papers which help the directors to take a decision, and send it to all the directors by hand delivery, post or email at their address. If you get approval by majority, then in the subsequent board meeting you will note it and include it in the minutes that such a resolution was passed. Okay. Sometimes it may so happen that I have received this draft resolution and I sincerely feel that this is a matter which should be taken up at the board meeting because it needs a lot of discussions. So if 1/3 of directors require that the resolution should be passed at board meeting, then chairperson shall decline this particular thing and they will call a board meeting and the matter is going to be decided at the board meeting. Clear? The matter is going to be decided at the board meeting. Then comes your section 176, a very small section which just talks about the defects, or you can say validity. See, a lot of times it may so happen that we appointed a director, his appointment was defective, or some disqualification gets attracted to him, or he has to vacate some office, some grounds of vacation has been attracted to him, but he doesn't know, the company is not aware. In such a situation, he continues to act as a director even during that period of disqualification for say 6 months, 7 months. Now during this tenure, he has passed a lot of resolutions, he has taken a lot of decisions, he has entered into a lot of transactions with other parties, third parties. Once we come to know that his appointment was defective, that means he was not a director, proper director, and that means all the acts that he has done as a director are not proper. That means we have to reverse all the acts. The answer is no. Section 176 gives us a clarity that if the director appointment was invalid by reason of defect, disqualification or termination, then whatever acts are done by the company till whatever acts are done by the director till company becomes aware of it, they shall be deemed to be valid. Okay. So after his appointment has been noticed by the company to be defective, thereafter all the acts will be invalid, but before that the acts will be valid. Okay. Before that the acts will not be considered to be invalid. Just a second. I try hard not to waste your time because I understand you are into such heavy professional studies, and at this particular time, if at this particular point, if I am asking you to devote 1 hour with me, then I have to understand the importance of that 1 hour, and I cannot be like only half an hour to be productive and half an hour some chit chat or this example or that joke. So I refrain from cracking a lot of jokes when I'm into serious studies. Of course, for the flow, for keeping the classes entertaining, you know that we need stories, we need jokes, we need situations every now and then, so that has to happen. But of course, when I'm doing this continuous revision, I don't want to waste your time, and that's why I am trying to be as quick as I can. If you still want that the flow should increase somehow, you can increase the speed, but I wouldn't a lot suggest you that. For the topics wherein you are very confident, you may skip this revision, you may increase the speed, but for the topics you are not very confident, then this is going to help you only, right? So you can revise along with me. I'm trying to cover all the aspects of all the complete section. I'm not leaving anything for you. Now, section 177, audit committee. See, 177 has two aspects, audit committee as well as vigil mechanism, and section 178 has NRC and SRC. First, we'll talk about section 177, audit committee, or as of that matter, any committees that we're talking of. What are these committees? They're nothing but a group of directors of the same company. So they are dedicatedly being appointed to the cause of something. When I'm talking about audit committee, they have been some directors who have expert knowledge in finance or who understand finance, who understand the financial statements and all, who understand how audit is being conducted, what is the importance of audit and like things. They are being included in this committee. What do? They see that which auditor should come, so they can give recommendation with respect to auditor, his remuneration. They can see how audit is being performed. They can see other internal controls of the company. They also have to approve some related party transactions, right? So they investigate into certain matters. So not just audit, but overall control of the company. So they have certain powers and they have some certain functions that they need to discharge. So they are going to oversee all those things. Okay. Ma'am, do we need audit committee in all types of companies? The answer is no. See, as the company grows and expands, then you need specific expertise areas. Otherwise, one person can handle it all. One person can handle audit also, he can handle the employees also, he can handle the operations also. So even if you have two directors, they can handle everything. But as company grows, you need different dedicated team to handle things. So the companies which are required to appoint independent directors, the same companies are also required to constitute audit committee. Okay, that means listed public companies or public companies which have paid up capital of more than equal to 10 crores, turnover more than equal to 100 crores, loans more than 50 crores. So these companies are required to constitute audit committee, which is mandatory. JV, that is joint venture, wholly owned subsidiary, dormant, not applicable to them. So they are not required to constitute. Now, we need to understand what is going to be the composition of audit committee, what are the powers that they have been given, what are the functions that they need to discharge or they need to perform, any disclosure and punishment for not doing it. The punishment is not given over here, it is given under section 178. So we don't have any punishment which has been specified in section 177. For the for contravention of section 177 also, the punishment is stated in 178 only. Okay, now composition. Minimum 3 directors, of which majority shall be independent and with the ability to read and with the ability to read and understand financial statement. They have to be financially literate, not just literate. Okay. What do? They recommend auditors' remuneration. One important point to note over here that they recommend. They cannot impose their decisions on the board. It is board's discretion only whether they want to appoint or nominate the auditors. Appointment of auditors is a matter of ordinary business which is being dealt at the general meeting of the company, but board nominates the name of the director, nominates the name of auditor. This name is being suggested by the audit committee. When an expert is giving you a recommendation, you must follow it. Although it is your life, your decision, you might not follow it. But when you reject that expert's recommendation, you must have a strong backing reason for that. The same goes for the board. Board, if you are rejecting, if you are not accepting the recommendation of audit committee, you must disclose the reasons in the board's report why not, along with the composition of audit committee. Fine. So they recommend, then they review auditor's performance, how the auditor is performing, so that we can give a feedback, no, this auditor is not correct, we should not reappoint this auditor, or this is performing brilliantly, what is happening, right? Then examining the auditor's report. If auditor has given any qualification in his report, then you are going to discuss it with the auditor, why this particular qualification has been given. If it is a clean report, no problem at all. Right, but then you will see on what aspects auditor has examined, on what aspects auditor has not examined, what are the things that are happening in the company. So it also acts as a bridge between the management as well as the auditor. Then scrutiny of loans, assets, internal control, monitor use of public funds, additional things, and approval of related party transactions. So section 177 out here is read with section 188. Is read with section 188. One by one we'll do it. Now, to discharge all the functions, you also have been given certain powers. You can call for comments of auditors, you can review financial statements, you can discuss issue with the auditors, you can investigate and oversee vigil mechanism. We'll do this later after we do this. Fine. Now, what is related party transaction? What is related party transaction? For this, you need to understand what is a related party. Section 2, clause 76 defines related party. Company, the director of company, relative of director. KMP is relative. Any firm in which they are a partner. any private company in which they are member or director, any public company in which director or manager is the director and holds more than 2% of paid up share capital of the company along with its relatives. Then any body corporate according to whom you are acting, or the body corporate who is acting on according to you. Then we have holding subsidiary, associate, investing company, subsidiary of holding, any other as may be prescribed. So all these are related parties. All these are related parties. Company enters into a contract with the related party. Company is buying some goods from related party. Now this is a contract which is specified in section 188. I'll repeat. Section 188 has 7 specified transactions if entered into with related party needs approval. Approval from audit committee, approval from board, and if ceiling limit exceeds, then approval from members also. So audit committee approval, board's approval, as well as members approval if ceiling limit exceeds. Members approval is needed only if ceiling limit exceeds, right? That means you need audit committee's approval also. So audit committee will grant the approval. Fine, ma'am. Audit committee has an option to give omnibus approval also. What is omnibus approval? It is one-time approval. See, if the transaction is not covered under section 188, of course you don't need to give any approval, you can only give recommendation. If the transaction is covered under section 188, then you need approval. But even within that, if the amount is less than 1 crore and you don't take approval from audit committee, then audit committee can ratify it within 3 months, and if not, it is going to be voidable at the option of audit committee. But if the amount is more than 1 crore and the transaction is specified under section 188, then either you can take approval transaction wise or you can take prior approval for maximum 1 year. Okay. For this, audit committee is going to check how repetitive the transaction is and how justified the transaction is. So based on that, they will give prior approval for the whole year. That okay, this is the maximum value, that during the whole year, maximum up to 1 crore you can enter into transaction, or maximum up to 10 crores. Per value transaction is not going to exceed 1 crore. You have to make these disclosures. These transactions are not permitted, and I'm going to review from time to time. Okay, so this, by imposing such conditions, audit committee can grant omnibus approval for related party transactions which need approval under section 188. Clear? If you contravene this, penalty is there. This is the penalty which is given under section 178. Clear? Now, audit committee is also required to oversee vigil mechanism. What do we mean by vigil mechanism? Vigil mechanism is set up for the benefit of employees, for the benefit of directors, so they can report their concerns, their grievances directly. A lot of times it happens that employees are being caught in the web of manager or the exact upper hierarchy. They don't have the access to move to higher authorities. They don't have any access to complain. They don't have any medium to complain, right? Even if they go to their own manager for complaining about him only, he's not going to listen. So for such purposes, for the companies, if your company is a listed company, if your company has accepted public deposits, or if your company has borrowings more than 50 crores, then in these situations it is mandatory for the company to establish vigil mechanism. Okay, now vigil mechanism is just a system where you can register your complaints, where you can have access to people who will listen and resolve your problems. For the companies which have audit committee, Audit committee oversees the vigil mechanism. In many companies, it may so happen that you don't have audit committee, but because you have accepted some public deposits, you are required to establish a vigil mechanism, and therefore you do it. So in such a situation, the board is going to nominate a person to oversee vigil mechanism. It also happens a lot of times that people take undue advantage of this system and they file unnecessary or frivolous complaints. So in such a situation, action will be taken against that employee also. I'm sorry. Clear? Fine. So this was about section 177. Now we move to section 178, NRC and SRC. Who is required to establish NRC and for what reason? NRC is again being established by those companies who are required to have independent director or who are required to constitute audit committee. So the same companies are also required to constitute NRC. What is NRC meant for? NRC is going to identify persons who should be appointed as director, who are deserving ones, who are required in the senior management, who should be removed. Formulate the criteria. In fact, even develop the criteria for evaluation of the performance of board, that he is a director who is performing really well, or he is in the senior management, he can be promoted as a board of directors. So this is the criteria that I have developed for evaluation of performance, like who attends at least 7 board meetings. So this is the criteria that they have maybe set up. Now this can be evaluated by them only, or it can be evaluated by some external agency also, or by the board also, right? So all this is the function of NRC. The composition of NRC is slightly different than audit committee. Here you need 3 directors, only non-executive directors, 3 or more, at least 3 non-executive directors, of whom half shall be independent directors, Now whoever is the chairperson of the company can become the member of NRC, but he will not be the chairperson of NRC. He is the chairperson of company, he is an executive director, he can still be the member of NRC, but he will not be the chairperson of NRC. Clear? Okay. Then we have stakeholders relationship committee. Ideally, when we talk about stakeholders, we include everyone, be it government, be it our suppliers, be it our employees, be it our vendors, all of them. But here, stakeholders mean the persons who have invested into the company. They are the security holders, they are shareholders, they are deposit holders as well, they are debenture holders, they are any other security holders. So collectively, if this number exceeds 1000, then comes the requirement of SRC, that is Stakeholders Relationship Committee. What are they going to do? Vigil mechanism for the reporting of complaints by employees. This is also for reporting of complaints or grievances or problems of stakeholders. Some might not have received the dividend, some has the issue with respect to share warrant, etc., etc. There can be ample of things, right? So they can file their grievances. Stakeholders Relationship Committee, a group of dedicated directors who are going to oversee that all the problems are being resolved or not. So the basic idea is to protect the interest of all security holders, okay, not just your equity shareholders, but all the shareholders, right? Now sometimes it may so happen that I'm genuinely trying to resolve a problem, but the other person is not listening at all or is in some other angle. So if you have tried to resolve the problem in good faith and you are unable to do that, then it will not be deemed to be contravention of the same. Okay, so no contravention if inability to resolve the problem in good faith. You have the penalty. What is the penalty? 5 lakh and 1 lakh. Section 177 plus section 178. So if you contravene any of the provisions of these sections, then this is the penalty. Penalty on company 5 lakh and penalty on officer in default 1 lakh. Right? Now, section 179, powers of board, or I can say powers exercisable only at a board meeting. See, first thing that you need to understand for this section is that what board of directors can do. Anything that a company can do, its board can. What company can do? Company has to comply with Companies Act. The board also has to comply with Companies Act. Company has to act within the purview of its memorandum of association. So will the board. So you have to understand that anything that a company is permitted to do, its board can do. But there are some powers or there are some acts which only shareholders can do. Like altering the articles of association. A company is permitted to alter its articles even after it has been drafted, but this power has been specifically reserved for the shareholders. So such a thing cannot be done by the board of directors. So all the acts which a company can do within Act, MOA, AOA, or any regulation which the shareholders have imposed in general meeting. So within these powers, board can do all the acts which company can do, but board cannot do the things which are specifically reserved for the shareholders. Now, so board has ample of powers. Out of these ample of powers, there are certain things which have to be dealt at board meeting only. These powers cannot be exercised, or these matters cannot be dealt through resolution by circulation. Okay. So BR in BM is needed. That is, board resolution and board meeting is needed for transacting these items. That means whenever you want to call money on shares. See, I have given you a mnemonic of learning this. I hope you remember that and you have learned this well. Calls on shares, buyback, issue of securities, approval of merger, diversified business, approval of financial statements, political contribution, takeover, appointment of KMP, internal statutory auditor, removal of KMP. And then you have big powers. Borrowing money, investment, and giving loan guarantees security. These two are covered in section 186 and this is covered in section 180. So section 180, company can borrow, company can give loan, company can invest, company can give guarantee, company can give security. Company can do this. It is not such that these things are not permitted. These matters can be dealt only at a board meeting. However, these three big powers, big powers can be delegated. You call a board meeting, you pass a board resolution, resolved that the power to borrow money has been delegated to managing director of the company. He is now empowered to borrow money on behalf of the company. The maximum amount that he can borrow is this, etc., etc. So by imposing all those conditions, you can delegate the power to a managing director, manager, commercial, the principal officer of the company or branch, right? He can be a director also. So I hope that's clear. Now, board of directors has all the powers which company has, subject to act, memorandum, articles and regulations. Now, there are around 13 matters which require board resolution at board meeting. Only then they can be discussed or they can be dealt with. Out of these 13 matters, there are 3 matters which can be delegated, right? Now, we come to section 180, borrowing. This is the major thing that is given in this section. Section 179 tells us that the company can borrow, but to borrow it has to hold a board meeting. However, it may also be delegated to someone, but whatever power is delegated, it has to be within the limit which is given in section 180. What does section 180 tells us? Section 180 restricts the general and vast power that has been given to the board. The board can borrow. The board can borrow money. Section 180 tells, hold on, you can borrow only up to this amount. If you want to borrow more than this, you need to go to the members and take special resolution. You need to pass SR and take their approval. Moreover, you also need SR for these things. So in these 4 cases, SR is needed by the board of directors. Case number 1. Company wants to sell its undertaking. What is undertaking? Undertaking is a separate unit. How do we identify whether a particular venture is an undertaking or not? If that particular venture is giving you or is worth 20% of net worth, more than 20% of net worth, or it's generating more than 20% of income, then it's an undertaking. So if you want to sell off that undertaking, the board cannot take decision on its own. It has to go to the shareholders and get a SR passed. If the company wants to sell only substantial amount of undertaking, not the whole undertaking, but a substantial amount of undertaking. What is substantial amount of undertaking? 20% of that undertaking. So if you want to sell that, then also you need SR. Clear? Sometimes on merger, you have received some amount. Company has received some amount. Now you want to use this amount for some purpose. It's not your money, it's the money of shareholders. You need to take their permission and then only you can use this amount. Supposedly, company has given some loan to a director. Now, can company give loan to a director? Yes, subject to section 185. Subject to section 185. Supposedly, company has given loan to a director and now the director is unable to repay. The director comes to the company and says, I need 1 more year. The board says, okay, fine, take it. Today is your day, tomorrow our day will come. No. The board does not have the power to give extension to the director. For this, you need SR. And lastly, if the amount of borrowing exceeds a particular limit, what is the limit that has been given? Borrowed plus proposed exceeds paid up capital, free reserves, securities premium. If this exceeds, then SR is needed. If it does not exceed, then SR is not needed. That means if your total borrowings are less than equal to paid up capital, free reserves or securities premium, then you don't need SR. If it exceeds that particular amount, then you need SR. In this section, in this particular point, we have a concept called as temporary loans. Temporary loans. What are they? Temporary loans. Like you have any short-term loans, they are not going to be part of that borrowing. For example, if there are short-term loans 50 lakhs, and then you have long-term loans again 50 lakhs, and the company proposes to borrow further 50 lakhs. So how will I compute this limit? I will say that my existing borrowings is 50 lakhs and my proposed borrowing is 50 lakhs. So 1 crore is the total borrowings. Now if this amount exceeds this, then I need SR. So I will also calculate paid up capital plus premium plus free reserves and I'll see which one is higher. If my borrowings is less than or within that limit, then I don't need SR, otherwise I need SR. Okay. Section 180 does not apply to a private company. So in private company, the board can borrow any amount that they want to. They don't need to get any special resolution. So for private companies, You can borrow any amount that you want to. There is no restriction or there is no limit which has been imposed. Fine. Section 181. Contribution to bona fide or charitable funds. This is a very small section. Company wants to contribute to these funds, you can. If you want to contribute up to this particular percent, it is within board's limit, and if it exceeds more than 5%, then you need OR, and then you can contribute. Then comes your section 182, which is political contribution. Again, a lot of students have this problem that, ma'am, why political contribution is so liberal that any amount, you can contribute any amount. So I have told you the logic behind this, right? See, any company other than government and a company which has been in existence for less than 3 years, they can contribute, they can give any amount they want to a political party. It's just that cash contribution is not allowed. They have to either contribute through check, draft, ECS or instrument. So they can. They just have to disclose in P&L account. Okay, fine. Contribution to National Defence Fund. This is an overriding section. It overrides everything. It says that if company wants to contribute to NDF, National Defence Fund, or any other approved fund for defence, go ahead. Even if your articles restrict you, then also you can. There will be no contravention, absolutely no. Okay, fine, ma'am. If you contravene this, there is a penalty. This reminds me, if you contravene section 179, section 180, section 181, that is powers of board, then you have restriction on powers of board, and even if you have charitable contributions. These three sections that we read before, they don't have any penalty which has been specified. That means, ma'am, we have been given that we have to discuss this matter at board meeting only. But supposedly we don't discuss this matter at board meeting and we pass a board resolution by circulation. What is the penalty? You have the penalty which is not specified for the section. So you go to a specific section of penalty, which is section 450, general section of penalty. So for all the sections where a specific penalty has not been specified under Companies Act, we have a general section, section 450. Now, disclosure of interest by director. A director has to give disclosure of interest. For this, again, we come back to our related party. For the students who have not done very thorough study, might not understand that what is the connection between related party and section 184, ma'am. Section 188 is for related party, section 184 is not for related party, but you have to understand that there may be situations when both the section applies. Why? Because we have interest in our related parties. No matter how much we say that we are interested in our neighbors or this or that or this or that, no, we are interested in our family, our relatives, our people. Right? If my mother is being appointed as one of the employees of a particular company, I'll be interested in that contract. If some XYZ person is being appointed, I'll not be interested. So my interest is somehow connected with related party, though it may not always happen so. Now, if I am a director, I have to check in which companies I have the holding, in which firm I am a partner, where body corporate, where association I'm interested. And I have to give all these details in the first board meeting in which I'm participating as a director. I've been appointed as a director. In the first board meeting that I participate, I have to give this disclosure. Thereafter, every year in the first board meeting, I'll give disclosure. And if there is any change in my interest, then after the change in interest, the first board meeting that happens, there also I'll give disclosure. So I have to give disclosures in this manner. The form specified is MBP 1. I give the disclosure. The company maintains a register MBP 4 for recording these things. Okay, fine. There is another subsection, section 184(2), which is more important for examination point of view, that deals with specific disclosure. Specific disclosure. Now this is when the company enters into a contract or arrangement with body corporated firm and the director of the company is interested in such body corporator firm. Now this interest has been specified. Section 184 interest has not been specified, so you have to give disclosure in all respect. But here you have to give disclosure only when you hold more than 2% of paid up capital, or your promoter or manager of CO and partner or owner of the firm in case of firm. So you have to, if above situation arises, then this director must disclose his interest in the board meeting in which first time the contract is discussed, and he shall not participate in it. Supposedly there is contravention of the same, the contract becomes voidable, such director has to vacate office and there will be a fine of 1 lakh on interested director. Okay. Again, it does not apply to private company, because in private company the directors who are interested, they can vote. After giving the disclosure, they can vote. Fine. Moving on to our next section, section 185, that is loans to directors. See, the first thing, company is prohibited to give loan, guarantee or security to the directors of the company, the directors of holding company, the relative of such director, partner of such director, and a firm in which such director or relative is a partner. So you cannot give loan, guarantee or security to your director, to your directors of holding company, and to other concerns in which the directors are related. This is the logic, this is the section which it says, but then it has exceptions. See, section 185 deals with such a situations when there is loan, guarantee or security to the directors or its concerned entities. If the director is not related to any entity, this case does not fall under section 185, because section 185 deals with loans to directors, etc. So we are talking about loans, giving loans to director directly or giving loans to the entities in which such director, in which director is interested. So one is that prohibition, you cannot give to these people. Second is that you are permitted to give to certain people in which director is interested if you pass SR. If you pass SR. Okay, ma'am? Permitted to give loan to or guarantee or security to private company in which director is a director or member, body corporate whose board acts according to us, and body corporate in which we hold more than equal to 25% of voting power. So you can give to such entities in which director is interested. Loan can be given to such body corporates in which the director is interested if explanatory statement is given to the members and SR is being passed. Clear? Now, it's not applicable to private company if no body corporate has invested in that private company and the borrowings are within this limit and there is no default. It is also not applicable to government company if they have obtained the necessary approval from their respective ministry and no default of filing. Moreover, it is not applicable if loan is made to MD or WTD as employee. They are executive directors, right? That means they are employees of the company. So just like advance salary can be given to other employees, it can be given to these directors also. So fine. There might be some scheme which has been released by the company, and in pursuance of that scheme you can take loan. So you can take loan, not a problem. There might be a situation when you give loan in ordinary course of business like NBFC or banking company. It is their business to give loan. So just like they give loan to other customers, they have given loan to director also. But obviously when you give loan to your internal employees, to your internal directors, you give loan at some reduced rate. In any situation, your rate should not be less than the government security yield. If you give loan to your wholly owned subsidiary, if you give guarantee to your wholly owned subsidiary, guarantee or security to your wholly owned subsidiary. So these are the exceptional cases where it is permitted, right? Where it is permitted. Moving on to next section. Loans, investments, etc. by a company, a very small section, section 186, or rather I would say it has two perspectives. Sorry, 186 is not a small section. It has two perspectives. One is putting a restriction on layering of investment companies, and the second is LGSI limit. First thing you need to understand for this section is what do you mean by investment companies, and since you have to understand about investment company, I'm going to take you over here. Investment company is what? Whose principal business is investing. How do you identify whether a company is investment company or not? See, if I want to check, I open a balance sheet of any company. If that's a factory, it will have a lot of assets as plant and machinery. So I come to know, okay, a lot of manufacturing is taking place in this company. Likewise, if I open the balance sheet of an investing company, I will see a lot of assets as investments only. So more than 50% shall be them. Or if I check the P&L account, I will see more than 50% of its income is coming from that investment sources only. Right? So that's how I identify whether a company is an investment company or not. Although we can talk about any type of company, there is a restriction on number of layers of subsidiaries. But this section 186 talks about investment companies only. It restricts the number of layers of subsidiaries to maximum 2. It does not mean that a company cannot have more than 2 subsidiaries. Undoubtedly, it can have hundreds of subsidiaries, but it cannot have more than 2 layers of subsidiaries, which means a company has a subsidiary, this company has another subsidiary, and this company has another subsidiary. So layer 1, layer 2 and layer 3. So layer 3 is not permitted. Fine. There are exceptions. What are the exceptions? Banking company, NBFC with net worth more than 500 crore, government company, insurance company. These are the exceptions. One more thing, that wholly owned subsidiary is not counted as a separate layer, that is merged with that company only. And we have a company, this company acquires a foreign company. It becomes a subsidiary. Now this foreign company already has 5 subsidiaries, 5 layers of subsidiaries, I would say. 1, 2, 3, 4, 5. And this is something which is permitted in that country. So this foreign company is not doing anything unlawful. It is a lawful act. And now you want to acquire, you want to make this foreign company as your subsidiary. An Indian company wants to make this foreign company as their subsidiary. You can. So if Indian company is a foreign company, if the investing company is a foreign company with permitted more layers as per foreign law, it is allowed. Now we have other provisions of section 186. This is LGSI. Loan to any person or body corporate, guarantee with respect to the loan, security with respect to the loan, or investment in body corporate. This is shortly known as LGSI. For this, you need unanimous board resolution. So for giving loans to anyone, for giving guarantee, for giving security, or for investing in any body corporate, you need UBR. More than that, apart from UBR, if the ceiling limit exceeds, you also need approval from members. You also need approval from members. So what are the cases? UBR is must in all cases. If LGSI made plus proposed does not exceed the limit which has been specified. What is the limit? This is the limit. Higher of 60% of paid up capital plus free reserves plus securities premium, or 100% of free reserves plus securities premium. So you check this limit, you compute this limit. If your LGSI which is already there plus proposed exceeds this amount, you need SR. If it does not exceed this amount, no SR is required. Okay. Now, If it does not exceed the limit, no SR needed, you just need UBR. Plus you need PFI approval if there is default in repayment. If there is no default in repayment, no problem. Fine. But if your LGSI exceeds this limit, you need UBR, you also need SR, as well as you also need PFI approval. Ma'am, even if there is no default, yes. If it exceeds limit, you need PFI approval also. Fine. Apart from this, whatever loan you are giving, at least this has to be the rate. The minimum rate is going to be at least yield of government security closest to the tenure. Right, when we compute this 60% of paid up share capital, we have to take capital as both preference plus equity, as well as we deduct call scenarios which have not been received, because we are computing paid up capital. So whatever has been received, that only is taken. There has to be no subsisting default with respect to deposits. If there is, you cannot go for LGSI. Disclosure has to be fully made in the financial statements. Okay, full disclosure in financial statements. Apart from this, there is a register for LGSI which is being maintained, MBP2. This register is also going to be open for inspection by the members, and there is contravention. If the company contravenes these provisions, minimum fine 25,000, maximum 5 lakhs. So your fine can range between this. On the company and officer in default, imprisonment less than equal to 2 years, and again fine between that. Fine. Section 187, a very small section. Whatever investments you are holding, whatever assets you are holding, whatever securities you are holding, it has to be in your own name and in your own possession. Simple. That is the general rule. So company, if it is holding any investment, it has to be in company's name only. However, there are certain exceptions. Sometimes it is important that you have, for compliance of law, you have to hold it in your nominee's name, hold shares. Sometimes you give it to the bank for collection of dividends. Sometimes you have to transfer it to the bank for facilitating sale. Sometimes you transfer it, rather give it as a pledge for obtaining loan. Sometimes when your shares are in demat form, you're not the registered owner, your depository is the registered owner and you're just the beneficial owner. So in these situations, investments might not be in your own name. For this, you have to prepare a register in MBP3, which is going to be kept at the registered office, preserved permanently, and is going to be open for inspection. Section 188, again we have a punishment also for this, 5 lakh and 50,000. Okay. Section 188, related party transactions. Now, see, whatever transaction is happening between the company and its related party, not all the transactions are covered under section 188. First of all, if they are at arm's length price in the ordinary course of business, they are not covered. Secondly, if they are not at arm's length price in ordinary course, then we have to check whether they are covered under the specified 7 transactions. What are the specified 7 transactions? Sale, purchase or supply of goods or material, disposing of property, leasing of property, availing or rendering of services, then with or without agent, that is clause E. Then appointment of OPP, office or place of profit, underwriting of securities. So these are the 7 specified transactions. If the company enters into a contract or arrangement with related party, the transaction which is specified under section 188, you need BR. If it exceeds the limit, you also need OR. Simple. For BR, notice of board meeting will be sent with agenda explaining everything. At board meeting, resolution will be passed. The interested director is abstained from participating and voting. Next thing is we have to check whether it exceeds the limit or not. If it exceeds the limit, then notice of general meeting will be sent along with the explanatory statement and the ordinary resolution will be passed. Related member will not vote. If it does not exceed, no OR is required. No OR is required, right? Transactions between 100% subsidiary and holding, no OR is required. Whatever transaction is being entered with the related party will be adequately disclosed in board's report. The next question arises in our mind that, ma'am, what is the limit? What is the limit? If it exceeds limit, we need OR. But what is the limit? The limit, sale purchase of goods material with or without agent, more than equal to 10% of turnover, OR. Property more than equal to 10% of net worth. Leasing more than equal to 10% of turnover. Services more than equal to 10% of turnover. 2,50,000 per month and 1% of net worth exceeds that. Now, if the contract needed approval from board or approval from members, but that necessary approval was not acquired and the transaction took place, the contract was entered into, what happens in that case? Does the contract become void? The answer is no, it becomes voidable. First of all, it can be ratified within 3 months. Even if it is not ratified, it becomes voidable at the option of the board or the members, whatever the case be, right? If there is any director who is involved, he is going to indemnify the company for the loss. Okay, you have the penalty. In case of listed company, 25 lakh. In case of unlisted or others, 5 lakhs, right? Now we have very small sections remaining. Section 189, the register. So for section 184, for section 188, you have to maintain the register. MBP 4, the register is going to be preserved permanently, kept in the custody of company secretary. When we give disclosure under section MBP 1, that details are going to be included in the register. Register will be kept at the registered office. It is going to be open for inspection, produced at every general meeting, and there is a penalty for non-maintenance, that is 25,000. Then comes section 190, which talks about the contracts of employment with MD or WTD. See, whenever a company is appointing MD or WTD, it enters into a contract of employment. If there is no contract of employment, then it will at least have a memorandum of understanding where the terms are being boiled down to writing, right? Whatever it is, it has to be kept at the registered office of the company, and which is going to be open for inspection for members. This is not for private companies. So only in public companies this is going to be an open thing for members, right? Again, there is a penalty, fine less than equal to 25,000 and 5,000 respectively for company and officer in default. Section 191 is somehow related to 202, because here we compensate for the loss of office. Section 202 gives compensation only to MD, WTD and manager. However, this section gives compensation to all the directors. In case of sale of undertaking, sale of shares, takeover, there is any loss of office to the directors, then they can get compensation which is not going to exceed the compensation given under section 202. So within that limit, the compensation can be given. Compensation can be given undoubtedly to the executive directors as well as non-executive directors. So when I am talking about executive directors, there are some restrictions. Since they are involved directly in repayment of deposits, repayment of debentures, repayment of bank loan, taxes, then payment of employee dues or dividend to preference shares or redemption of preference shares, if there is any default in all these, they will not be entitled to get compensation. The non-executive directors will still be entitled, but they will not be entitled, right? Moreover, an additional point to note over here is with respect to the quorum. Usually, see one more important thing. When we are talking about section 191, we give compensation to all the directors by passing ordinary resolution. So when we are passing ordinary resolution, it may so happen that the meeting was adjourned, and at the adjourned meeting also the quorum was not there. So deemed quorum and the resolutions were passed. This shall not be passed. No deemed approval in case of this section. Okay, penalty 1 lakh. Then we come to section 192, restrictions on non-cash transactions. That is a kind of barter system. Again, this is not going to happen unless OR is passed. So if you want to enter into any transaction with the director which is non-cash, you have to take prior approval by OR, and the value shall be determined by the registered valuer. If it is not so obtained, if the approval is not so obtained, the transaction will be voidable at the option of the company. Okay. Lastly, we have section 193, that is contract by one person company. It is absolutely nothing. One person company is entering into a contract with the sole member who is the director also. So what disclosures you will give, what board meeting you will hold, what permissions you will take, nothing required. You just have to enter it in the minutes book, and you have to inform the ROC within 15 days about the transaction into, because he is a related party, right? So that's how things will take place. That's it with this particular chapter. Okay, let's now revise the chapter of inspection, inquiry and investigation, starting from section number 206 till section number 229. So it has quite a few sections. The initial sections, that is 206, 207, 208 and 209, relates to inspection and inquiry, and the latest sections are all about investigation except a few parts which apply to all the cases. Now, there are three terms involved in this particular chapter, as you can very well see: inspection, inquiry and investigation. What do we mean by these three terms? Of course, these three terms are different, and you have to understand the difference, then only you will be able to understand the provisions. Inspection is something that happens, examination of books and accounts. Inquiry is like asking people, interrogating people and all that who are involved. And investigation is something which is next level, the detailed examination of things. So maybe first of all, inspection is being ordered, and if the result of inspection creates even more suspicion that there could be some fraudulent activities going on in the company, then that results to investigation. So then investigation commences. Okay, so we have a whole flow of things. Let's start with section 206. Undoubtedly, this is a revision class, so not everything in absolute detail, but I'm going to explain you in such a manner that you understand the whole chapter. Section 206, company files a document. Undoubtedly, we all know that with ROC, a lot of documents is being filed, a lot of information is being received by ROC. Supposedly, ROC receives any piece of information for which ROC finds that the piece of information is creating some suspicion or is incomplete, and seeks for more information. So at that particular point of time, ROC sends the first notice to the company. First notice, not for inspection, not for inquiry, not for investigation, but just for seeking some more information. On receipt of information, there are possible cases that you reply or you don't reply, and even if you reply or you reply with some extended time, the reply may be satisfactory, the reply may be not satisfactory, or the reply may be inadequate. So in case when the reply is not satisfactory, the reply is inadequate, or you haven't replied at all, in all these three cases, registrar gets a reason to go for inspection. That means it will call complete books and accounts and papers and inspect them, right? So it gets a reason to do so. It will record the reasons and send you the second notice, which is of inspection. So now again, calling of books and accounts, not just some piece of information, but books of accounts for inspection. Right. How inspection will be carried out? Inspection will be carried out according to section 207. Here one more power comes into picture, which is of central government. Central government may also, if it deems fit, can order inspection. So maybe ROC carries out inspection on its own, or CG appoints some inspector and that particular person carries out inspection. So quite possible there are two cases. Whatever it be, even if registrar or inspector, whoever is carrying out the inspection on whatever grounds, They prepare a report of their inspection which they are going to submit to central government, right? Now when they submit the report, they also give a recommendation that what is their analysis, what do they suggest, that is there, could there be a probability of fraud involved? So should they go for investigation? What do they recommend? It's only their recommendation. This does not bind central government to initiate investigation. Okay, so it's just their recommendation. So report made and submitted to CG under section 208 with recommendation, then CG may carry out investigation. Now inquiry is also given in the same section 206, which tells us that any piece of information, again anyone approaches registrar or registrar receives some information and registrar is satisfied that some fraudulent activities are going on in the company, or there is non-compliance of provisions, or the grievances of people are not being addressed. So in these three situations, what will registrar do? Registrar will inform the company that these allegations have been imposed against you. If company can give an adequate reply, great. Otherwise, registrar will give an opportunity of being heard to the company undoubtedly, and thereafter initiate inquiry. In the same manner, CG had the power to initiate inspection. Here also CG also has the power to direct inquiry. So CG may appoint inspector for the same. So, and they'll carry out inquiry. So registrar or inspector can carry out inspection or inquiry as given under section 206. How they carry out inquiry or inspection as given under section 207. So after the order of inspection or inquiry is passed, registrar or inspector, they call for books of accounts and other papers, and it is going to be the duty of the officers and employees, past plus present. They are going to produce books and papers, furnish information and give all assistance. If they don't, imprisonment and or fine, and if they do, then registrar is going to conduct inspection or inquiry. What powers are given to them? They get the same powers as of civil court. They can also place identification marks, take copies of the books, papers, etc. And after they have completed the inspection or inquiry, they will submit the report to central government as given in section 208. Now, sometimes it may also happen that central government wants report in between inspection. The inspection is yet not over, inspection is going on, and central government wants some report, updation as to what is happening. In such cases, you have to submit interim report. So ROC or inspector will give interim report to CG if they so direct, and otherwise on completion of investigation, on completion of inspection or inquiry, final report shall be submitted. Now this power to receive report has been delegated to regional director. Next we have the section of search and seizure. This power is also given to registrar or inspector, but they have this power only when they take approval from central government. Sometimes it may so happen that they know, or during inspection or inquiry they come to know that there might be a situation that some documents of the company are missing, and these documents may be destroyed by people involved, or they may be mutilated, they may be secreted, they may be falsified. In such situations, you go to the special court, you obtain the permission of special court, not of CG but of special court. So registrar or inspector, after obtaining special court's permission, they can enter into the places, they can search and seize the documents. Seize documents means you are taking the documents into your custody. Now when you are taking the documents into your custody, the company might ask for some photocopies, so you will allow them to take photocopies and seize the documents and take them with you. There is a limit of 180 days. that you can keep these seized documents only for 180 days and thereafter you're bound to return them. If you want to examine more, then you can again call them back, right? So you have to remember two important points in section 209, which is entering into the premises with special court's permission and keeping the seized documents only for 180 days. Why am I telling you to remember these two important points? Because when we read the seizure under investigation, this is a seizure over here. When we read about search and seizure under investigation, that is section 220, then these 2 points are missing in that section. No restriction to inspector under investigation. They don't need to seek any approval from special court. Moreover, they also don't have this restriction of 180 days. So exactly replica section is 220 with that difference. Okay, so that we will read. Now, these were the 4 sections relating to inspection and inquiry. Now we start with the sections of investigation. We have 5 sections of investigation. 3 sections about investigation into affairs of the company, 1 section about investigation into membership of the company, and another section about investigation into affairs of other companies, related companies you can say, right? So 210, 212, 213, 216 and 219. So we have these 5 sections of investigation. Now we are talking about the first 3 sections first. That is, you are investigating into affairs of any company, right? What happens? When can you investigate? That is the first question. When can you investigate? See, after submission of a report by the inspector or ROC, after they have done inspection or inquiry, they submit the report to central government along with the recommendation. Central government receives the report and central government, based on the report, decides whether I want to carry out further investigation or not. So on receipt of report, CG may order investigation. Secondly, the members of the company have a very strong doubt that some fraudulent activities are going in the company, so they pass a special resolution and they send the special resolution to company by suggesting that it is our wish that you must carry out investigation of this particular company. Again, CG has a choice. It may not. And in public interest also, CG may do so. So section 210, there are 4 grounds. There are 4 grounds on which investigation may be carried out by central government. However, the 4th ground, that is in front of NCLT, some proceedings are going on where NCLT or court discovers that this company has some problems, some serious issues, and investigation must be carried out. So NCLT directs CG to carry out investigation. So since an order is being passed, it is the duty of central government to carry out investigation. So in the first 3 instances, CG has a choice. In the last ground, as mentioned in section 210, CG doesn't have a choice and must order investigation, right? So whatever it be, CG may order, CG must order. The order of investigation has been passed. After passing the order of investigation, CG appoints an inspector. CG appoints inspector. In some cases, if CG finds that the case is big, the case is huge, the case is serious, and it needs more expert people to be employed to investigate into the fraud or the scam, possible scam, then in such a situation, CG doesn't appoint inspector to investigate into the case, rather assigns the case to a special dedicated office, which is SFIO. Serious Fraud Investigation Office, just like we have CBI. Okay, that is section 212. I told you there are 3 sections of investigation into affairs of the company. One is 210, where there are 4 grounds on which CG orders investigation. Second is 212, where CG assigns the case to SFIU. And third is 213, where members don't go to CG by passing SR. Rather, some eligible members go to NCLT and files a complaint. They file an application, and NCLT in turn, if finds suited, then orders CG. So you make a direct application to NCLT, and NCLT orders CG, and thereafter investigation takes place. Ultimately, CG is only doing the investigation. CG is either appointing inspectors or assigning the case to SFIU. But then there are 3 sections. I hope you get that, right? Now section 213, where who can make an application to NCLT? Either the members or any person. Which members? If the company has share capital, then at least 100 members or members with 10% voting power. If the company doesn't have share capital, then 1/5 of the members. They become the eligible members. With supporting documents and reasons, they can make applications seeking investigation to tribunal. Or any other person can make application. But when any other person make application, tribunal has to be satisfied of any fraud or any unlawful activity, any oppression. If the company is formed for unlawful purpose, the management or the promoters are involved in fraud, or the members are not being given complete information. So in such situations, tribunal, after giving reasonable opportunity of being heard to parties, then decide about investigation, that whether investigation should be carried out or not. And if tribunal decides that yes, investigation should be carried out, then it is going to direct CG the same, and CG is bound to order investigation. CG cannot say that okay, I'll see whether it has to be done or not. No. So CG will appoint inspector, and the inspector will prepare a report and give it to central government. Okay. Now comes into picture SFIU. What is SFIU? The establishment of SFIU is given in section 211, which is not a very important section. It just tells us about the composition. CG has the power that by notification it can establish SFIU, and it has done that. Head office, Delhi, it has director, it has experts, it has the number of employees, the terms and conditions as prescribed, etc., etc. Now, the important section is 212. Where central government assigns some cases of investigation to SFIU. Which cases, ma'am? That is completely a discretionary choice of government. However, in these 4 cases, government can do so. When government receives a report under section 208, when SR is being passed by the company in public interest, which is an open ground, and on request from Department of CG or SG, central government is of the opinion that investigation must be carried out by SFIU only, then it assigns the case to SFIU. When the investigation is started by SFIU, all other investigating agencies will stop their investigation. Whatever their findings are, they are going to give it to SFIU. Fine? Okay. Now, what will SFIU do? SFIU, the director of SFIU, that is the highest authority, will appoint an investigating officer who will also be called as an inspector under the Act. That person is going to conduct the investigation in the prescribed manner. Ma'am, it has to be a detailed evaluation, a detailed examination. So what do you think? How much power should be given to him? That means who he can call, who he can ask, where can he go, from where can he extract information, what can he arrest, etc., etc. So what powers are given to him? He is given the powers which are given under section 217. So we have a separate section for the powers which will be given to him. Okay, as of that matter, the powers which are given to any inspector during investigation. Apart from the general powers which are given to inspector, he also has a power, a very special power that you will not see in Companies Act ever. And the subsection which is very important, 212 subsection 6, 212(6), that gives the power to arrest. So the offences under this section are cognizable. That means people can be arrested even without warrant. However, not anyone can go and arrest them. Someone not below the assistant director, that is assistant director, additional director and director. On these orders only arrest can take place. Right? So if someone is found guilty of offence, that means I get some material information during my investigation and I'm sure that I have this evidence and I know that this particular person is involved in fraud. So I can arrest that person if I have that authority, undoubtedly. So I can go out and arrest that person. Now when I arrest that person, I have to do two things. First, arrest order plus this material information I have to give it to SFIO so that my department clearly knows that this arrest has taken place on these material grounds. Secondly, I have to produce this person in front of the magistrate or court within 24 hours. Now, when I present, the other person would want a bail, right? Bail will not be given so easily. That means there are strict conditions of bail. Bail will only be given when public prosecutor has been given an opportunity to oppose the bail. That means government lawyer. Our lawyer will go and oppose the bail. So once he opposes the bail, then court has to decide. If court is satisfied that this person who has been arrested is not guilty and he must be released on bail, he is an innocent person, he will not commit any offence when I release him on bail. If court is satisfied of that thing, then only the court will release him on bail. But sick, infirm, under the age of 16 and women, these are the four people who get relief. That means even if special court, if they want, they will not give an opportunity to public prosecutor to oppose the bail and grant bail. So it is at the discretion of special court in those cases. Okay, so here we have the whole part of arrest. Here we have the whole part of arrest. The inspector appointed will carry out the investigation, submit the report to central government. If central government directs, then it will also submit interim report, otherwise just the final report. And the report may state that yes, these people have committed fraud. So CG will take an action in pursuance of the report. What will be that action? CG will direct SFIO that okay, file the complaint and start the prosecution against these people. That means the legal proceedings will be started and adequately they will get the punishment. If some person has got some benefit, then to recover that benefit, CG will file an application with NCLT, and that is known as order of disgorgement. So NCLT will pass an order of disgorgement, that is for recovery of all the illegal gains that have been made by the persons, right? Okay. So that was about investigation into affairs of the company. Moving on to investigation into membership of the company. Sometimes it may so happen that on record there is another member, but actually the benefit is being passed on to some other member, which we call as beneficial owner also, as we have read in section 89 and 90 of the Act. Significant beneficial owner and all that part. So sometimes it may so happen that the control is being projected as in someone's hand but is actually not in that person's hand. So sometimes you need to figure out who the real owner is, then only we will be able to establish that what is the fraud, where the money is flowing and a lot of other things. So if a complaint is being made by some person or suo motu by government or by reference by NCLT, then CG shall order, and in these situations CG may order investigation into membership. Right, to determine who are the financially interested people, who are able to control the policy, who are beneficial owners, etc. So for this regard also, CG shall appoint inspector who shall investigate into matters relating to the company and membership and shall report it to central government. Now, when you are discovering about the membership or when you're discovering about the ownership, it may so happen that you want certain restrictions to be imposed upon securities. You want to find out who the security or where the benefit is going on, and before you could reach that person, the transfer of securities is taking place from one person to another, another to another. So you want this to break. In such situation, or if any person files a complaint, then tribunal understands that I must find out the details about this particular security, and to find out the details I must put some restrictions. In such situation, tribunal can put restrictions, but not for more than 3 years. This is something which is very important for you to remember, that tribunal, although has been given the power under section 222 to impose restrictions, yet the restrictions cannot be imposed for more than 3 years. Okay, now investigation into affairs of related companies. Related companies does not mean the related party definition that we have read. Related companies means the companies or the entities which have been specified in section 219 only. So when an inspector is investigating into the affairs of a company under these 3 sections, he believes that to find out the whole truth, I also must investigate into these related companies. Then after taking approval from CG, he can do that. Now, what are the related companies? Subsidiary, holding, subsidiary of holding, it could be past also, managing director, manager, employee, any body corporate which is being managed by the managing director or manager. It may so happen that currently you're the manager and it was being managed by the past, or currently it is being managed, you are the past manager, so is, was, it could be, right? Any body corporate whose board of directors includes the nominees of these companies, or any body corporate whose board of directors are acting according to the directions given by the directors of this company. So in such situations, there is a link between these 2 companies, and quite possible there are a lot of transaction flows from one company to the other related company, and to find out the whole truth where the actually money is going, I need to investigate into affairs of these companies also. So after taking central government's approval, you can do that. Next is section 221. Next is section 221, which talks about freezing of assets. Freezing of assets of a company. Freezing of assets of a company. See, if central government makes a reference, or if a complaint is made by members specified under section 244, that is oppression and mismanagement, or if creditors file a complaint, the creditors who have at least 1 lakh amount outstanding, or any other person, they file an application to tribunal, and tribunal believes that company might be disposing of, might be selling off some assets which is not in the best interest of the company, which is prejudicial to the interest of creditors, members, then in such a situation, tribunal can put restrictions on these assets, just like it was putting restrictions on securities to find out the whole truth. It is putting restrictions on assets also. It is freezing the assets. That means it is giving the directions that you cannot remove, transfer or dispose of the assets. But again, the restriction is going to be for maximum 3 years only. It cannot be for more than 3 years. It cannot be for more than 3 years. Okay, ma'am. Now, section 220. I told you we have a section 209, which is exactly replica of 220, except for the two differences that I told you. So during investigation, if inspector has reasonable grounds to believe that books are going to be or are likely to be mutilated, altered, destroyed, falsified, secreted, then inspector may enter, seize and search and seize documents and return them on completion of investigation, not within 180 days, and no permission from special court. Okay. Fine. Okay. Now, the next section that we are going to discuss is inspector's report. Here I'll give you some clarification. We have read about inspection and inquiry and its report under section 208. So, when inspection or inquiry takes place, the report is submitted under section 208. When investigation takes place, the report is given in section 223 and the action that has to be taken after receipt of report is given under section 224. However, when investigation is being carried out by SFIO, then what report has to be submitted, in what manner, what actions shall be taken after submission of report, all that part is given in section 212 itself. Okay, so section 223 as well as section 224, it is about investigation, it is for the cases of investigation, except section 2112, that is SFIO. Fine. So apart from the inspector appointed under section 212, all other inspectors after investigation have to submit a report undoubtedly to central government. If central government wants an interim report, then you also have to give an interim report. The report is going to be obtained the report is going to be authenticated by seal or certificate of public officer. Remember, I explained you the whole procedure of public officer in the class, in the main class, right? That who is a public officer, how the things happen, so that you get that practical knowledge as well. And a copy may be obtained by making an application to central government. So if you want to know what is the result of this particular investigation, what happened, what was the scope and everything, you can obtain the copy of it by making an application to central government. Central government is going to give you that. Okay. Now, when central government receives the report, what actions it can take in pursuance of the report? Central government receives the report, central government studies the report and finds out that okay, these 5 people were involved in fraud. So undoubtedly these 5 people have to get punishment. So central government will initiate prosecution against these people. So legal proceedings will be started and adequately they will be punished. Now, this is one thing. Central government, after receiving the report, finds out that it's important that the company must be closed. So we must sell off the assets, pay off the liability. So winding a petition may be filed by CG. It may also so happen that central government finds the case of oppression or mismanagement, and hence CG files an application to NCLT for obtaining relief from oppression and mismanagement, or both application may also be filed. So first thing, CG initiates prosecution against the defaulters. Second, makes an application for winding up or relief from oppression, or both. Third, files a suit for recovery of property or damages. It may so happen that the company involved has lost a lot of property because of fraud. So for recovering that property, CG has filed a suit on behalf of the company. And when CG has filed a suit, CG will be indemnified by the company because CG is recovering the property on their behalf, right? And lastly, disgorgement. If someone has got illegal gain out of this fraud, then that money can be recovered from him. How? CG makes an application to Tribunal, because Tribunal is the judicial authority over here. CG is not the judicial authority. So CG will make an application to Tribunal. Tribunal will pass the orders of recovery, that is orders of disgorgement. Okay, fine. Now, see, we also have a section 225 and 214, which are both related type of section. Often there is a confusion amongst students that, ma'am, so much of investigation is taking place, then who is going to bear the expenses of investigation? That is the question, right? See, one is section 214, which initiates, just to rule out not so serious applications. What happens if someone has filed a complaint to CG, or there is SR being passed by the company and CG receives that SR and CG initiates investigation. Before appointing inspector, it will ask the applicant that you deposit a sum not exceeding 25,000 as a security, because we are going to take an action on your request. What if the request is some fake evidence and some false request? So you submit some security. If this turns out to be false, then you will not get your money back. But if this turns out to be true and actually some fraud has taken place and this results in finding someone as guilty, then this money will be refunded to you. So if it doesn't end up in prosecution, then we will use that money to carry out the inspection investigation, and we will take the help of company, whoever is involved in whatever not so in order things. Otherwise, if this results in prosecution, that means the end result of investigation is such that we find some people guilty. So whoever has been found guilty, we will recover from them. If the investigation ends up in recovering some property of the company, then from that property, central government will have first charge on that property. It can use that property to reimburse the money. So all that portion is given in section 225, right? So that's how central government obtains, or central government gets money to carry out this process of investigation. If it doesn't end up in prosecution, of course, the applicants and the company concerned. Fine. Okay. Now, procedure powers of inspector, section 217. So whoever is carrying out investigation and some part of inspection and inquiry, they have these powers. What are the powers? They can call for information, and it will be the duty of past plus present officers to preserve books, to produce books, and to give all assistance. Now, whenever an inspector is taking books, they can keep them in their custody for only 180 days. Ma'am, earlier you told that there is no limit. I told that there is no limit under section 220. That is the section of seizure. This is a normal section when you ask for books and papers and you have taken books and papers. There you have entered into premises and you have seized the books and papers. Okay, so that is the difference. Now you can examine people on oath. Which people? Anyone? No, not anyone. The employed officers, you can examine them on oath, but if you want to examine some other person, then you have to seek approval from CG, and then you can do that. You will get the same powers as of civil court. All the police, other authorities, government, they all are going to provide you assistance if needed when you take the approval from CG. There is one special point in section 217 which talks about reciprocal arrangements. What happens in that? See, it is very easy to discover truth, find out evidence, inquire people in our country. But when the laws change, to get evidence from a foreign source is extremely difficult. For that, If we want to obtain some evidence from a foreign country, we have to check whether our government has a reciprocal arrangement with them or not. If they have a reciprocal arrangement, it gets extremely easy. How? We will tell our Indian court that there is an evidence which is out there. Indian court will send a letter of request to foreign court. Foreign court will summon that person who is concerned, will inquire that person, will collect evidences and give it back to the Indian court, and Indian court will give it to the inspector concerned and he will prepare the report. Likewise, since it is a reciprocal arrangement, so give and take, foreign court, if they want some evidence from our country, they will send a letter of request. Our government will forward it to Indian court. Indian court will either summon the person himself or call the inspector and assign the case to him. Inspector will investigate, inspector will prepare a report, collect evidences, give it to the court, court will give it to the government, government will give it to foreign court. I hope you get the procedure. So it's give and take. These reciprocal arrangements may be there. Okay. Now, another section, protection of employees. The employees get sometimes scared to disclose the insider information of a company during investigation just because they may be fired later. To protect them, if an investigation is being carried out under these sections, all the 5 sections are mentioned over here, or some pendency of proceedings of prevention of oppression and mismanagement, in both these cases, if the company proposes to suspend an employee, dismiss him, demote him, right, or change his terms of employment to his disadvantage, then in all these cases it will not be allowed unless you take approval from tribunal. So you have to file, the company has to file an application to tribunal that I am proposing to dismiss this particular employee when the investigation is going on. The tribunal will not give you a reply like, okay, fine, you dismiss him, or don't dismiss him. No, you have to wait for 30 days. Within 30 days, either tribunal will send a notice of objection or tribunal will stay silent. If you don't receive any objection notice from tribunal within 30 days, then company can proceed and take action against that employee. Okay. Now, if tribunal objects and the company is not satisfied with it, company can file an appeal to NCLT within 30 days. Okay, apart from this, we have section 226, which is a very small section and states that doesn't matter you have passed SR for winding up, doesn't matter any winding up proceedings are going on, doesn't matter there's an application for oppression and mismanagement. These things are not going to affect the investigation. So despite that, if an investigation comes into picture, it is going to be carried out. We have another section, section 227, which tells us an inspector cannot compel the legal advisor to disclose any information other than client's name and address. Likewise, an inspector cannot compel banker to disclose any information other than information related to the company concerned. Banker cannot be compelled to disclose information of other customers, right? And section 228, which tells us that the provisions of inspection, inquiry and investigation are going to be applicable to foreign company also. And section 229, that if in the whole process you do some fraudulent activity, that means you give some false answer to the inspector, you make some false entry, you try to destroy some paper, anything like that, then you will be attracted to the section of fraud. What is the section of fraud which gives the punishment for fraud? It is section 447, right? So that's it with the revision of inspection, inquiry and investigation. Okay, let's now revise the chapter of compromises, arrangements and amalgamation. In this chapter, we have sections 230 to 240. Not a very huge section, but sometimes the students don't understand the underlying concept in this chapter. and hence they end up thinking that this is a very boring chapter. However, if you ask me, this is the most relatable chapter to your practical life. If you have to, or if you're planning to pursue your career somewhere in the field of mergers, acquisitions and life, then undoubtedly this is one such thing that you must know. If I share with you, although we have discussed all this in our regular class, but if I share with you one of the scheme of compromise, scheme of amalgamation arrangement, you can clearly see that under sections 230 to 232 of Companies Act 2013. So this is not something which has been drafted by me, but it is the scheme of amalgamation which actually happens in the real life, in the practical world, between Bharti Infratel and Indus Towers, right? So actually you find the relevance of the section. It is absolutely, of course, along with other provisions, this is something which is very important. Now, since it is a revision class, we cannot go into very much depth about the terms, and I have already explained you the terms. However, the chapter involves three broad terms, that is compromise, arrangement and amalgamation. If I talk about compromise, compromise means some type of sacrifice. The sacrifice could be between members and the company, or between creditors and the company. So might be creditors are sacrificing something for the company. Maybe the company is not in a very good financial state, and so the creditors are sacrificing some portion of their debt, or maybe some interest portion or something like that. So that is a scheme of compromise that's taking place. Arrangement is a kind of residuary terms which includes every other thing which is not compromise or amalgamation. It could be some reconstruction of capital, alteration of capital, etc, etc. Now, what do you mean by amalgamation? Although the chapter heading uses only the term amalgamation, when we switch to the sections, we find the term merger, amalgamation, demerger, all of that. So what do we mean by that? If I talk about merger, it could be by formation of a new company, or by acquisition. By acquisition means, or by absorption means, x plus y is equal to y. So you don't form any new company, an old company absorbs another company into itself. Or the merger could be by formation of a new company. So I could say that maybe A plus B is equal to C. So there is a new company which has come into consideration, and two old companies have lost its existence. Now when I switch to amalgamation, amalgamation could be in the nature of merger or could be in the nature of purchase. In the nature of merger, if it satisfies all the criteria, right, and if it doesn't satisfy all the criteria, then it's going to be in the nature of purchase, right? That is something which is not needed, because the act does not identify or does not recognize any difference between two, and has not stated different provisions for amalgamation, merger in the amalgamation in the nature of purchase, demerger. No, there are like provisions for all these cases. Okay, and we have section 230 which is for compromise or arrangement, and section 232 which is for merger, amalgamation, demerger. However, section 232 is not complete. It does not give us an elaborate, a detailed and exhaustive procedure as to how merger and amalgamation should be proceeded with, and redirects us to section 230. So I hope you understand that the most important section of this particular chapter is section 230, undoubtedly. Fine. So we'll start with the revision. The very first section, section 237, where there is a power to make compromise or arrangements with creditors as well as members. So company may enter into any scheme of compromise or arrangement. As I told you, example could be internal reconstruction, example could be some debt restructuring and like things, between company and creditors, between company and members. So in this situation, they have to take permission of NCLT. For taking permission, they will make an application. There is a whole procedure which has been given under section 230. It starts with making of an application. members, creditor, liquidator or company, they can make an application in form NCLT 1 to NCLT. This application will be accompanied with the affidavit containing disclosure, copy of scheme and fees. Now this may be accepted, this may be rejected. Once it is accepted, the next step is that NCLT orders to hold meeting. Hold meeting of whom, ma'am? NCLT is concerned that are all the creditors, are all the members who are concerned, who are involved, happy about it, right? Are they happy and have they actually approved it? That is the main concern of NCLT at the first place. So NCLT asks the company that send notice to your creditors and members and take their approval, and thereafter report to me whether they have approved or not. Then we will consider and sanction your scheme. Okay, so NCLT orders to hold meeting. Chairperson calls the meeting by sending notice. The notice which is sent to the members, to the creditors, is accompanied by the details of compromise or arrangement, valuation report, effect and other matters. At the same time, one notice is also sent to the statutory authorities. Statutory authorities could be income tax, could be central government, SEBI, Registrar, Stock Exchange, Competition Commission of India and all that. Why it is sent to the statutory authorities? To seek objections from them. If they have any objection, they can also give objection within 30 days. Okay. Now this notice is also advertised English newspaper, vernacular newspaper, and is placed on the website. If it is a listed company, it's also sent to Stock Exchange and SEBI. Fine. Now, after sending this notice, advertising it, placing it on website with all these details to creditors and members, then the meeting is held. In the meeting, the creditors members will vote. Accordingly, they will give their approval, right? Fine, they will give their approval. How can they vote? They can vote in person, they can vote by proxy, they can vote by postal ballot. So an option of postal ballot is also made available to them. Now here, the approval is not a normal one. That is, if there are 1,000 members, we cannot say that if 600 members have approved, then we accord the approval. No. The approval is a two-way approval. Majority of members holding or representing 3/4 value, and this is not of total, it is of the members who are present and voting. Okay. So if the number of members is 500, then majority comes out to be 251. So at least 251 members holding 3/4 value share capital. Say supposedly the share capital is 10 lakh, then at least 7,50,000 share capital should be held by these 251 members who have given the approval. If that is so, then only we will consider the scheme to be approved. The same goes for the creditors also. Creditors majority in number representing at least 3/4 value. Okay. After this approval is taken, the next thing is that NCLT also needs auditor's certificate that whatever accounting treatment is going to be taken place in the books, that will be in accordance with the accounting standards as well as Ind AS applicable, right? So after it has been approved, after CA certificate has been received, then tribunal sanctions the scheme, of course after considering the objections of statutory authorities. Whatever order is passed shall bind everyone. However, the tribunal shall send the order to the company within 30 days, file it to registrar. What is going to be the contents of order? What is going to be the contents of order? Variation of rights, that is the first thing. Variation of rights means what? We have a section 48, which tells that if you have to vary the rights of a shareholder, then in that situation you need to take their approval, right? If it affects some other class, then you take approval of that class also, etc., etc. So there is a procedure which has been given. In case your compromise or arrangement is somehow altering the rights, then you must follow section number 48. Section number 48. Okay.
Then to dissenting shareholders, exit offer is given. Conversion of share capital. When preference share capital is being converted into equity under a scheme of compromise or arrangement, supposedly there was some preference capital on which preference dividend was not paid for 4 years. Now under a scheme of compromise, they are converting. Under a scheme of arrangement, they are being converted into equity. Option will be given to them that those pending 4 years dividend, either you take in cash or an equivalent amount of shares. Get that converted into an equivalent amount of shares. Fine. Then all the proceedings of BIFR shall abate. What do you mean by proceedings of BIFR shall abate? See, if it is a sick company, it moves to BIFR to revive itself. Now, supposedly we have interacted with our creditors and the creditors have somehow reduced our repayment burden in some manner. Now the company itself is in a position to grow. Earlier the company, all the money that the company was earning was going into the EMI. Now it has been relaxed and the company has funds to invest into the core business and thereafter earn huge profits. Right, so there is a ray of hope that the company will automatically come back to its good financial state post this compromise or arrangement, and hence that BIFR proceedings are not required, so they shall come on hold. Okay, so and this buyback or reduction of capital, what I have written, it simply means that if you have to go for buyback, then you will also follow the scheme of buyback, that is you have to follow section number 68. Okay, and now we come to section 231. Tribunal has sanctioned the scheme. Tribunal has the power to supervise its implementation, make modifications as and when needed to implement, give directions, and if at all tribunal finds that it is impossible to implement the scheme in a manner as it was sanctioned and it will not bring a raised effect, and if not implemented, the company will not be able to pay its debts. That means company is in a kind of insolvency state. Then in such a situation, tribunal might pass winding up orders, that is closing down the company. Okay. Fine. Now we come to section number 232. Merger and amalgamation of companies. So we are talking about the case of merger, amalgamation, demerger, all of that. Whenever an application, here also you need NCLT approval, here also there is a whole elaborate procedure and exactly the same procedure as we have read in section 230. However, the section is different, and so we cannot say that if I am talking about a case of merger, I give my answer in accordance with section 232. No, in accordance with section 230 to 232. Fine. Okay. So applicant makes an application to NCLT for seeking approval. NCLT finds that the application relates to merger, amalgamation or demerger. So it will order the meeting of creditors members any class as it does in section 230 also, and the same provisions of section 230 will apply. That is, the notice will be sent to persons, advertisement, website, everything, statutory authorities notice, then approval will be taken from members or creditors and thereafter scheme will be sanctioned. Okay. There is one more point which is written over here, objection allowed, which I haven't explained you in section 230. What do you mean by objection allowed? It is very important point. Okay. See, some of the members or creditors, since the company got the approval as needed of 3/4 value majority, so the company proceeded with the scheme, but there might be some people who are not very happy about it. See, there are two types of people, one who are not happy but still they accept it, and ones who are not happy and become rebellious. So these are the rebellious ones, they want to oppose. We have to check, are they capable enough to oppose, because capability criteria has been specified. Who is eligible to oppose, that has been specified. Who can object more than equal to 10% of share capital or more than equal to 5% of debt in the case of members
and creditors respectively. Okay, so this is how that is going to take place. The same objection criteria is specified here also, because the same provisions apply in this case also. But ma'am, undoubtedly there should be something different in section 232 or something additional in section 232, because we have a separate section for mergers and amalgamation and a separate one for compromise and arrangement. So undoubtedly there is some difference. Yes, there is. There are two major differences, or there are two major additions in case of merger and amalgamation. One, you have to circulate additional documents. Two, your scheme will contain for these. Okay, so along with the notice, there are some additional documents which have to be sent, that is draft notice, draft scheme, complete scheme. There was only then it's confirmation that it has been filed with ROC, valuation report, financial statement, or you can say supplementary accounting statement if it's not in all cases, if the financial year end was 6 months ago. So in that case, a supplementary accounting statement, the report by directors with regard to effect of merger and amalgamation along with the exchange ratio, what is the price they are going to get and all that, right? So this will additionally be circulated along with the notice if it is a case of merger, amalgamation, demerger. If all the conditions are satisfied with and certificate of auditor received, then tribunal may sanction the scheme. Now the scheme must contain for these following, since it is a case of merger, amalgamation or demerger. After it is sanctioned, the order is sent to the company and company files it with registrar within 30 days. This point I'll discuss little later. First we are going to discuss the orders. The points which must be there in the scheme, otherwise tribunal can pass orders in this regard. First is transfer of undertaking. Whenever a scheme of merger or amalgamation takes place, undoubtedly there is transfer of assets, liabilities. Sometimes it could be transfer of just one undertaking and like things. Whatever it is, you have to give adequate information about what is going to be transferred, how it is going to be transferred. Second is with respect to purchase consideration. So what are you going to allot? Allotment of shares, right? So order about that. Continuation of legal proceedings. The legal proceedings or the legal cases shall be now against the transferee company. So from transferor company, they'll come to transferee company. The transferor company, that is the old company which is being now merged into the transferee company, this company, all the assets, liabilities have all been taken over by this transferee company. Now this company is a kind of empty box which has nothing in it. However, it does not die because it has to die a legal death, since it is a legal person, so we have to dissolve it. So no winding up needed because it does not have any assets, liabilities. However, we must dissolve it, we must remove its existence. Okay. Then shares to non-resident shareholders. We have to make sure that FDI compliance is done. The employees of transferor company to go to the transferee company. Set off of fees. And before that we have listed companies. Supposedly a listed company is being merged into unlisted company. So this unlisted company will remain unlisted only. It will not become listed just because it has acquired a listed company. No, if you marry a celebrity, you don't become a celebrity, or you do actually become a celebrity, but here the same is not going to apply. And set off of fees. What is it? What do you mean by that? Supposedly A plus B is equal to C. So we have to incorporate a new company C. Incorporation fees is there, but these A and B, they are going to dissolve. So whatever fees have been paid by them, they can be set off. Other incidental matters, right? Apart from this, we have this another point, which is
The scheme of amalgamation merger takes quite some time, and if it is at a stretch of 2 years, 3 years, at the end of every financial year, within 200 days, there has to be a certificate of compliance certified by CA, CS, CMA, which is going to be filed with ROC. Okay, that yes, whatever scheme was sanctioned by tribunal, we are following the same. Now, merger and amalgamation of certain companies. This is also known as fast track merger, but it is not available for all types of companies. Okay. It is available for small companies. It is available for holding in its 100% subsidiary. It's available for prescribed companies, which are startups and startup with a small company. So in these 4 cases, companies, instead of going through that long route, they can also opt for fast track merger under section 233. What is the procedure that they have to follow under section 233 is a matter of concern over here. We don't need approval of NCLT. That's the most important point over here. Instead of NCLT's approval, we need CG's approval. Ma'am, how is it going to be fast then? Undoubtedly, taking approval from CG is way more easier than NCLT, because CG is as good as MCA, right? So we have to take that approval. But before that, we have to take approval from members and creditors. Members and creditors. So first of all, we take approval from members as well as our creditors. This is not the case in section 230 or 232, but here we have to take approval from both members and creditors. We sent a notice to seek objection to just 2 people, that is ROC and official liquidator, who is the officer of High Court. So we sent the notice. If they have objection, they will give objection, and thereafter, when we get sanctioned, when we get approval from our members and creditors, we file this with central government, and central government grants us approval and the scheme is implemented. So that's how the process works. Both the companies, that is the transferor company and the transferee company, they both file declaration of solvency with registrar, and this is a separate requirement. Here the process starts. First thing that they are going to do is send a notice inviting objections from registrar and official liquidator. And after that, you have to call meetings of shareholders, meetings of creditors, right? So you call the meeting wherein they are present, and you need to take their approval. How, ma'am? Approval has to be as it was in section 230? The answer is no. Here the criteria of approval is different. And you have to very well remember the criteria of approval under section 233 and section 230. They are 2 different things. There, majority number representing 3/4 value, dual type of approval was needed. Here, for members, you only need that members should represent at least 90% of shares. 90% of shares. And if it is creditors, majority representing 90% value. So here you need dual approval. Here you just need 90% of shares. Fine. Okay. If registrar or official liquidator wants to object, they can make objections within 30 days. They have a time period of making objections. Now, you called the members, you called the creditors, took their approval, you also sent notice to ROC and official liquidator. The next step is that after taking the approval, within 7 days, you file the scheme with central government, ROC and official liquidator. There are 2 instances which may happen. ROC or official liquidator have an objection, they don't have an objection. If they don't have any objection, central government finds no problem. Central government will register the scheme, pass the order of approval. The same order of approval will be sent to the company. Company will file it with ROC. The old company will dissolve and other transfer of assets, liabilities, all will take place. Okay. If objection is there,
or central government finds that it is not in the public interest that this merger should take place, then central government leaves the case and transfers it to tribunal. So central government makes an application to tribunal and requested that you consider the scheme under section 238 because you are more competent to do so. Now it is at the discretion of tribunal that they can sanction the scheme or process the scheme according to section 232. Fine. Okay, next is section 234, merger or amalgamation of foreign companies. So Indian company can merge into foreign company can merge into Indian company. The provisions are the same. So we have to follow section 230 to 232 only for this also. And here one important point that you have to remember is that foreign company does not mean company incorporated outside India and having a place of business in India, as we read in the definition. No, whether having a place of business in India or not, that is the foreign company for this particular section. So what is the additional requirement, ma'am? If we have to follow the section 230 to 232, what is the additional requirement? Additional requirement is that you need RBI's approval. You need approval from RBI. Moreover, the consideration may be paid in cash, depository receipts, or a mix of both. One more point which is there in rule, it states that supposedly Indian company is being merged into the foreign company. So the foreign company will pay shareholders of these Indian companies. What will they pay? What will they pay? They pay us an equivalent amount of shares. So what is going to be the exchange ratio? That will be decided by that foreign company. So foreign company will take help of a competent person. Here we have registered valuers. What about there? So it is stated that their valuation should be done by some members who are undoubtedly the member of recognized body which follows internationally accepted principles of valuation, so that we can be sure of fair valuation. Okay, so this is an important point that is there. Fine. And moreover, we also have to take care of the jurisdiction, that foreign company which must be incorporated in certain jurisdictions where securities market regulators, there are anti-money laundering, etc., etc., and that we have to take care of. And you can merge only with the company of that particular jurisdiction. Fine. Moving on to the next section, section 235. One company wants to acquire another company as its 100% subsidiary. That means want to buy all the shares of that particular company. So the company gives an offer to the shareholders of that company that you sell your shares to me because I have an intention to take all the shares. I give you 4 months, you can either reject or accept, it's completely your choice. But supposedly it is accepted by 9/10 value of shareholders. Then it's going to give a huge power to the company. The company now gets the power to acquire shares of even those people who did not agree. This might sound harsh to you, but I hope you remember the logic that I explained to you in the comprehensive class, right? So we have discussed it thoroughly, that why this section is being introduced, and it is for the good. No, it's not, definitely not harsh. Okay, so within 4 months they can accept or reject. In case this approval is acquired but there are some shareholders who disagree, then in such a situation, transferee company, what they will do is they will send a notice to the ones who disagreed that we are going to acquire your shares. They're not happy with it. So within 1 month they can apply to tribunal. If tribunal finds that something wrong is happening to them, tribunal will give the result in favor and we have to stop. But if the appeal is dismissed or you don't apply at all, then we will take our next course of action, which is executing the transfer deed for transferring the shares of yours into our name. But we'll not give it to you. We'll give it to your company. So we will give the transfer deed, we will give the notice that we sent to you, copy of notice, as well as the money to your company, and this company will inform you that the shares are no more yours because the company has registered the shares in our name. So the transfer has taken place. So it will be informed to the dissenting shareholders that the shares are no more yours, they have been transferred to this company, and the fact that we have received your money and it will be disbursed in 60 days. Okay. So this is the case. Section 236 is quite close yet has a difference. What is the difference over here, ma'am? That before that, let me take you over here. Section 238, it just tells us about the attachments, that whenever a transferee company gives an offer, it also contains the board of directors recommendation, the statement that if you accept the offer, necessary cash will be available, you will get adequate cash, and thereafter you can sell the shares, and that we have registered the circular with ROC. See, whatever offer you are giving, you also have to register it with ROC. If ROC refuses to register, you cannot go ahead and make an offer. There is a penalty also of 1 lakh for that. Okay, now section 236, purchase of minority shareholding. Supposedly over the period of time, some person has got or has become the shareholder of more than equal to 90% of equity share capital, then he can acquire the remaining ones also. How? You will notify your intention to minority shareholders. There are two options. They might also offer to sell their shares, or you can make an offer. Now this is something which is which has to be considered. Predetermined price. Whatever offer you will be made at a predetermined price, and this pricing has been quite illustrated through the rules also. A registered valuer will be higher, he will value the price, yet that will not be the price. We have to ensure that what SEBI releases as the fair price, or if it is an unlisted company, then what is the fair price that can be calculated on the basis of what price has been paid in the last 12 months. All this is not something that you must remember, but I'm just telling you for information. So based on that, we decide that higher of what registered valuer has taken out or what SEBI has given as a fair value. So according to SEBI regulations, what has come at the fair value, higher of these two, that is the predetermined price. Okay, that is the predetermined price. Because here at once the offer is not being made, offer is made in chunks. Sometimes you are buying 2 shares, 3 shares, and likewise you have attained this particular point already, and now you are availing this particular section. So what you will do is, you will deposit consideration in a separate bank account. You give the money to transferor company only. So transferor company only receives money, pays money, collects share certificate, discards it, issue new certificates. It acts as a transfer agent in that regard. And deposit money in separate bank account, which remains valid for 1 year. So 1 year anyone can take payment from that bank account. The amount has to be disbursed within 60 days. Now one important or additional point which is there in this section which students fail to understand is that there is this minority which was already 10% or lesser. In this minority, there is a majority and minority. Majority which holds more than equal to 75% of holding, and minority which holds less than equal to 25% of holding. Now, in this minority, the majority negotiates with that shareholder, with that actual majority shareholder, and gets a higher price, or get some more money for sale of shares, because they are good chunk, they can negotiate. or they reach an understanding that I want more money, whatever more money they receive, they have to give or they have to share that additional compensation even with the minority segment of shareholders. Okay, fine. Section 237, if central government is satisfied that two companies must merge into one another, central government can pass such order. What about our wishes, our will? Central government will first draft the order, send it to both the companies that you both have to merge. This is my order. If you have objection, you can give the objection within 2 months. Your rights and liabilities will not be affected. If at all the rights of members creditors are affected, then you will get compensation for it, and if you're not satisfied with the compensation, you can even appeal to tribunal within 30 days. So draft is made, it is sent to the companies can object within 2 months. If companies don't object, fine. If they object, then central government will consider the objections, make necessary modifications if needed, and thereafter pass the final order in official gazette, which will implement the merger scheme. And this is also going to be laid in the Houses of Parliament, right? After that, we have section 239, which just says that whatever company has been merged, has been amalgamated, the books and papers of that company cannot be disposed of, destroyed without the permission of central government. So you need to make an application to central government for seeking permission. Central government will ensure that there is no evidence left of any offence, prospective offence, and thereafter permit you. Section number 240 states that if two companies are merged, the old company had committed an offence and some officer in default was responsible, he will continue to be liable even after this merger, demerger, amalgamation, whatever is taking place, right? So that is all about this particular chapter's revision.
Okay, now the revision of prevention of oppression and mismanagement. We have very few sections read with rules and some case laws in this particular chapter. This chapter comprises of not many sections, starting from section number 241 till section number 246. If we look at the chapter overview, if oppression and mismanagement is taking place in any company and if you're being oppressed in the capacity as a member, that is a continuous act of oppression that you're suffering from, then if you happen to be the eligible member, then you can make an application to tribunal for seeking relief from that oppression or mismanagement. This chapter intends to provide the preventive remedy and not the exact cure after an oppression has taken place. So oppression and mismanagement, these are the two terms which are not defined in the act, defined in this whole chapter. However, when we look at section number 241, we are being given two cases when an application may be made. So if you satisfy the criteria, if you fall into those cases and you meet the eligibility requirement, then you can make an application. So when we start with the chapter, we start with understanding the meaning of the two terms. There are two perspectives. One is the general meaning that we understand of the two terms, and second is the given intended meaning, the given intended precise meaning in this section, which we have to present in our answers, right? So the very first thing, the chapter begins with a rule, that is majority rule, Foss versus Harbottle, which states that all the decisions will be taken by majority, which is fair enough. Because if we remove this particular rule, we will not have any proper procedure to take decisions in a company, in our lives, in anywhere, right? So obviously, if the decisions are to be taken by board of directors or the members, they are going to be taken by majority of people, which is the majority rule, which is nothing wrong at all. And the courts will not intervene in this internal management as long as the decisions are being taken in the manner they ought to be. However, this chapter says something as an exception to this force versus hard-bottom majority rule, and it states that sometimes the decisions being taken by this majority could be oppressive, could be creating some atrocities to the minority group, to some group of members, to one member, two member, four member, five member. And in such a situation courts will intervene. How the courts will intervene? NCLT gets the power under this chapter to entertain such applications and complaints, right? This is the slight background that I have given to you. Since just a revision class, we're not going to get into very much in-depth meaning of each and every term. Once again, if we come back to the chapter overview, someone is entitled to make an application under section 241. Who is entitled? The members' eligibility criteria or requirement is given under section 244. So before reading section 241, you need to have that understanding of section 244 and remember who is eligible to make an application. So someone who is eligible to make an application, if the circumstances prevail which are given in section 241. What are the circumstances? There are two cases which are given. One case is termed as oppression and one as mismanagement. Although section does not define the terms, section only states the circumstances we believe it to be the case of oppression or mismanagement, right? So if the members are eligible, they can make an application. If there are the circumstances prevalent, they can make an application to tribunal under section 241. Tribunal passes certain orders under section 242, and out of those orders, a few orders have certain consequences also, some after effects. That is given in section 243, and we have a separate segment, class action suits, given under section 245 and 246 is absolutely nothing, right? You're not being asked any question. It is nothing. It's just about the applicability of some part. So that we are not concerned with. We start with the revision of first section 241, but before that, let's have a look at who is eligible to make an application. There might be a company with share capital, there might be a company without share capital. If it is a company without share capital, we don't have any share capital, we just have the number of members. So we can straight away say 1/5 of the total number of members. So if the company is without share capital, 1/5 of the total number of members. But if the company is with share capital, then ideally we have three things. And we can say lowest of all these three, or we can have a division that number wise also criteria could be met, or the value wise criteria could also be met. A company is having share capital. Who are the members who are eligible to make an application? Lowest of either 100 members or 1/10 of the total number of members, or the members who are holding at least 1/10 of the issued share capital. Here it means preference plus equity both. Point number one. Secondly, it's not paid up capital, it's issued capital. So you have to keep this thing in mind. So if you meet any of these three criteria, you become eligible to make an application. However, what is important is that you must have paid all the calls and sums due to the company. If you yourself have failed to pay the calls of the company, then your eligibility requirement also fails, and in that case you are not an eligible applicant. Moreover, sometimes it may so happen that although you fail to meet the eligibility requirement, yet your case is severe and your application is genuine, and you must make an application for seeking relief. In such a situation, tribunal can waive the requirements. Tribunal can say, fine, even if you're not 1/10 of members, you can still make an application. Even if you don't hold 1/10 of issued share capital, you still make an application and we will admit your petition. right? So this is something which is possible. NCLT may permit the lesser number of members. That is something which is something that I have told you. Now, although these points are established through a lot of case laws as well, but two things I am telling you over here. One, I hold 100 shares and so I am eligible. After making an application, I sell my 50 shares, so my shareholding gets reduced. Later on, after making an application, will my application be still valid? The answer is yes. So I am supposed to hold the requisite number of shares only at the time of filing application and not thereafter. Secondly, I have given my consent, but subsequently I have withdrawn my consent. Will my application be still valid? The answer is yes. Right. So both these requirement, that is the shareholding as well as the consent, is needed only at the time of filing of application and not thereafter. Not thereafter. Thereafter, if it is subsequently reduced or withdrawn, it doesn't really matter. So one thing is clear, who is eligible to make an application? So we check whether the company is with share capital, without share capital, where do you fall, and do you meet the criteria as given or not. If you meet the criteria, then you may complain. If oppression takes place or if mismanagement takes place, or likely to take place, right? Because it is a preventive remedy. So one, if the affairs of the company are being conducted, have been conducted, or are being conducted prejudicial to public interest, what do you mean by prejudicial? Prejudicial is harmful. So if it is harmful for public, it is harmful or oppressive to the members, it is harmful to the interest of the company. So if any of these things exist and you are eligible member, then you may complain. You may complain. You may complain. Secondly, there is some change in the management, or even without the change also this takes place. However, what has been given in the section, if there is change in the management and now it is expected that whatever actions they are going to do, it will prejudice us. Why change in the management is written over here? Because if there is no change, then affairs are being conducted in a harmful manner. So if there is no change, this point covers it all. But if recently some board of directors have changed, or maybe the two companies have come together, or maybe some shares have been acquired by a particular group, so that ownership in shares have been changed, so now whatever resolution will be passed, they will have the majority and they will be taking the decisions. So if there is some change, if there is no change, either the affairs will be running good or not good. Not good, you can use this ground and you can complain. If there is change in management, then you come to this particular point, right? So there is change in the management, you are expecting that it will be harmful to members, so you have proper circumstances and evidence which suggests the same, then you may also complain. And CG in public interest can also complain. So you can make an application to tribunal, and if tribunal is satisfied that yes, the allegation, the application is genuine and the above affairs exist, above state of affairs exist, and the company is in such a condition that the company must be wound up. But if we go on to wind up the company, it will not be fair for the members who have made the application. Right, something wrong has happened to me and you're closing down the company, it doesn't rectify what wrong has happened to me, right? So in such a situation, tribunal, instead of resorting to winding up, takes some other actions. What are the other actions? This part is given in section 242. So these are the orders of tribunal, what orders may be passed. Although tribunal can pass any order as they deem fit, however, there is some list of orders which are given which may be passed, right? So what orders can be passed? The tribunal can say that we are going to regulate the affairs. Fair enough. The tribunal could say regarding the purchase of shares by some group or by the company, The tribunal can instruct the company that, okay, fine, you buy the shares of these people at a fair price. And since you're buying back the shares, it should result in, or it should comply with all the provisions of reduction of share capital. Right. Sometimes it may so happen that some transfer of shares is constantly taking place, which is not in the best interest of the company, and all the shares are being rerouted to a group of shareholders who are misusing their powers or something like that. So tribunal can restrict that transfer. Some further shares are being issued, and if these shares are issued to a particular group of people, they will become majority from minority. Tribunal can stop that allotment. Now, tribunal can terminate, set aside, modify the agreement between directors and company, or between company and some third party. If tribunal does this, it has consequences of 243. Only in this point. Only in this point we have consequences. For all other points, we don't have consequences. What do you mean by that, ma'am? Company has hired, or company has appointed Mr. X as the managing director for 5 years, but tribunal terminated their contract and said that you have to leave the company. Right? In such a situation, two consequences follow, which are given in section 243. 1, although if a managing director is removed before expiry of his term and he fulfills the conditions given in section 202, he is entitled to compensation. However, if he is removed under section 242 by tribunal, he will not be entitled to compensation. Moreover, because tribunal has found him guilty and that's why has removed him, so he will be disqualified for 5 years. If he wants to be appointed as a director before 5 years, then he has to go to tribunal, seek its permission, and then it can be appointed. Okay. Likewise, although third party and company, tribunal doesn't have the right to terminate a contract of third party and company. Right. But still here tribunal gets that power. Tribunal will discuss with the third party, will take permission from the third party, and then terminate, set aside, or modify the agreement with the third party. However, even in that situation, the third party also shall not be entitled to any compensation. So no matter if tribunal has terminated or set aside or modified the contract, then absolutely no compensation, and the concerned directors will be disqualified for 5 years of appointment until they seek the permission from tribunal. Next, setting aside of fraudulent preference. For this, you need to recall and understand what do you mean by fraudulent preference. Giving someone preference for a fraudulent motive or intention. That is fraudulent preference. Like what, ma'am? I have 10 creditors, and if I have to genuinely make payment of these 10 creditors, I will pay the creditor who has been waiting for the longest, right? But instead of making that particular payment, I paid to some creditor who I know is a good friend of mine. So this is giving fraudulent preference to that creditor just because I know that the company is running out of funds, and if I start in that sequence, my friend will not get money. But that's how it should happen. That's a fair play, right? But instead of going for that fair play, here we are involving some fraudulent motive and doing this. Tribunal has the power that in the past, if these type of transactions have taken place, they can set aside this transaction. Tribunal can remove MD, manager, director, appoint them who is going to report to NCLT. They can give instructions about the cost of this and recovery and other matters as they deem fit. So these are the orders which may be passed by tribunal. An application may be given by the eligible members to tribunal. Tribunal receipt of application is satisfied that yes, it exists and winding up would be unfair. Then tribunal passes certain orders. Whatever order is passed, that has to be furnished to ROC within 30 days. Within 30 days. Okay. Now, we have another point over here on which we have not done a lot of questions because these are some recent amended sections which have been incorporated and a new thing which has been incorporated. But then this is important. Okay, so there is something more. What is it? Application to tribunal for relief in case of oppression, etc. And powers of tribunal and section 243. Ma'am, we have read section 241, we have read section 242, we have read even section 243. Then what is it? It is a combination of all three of them. It is an absolutely different topic, but it is not given in one section. Some part of it is given in section 241, some in 242, and some in 243. Okay, so let's begin from the very first part. See, if central government, on the basis of some circumstances, has a belief that there is a director in the company who is not fit enough to be the director. Fit enough means he is constantly negligent in his duties, he is not performing his duties well, or maybe he's constantly indulged in fraud, right? Some people are there who do mistakes, but some people are there who have a habit of doing mistakes, right? So if central government comes across any such person who is guilty of fraud or breach, or has not done the business according to the principles, or has been doing the business with the intent to defraud or cause injury, then CG wants to know, is he fit enough? CG wants to know, is he fit enough? So CG initiates a case and makes an application to tribunal. Now, tribunal should also have the confidence that do I really need to inquire about this person? So for that, CG gives a concise statement that why CG believes that yes, some inquiry should take place for this person. I don't find this person to be fit and proper. I don't find him to be fit enough to be the director, right? So central government gives the application to tribunal to inquire and record whether or not such person is fit and proper to hold office. Under section 242, tribunal records its decision. So tribunal will hear the case, will call him, will look for evidences and all that, and finally come to a conclusion that yes, he is fit or no, he is not fit, right? So whatever conclusion he comes across, he records that decision under section 242. And if he is fit, great enough. If he is not fit, then such person shall not hold office for 5 years from the said decision without the leave of tribunal. So if he wants to be appointed, he can take permission of tribunal, and such person shall not be entitled to compensation. Just the same thing that we have read before also. I have made another chart for you all in the same capacity so that you understand the whole for the same topic, so that you understand the whole concept well once again. Central government, if these circumstances suggest fraud, negligence, or default, not sound business principles, or serious injury to trade or industry, or intent to defraud, then it can make an application to NCLT to inquire along with concise statement. This part is given in section number 241. After hearing, NCLT shall pass order. This is given in section 242(4)(a). If he is fit, no further action needed. If he is not fit, then these three parts are given over here. Such person shall be removed, disqualified for 5 years in any company. If tribunal terminates or sets aside some agreement with the director, he is disqualified to be appointed for 5 years only in that company. But if tribunal finds that a person is not fit enough, then he's disqualified for 5 years to hold office in any company. That's the difference. And also entitled to compensation for that loss, right? So you get double clarity this way, right? So I think this is clear. Okay, now we probably have this last section that we need to discuss. Class action. Class action is a benefit which has been given, and this benefit is not just for the members but also for the depositors. I have made you a proper differentiate between section 241, section 245, that there also some members are coming together and making an application. Here also members are coming together and making an application. So what is the difference? All that difference I've already told you. Right now we'll focus just on revising our concepts, right? So members can also go for class action and depositors can also go for class action. If members, we are talking about members, the company may be with share capital, without share capital. If it is with share capital, the lowest of 100 members, 5% of number of members, or if it is a listed company, members holding 2% of share capital. If it is unlisted company, members holding 5% of share capital. Fine. If the company is without share capital, 1/5 of the number of members. You have to learn it. If you don't learn it, no, you will think and try to focus that what is ma'am trying to tell us. I'm unable to gain this, I'm unable to retain this. So you will face a lot of problems if you don't learn. Wherever in law there is a limit, my dear, you have no choice but to learn, right? Other than these numbers and limits, all that concept building helps you to retain the concepts throughout, but this learning part has to happen. Okay. And if it is depositors, exactly the same thing. 100 depositors, 5% of depositors in terms of number, or the depositors who owes 5% of total deposits. So this is in terms of value and this is in terms of number. Fine. Now, if you are eligible, you can make an application. On what ground? That management of affairs are being conducted in a prejudicial manner. Tribunal will consider the factors. Tribunal might admit your application or it might reject the application, right? You are making an application to seek these specified remedies which may be granted to you. There is an option at the end, other remedy as well, which is a leftover option. Now, before this, what is the procedure of class action? In the procedure of class action, once tribunal receives an application, tribunal gives a public notice. Public notice as in, we have received a class action application. Now, all the members are being given a public notice. There might be some members who want to opt out from this, they can. But if they don't want to opt out, they are deemed to be a part of this class action application, right? Maybe there might be a situation that 2 class applications have been filed in the same regard, so they will be clubbed into one and one lead applicant will be selected. Now, it is the choice of the applicants only to select one lead applicant. However, if there is a conflict between these applicants, then tribunal can take a call and tribunal can decide about the lead applicant, which is going to be binding on everyone. Fine. So what orders or what types of remedies can be obtained under this section? The company can be stopped from doing an ultra vires act, from committing some breach, and some resolution can be declared as void. A resolution for altering a particular regulation of articles of association was passed, but there was some problem which we have discussed in classes, so that can be rendered as void by the tribunal. Restraining company to act on above resolution. Since the above resolution has been rendered to be void, then obviously you will not even act on that resolution. If that resolution was valid, you will take its actions. But if it is not valid, then you will stop yourself. You will not go ahead, right? Is stopping the company to act in contrary to the provisions. You can claim damages from the director, auditor, expert, others, and any other remedy which may be granted, right? So these are the different types of reliefs or remedies which may be given under a class action suit. Fine, so that was super quick revision of the chapter of prevention of oppression and mismanagement.
Now let's revise the topic of winding up. Winding up is a huge chapter and has a lot of sections, however, not very important from examination perspective. What is winding up? First thing that you have to understand is winding up is different from dissolution. Winding up is actually the process of realizing the assets and paying off the liabilities. Of course, to realize the assets and pay off the liabilities, you need to do a lot more work than you can think. Collecting and actually verifying all the claims, that who wants money from our company, which is basically the creditors or the contributories, and from whom we can take money, our prospective debtors, our assets, from where can we realize. Some assets might be on lease, some assets might be in someone else's possession, some assets might not be on paper belonging to the company wherein they actually belong to the company. So a lot of efforts have to be taken, and moreover, to carry out this process, we need someone who is independent and who is not biased towards the company, not biased towards any of the creditor, not biased towards any of the director, etc. Because it is also important to extract and bring out any fraud if there exists in the company. So for that, you need an independent professional person who is known as a liquidator. Now who works as a liquidator? It could be an official liquidator, like the central government officers which work under the high court. It could be the insolvency professionals, right, about which we read in IBC, that is Insolvency and Bankruptcy Code. Now when we begin with the chapter, the very first section is 270, but before that you have to understand that post in IBC, after insolvency and bankruptcy code came into picture, there are broadly one thing which has been eliminated. That is the topic of voluntary winding up. So earlier, if companies are properly solvent, they don't have any issue, yet they want to close down, they had the option under this chapter. Now they don't have, they have the option only under IBC. Moreover, a creditor was able to be a petitioner. See, this process of selling the assets and making payment to the creditors is going to be done only on the permission of NCLT. So anyone who desires to go into that process have to make an application to NCLT. Be it the company itself, be it any of the shareholder, be it the registrar, be it anyone. So if company does anything which is not acceptable, there are grounds when this winding up can take place. We will read about the grounds. So if anything like that is done which is unacceptable, a petition is made to NCLT. NCLT passes the order, and thereafter this process of winding up takes place. So if a company has taken a loan but the company is unable to repay the loan, can bank file a petition with NCLT that close down this company, sell their assets and make my payment? The answer is no. Why? Because this ground has been removed. So the creditors are not entitled to make a petition. After IBC, if you have any issue, if you are an operational creditor or a financial creditor, you have to move to IBC, and therein you can make an application. Okay, not over here. So there are slight these changes which have been witnessed after IBC. Okay. So we are left with just one mode of winding up under this chapter, that is winding up by tribunal. Now, tribunal is not going to order winding up just like that. Okay, fine, close the company, sell the assets and realize the assets, pay off the liabilities, close the company. No. Someone has to complaint. Someone has to file a petition. Now, someone will not file a petition just like that. There have to be proper grounds. So, what are the proper grounds? If SR is passed by the company, if the company is acting against the sovereignty or integrity or a friendly states with other countries. So if you're acting against any of these, then central government or state government, they can also intrude and they can also file a petition with NCLT that close down this company. This company is working against the sovereignty of our nation. So close down the company. Fine. The company cannot be closed down just like that. You have to understand that there are so many creditors, there are so many stakeholders rather. There are employees, maybe their salaries have not been paid. There is government whose dues have not been paid. Maybe there are creditor, there is a bank from whom we have taken loan. Right. So all these stakeholders cannot be left just like that. So it is important that this process is carried out. So everyone, all the liabilities are settled down, whatever surplus is there. If it is not a fraudulent surplus, then it is given to the shareholders who invested in the company, and then the company will be closed down. The ultimate intention is to close down the company, right? Because there is maybe fraud involved, or maybe the company is doing a default in filing financial statement or annual return. So this is also one of the ground. For continuous 5 years, if there is a default in filing financial statements or annual returns, or there are fraudulent affairs, or the formation of the company was whole fraud, promoter, board of director, they are involved in fraud, or there is an open last ground, winding up is just and equitable. That means this is the only fair option left. So in such cases, petition may be made. Now, who is entitled to make the petition? Company. The contributory. Now, who is called as a contributory? Contributories are no special people, they are only the members of the company. Just like when you incorporate a company, before incorporation they are subscribers, post incorporation they become members. Like that, before winding up they are members, post winding up, that is when winding up commences, they become the contributories. Many students have this confusion in their mind that contributory means someone who is liable. There can be three types of companies, my dear: a company limited by shares, a company limited by guarantee, and an unlimited company. If a company is limited by shares, that means the members are liable to contribute only up to the amount unpaid on shares held by them. That means if I have fully paid up shares of any company, I'm not liable in any case to contribute anything to the company, even if company demands in the case of winding up. I will still be called as a contributory. If I have partly paid shares, I can be liable for the amount unpaid. If I have taken guarantee, I will be liable for the amount of guarantee, right? But I will still be called as a contributory, whether I'm liable or I'm not liable. In cases, if I have partly paid shares and I have transferred this partly paid share to someone else, and within a few months the company goes into liquidation and this person is unable to give that call money, then I, being the past member of the company that is falling in list B contributories, can also be asked to make the payment. Okay, so that we will see what are the conditions later. Okay, right now this much information recalling is sufficient. After that, we also have a registrar. ROC can also make a petition that close down this company, because ROC is the one who has most knowledge about filing and all that. So ROC comes to know that there is a company which is continuously not filing financial statements or annual returns. So ROC will make an application to central government. Central government will give an opportunity to company that ROC wants to make a petition for winding up. Do you have anything to say? Whatever discussion is done, if CG approves, thereafter ROC can file a petition to NCLT. Official of central government and central or state government, of sovereignty of the nation and all that, that point is affected. Okay.
So they are entitled to make a petition. These are the grounds on which petition may be made. Petition is made to whom? Petition is made to NCLT. See, they make petition to NCLT, but a copy is also sent to ROC. So ROC within 60 days has to submit views, that what are his views on this whole winding up. Should winding up happen or should winding up not happen? Okay, fine. Moving to the next section, section 273, order by tribunal. So once NCLT receives the petition by eligible petitioner on eligible grounds, next is what tribunal will decide. So tribunal within 90 days may pass an interim order. For the time being, this has to be done. May appoint a provisional liquidator after giving an opportunity of being heard to the company. Provisional liquidator means what, ma'am? See, there can be two instances. A provisional liquidator is appointed. Thereafter, winding up order, company liquidator is appointed. The same person can act as a company liquidator. Option number 2, provisional liquidator is not appointed. Directly, we have a company liquidator. Now, what is the difference between the two? Provisional liquidator also start doing the same things as company liquidator would have done. However, when we are very not sure about what is going to happen, we may restrict his powers. That means we may say that we want the winding up process to start quickly. That's why we have appointed you, but you don't have these powers. You cannot do this. You only can do this. So he will do that. And once company liquidator, maybe we now trust his abilities. So we now make him the company liquidator and he gets all the powers. Or maybe we replace him with someone else and then that person gets all the powers. Okay. So that is the only difference. Or any other order may be passed. So order of winding up, any interim order, liquidator may be appointed, or any other order may be passed. Right? Tribunal cannot refuse passing the order of winding up just on the ground because the company does not have much assets to sell. Even if company doesn't have many assets to sell, still the winding up order can be passed. Okay. Section 274 is about statement of affairs. See, when company itself is the petitioner, listen to me carefully. When company itself is the petitioner, company itself is saying that wind up. So company knows about its state of affairs. So company, when files a petition, also files statement of affairs. Company with statement of affairs. However, if there are other eligible petitioners, they do not know about the company's state of affairs, so they cannot file the state of affairs with tribunal. So then tribunal directs company that you file your statement of affairs. Now, supposedly ROC has given a petition to NCLT that wind up this company. I should be given an opportunity to at least oppose. I don't want to be closed down. So I should have an opportunity to oppose my winding up. So this is an opportunity. Tribunal directs us that give your SOA, statement of affairs, along with that also object. If you don't submit your SOA, you lose your right to object. Then you cannot oppose this petition. Plus, you will be penalized. Right? So you have the time period of 30 days plus an extension of 30 days can also be given. If you file, great. If you don't file, you lose the right to oppose the petition, as well as penalty is imposed upon you. Penalty may be ranging from 25,000 to 5 lakh and imprisonment up to 6 months or both. Okay. Thereafter, we have some sections. Appointment of liquidator, removal, replacement, constitution of winding up committee. A lot of sections have been clubbed in this chart. Now, as I told you, NCLT may appoint provisional liquidator or company liquidator. And I also told you the powers, and I also told you who can be appointed. What salary will they get? It depends upon what experience they have, what qualification they have, and the quantum of work. If it is a very huge company, of course, their remuneration will be high. If it is a very small company, their remuneration will not be so high. Fine, ma'am. And one more thing that I told you in the beginning, that
This has to be someone who is independent, impartial. So when you're appointed within 7 days of appointment, you have to file a declaration. Declaration, rather, disclosure of any conflict of interest or lack of independence. If you have any lack of independence, that means you have been appointed for a company in which some of your relative is a stakeholder, or you have some inclination, that means your independence is compromised on certain grounds, then you have to disclose that. Okay. And once you are appointed, NCLT intimates the liquidator as well as the registrar, and registrar thereafter puts it on MCA website, puts it in official gazette, notifies the stock exchange and all that. Right. Now, once a liquidator is appointed, does not mean he's going to continue. He can be removed. He can resign also, and he can die also. On what grounds can he be removed? Misconduct, fraud, if he becomes professionally incompetent, or he is unable to act, or he lacks independence, or of course conflict of interest. So after giving a reasonable opportunity of being heard, he can be removed, and when he is removed, or he resigns, or he dies, then a new liquidator will be appointed and all the work will be transferred to the other liquidator. Because of the old liquidator, if we have suffered some loss, then the loss can be recovered from that person. Now, there are two different dates. One is winding up commencement date, that is the date of filing petition. And second is winding up order, that is when order is being passed. So within 3 weeks of passing this winding up order, we have to constitute, that is the company's liquidator has to constitute a winding up committee. Section 277. Okay, so company liquidator will make an application to tribunal to constitute winding up committee. Who will be a part of winding up committee? The nominee of secured creditor and official liquidator and professional, another professional by NCLT. Official liquidator, I've already told you who is the official liquidator. Fine. Then there is something called as reporting. Although we read about preliminary report, we read about monthly reports, we read about final reports. So there are different reportings throughout winding up. These reports are being made from liquidator to tribunal. Okay, so these reports will undoubtedly continue. Then comes your section 279. When winding up begins, all other suits are being put on hold. That means you cannot file a fresh case. The pending cases will be put on stay. They cannot be continued or proceeded with. However, the cases which are pending against in High Court or Supreme Court, they have a authority higher or superior than NCLT. So their cases will continue. Okay, so their cases will continue. Now, supposedly, I think that this is a case which is just going to be disposed of in a very quick manner. So in such a situation, I can seek permission from tribunal to continue that case in the same forum. Maybe there is a case which is going on in the district court. So I can seek permission from tribunal, and tribunal may grant the same by imposing certain conditions. Whatever application I make to tribunal, that application is going to be disposed of within 60 days. Right? Okay. Now we have some more reports. As I told you, we have about preliminary report also. But before that, just because we're talking about cases, we also have section 280. See, tribunal ideally deals with only corporate cases. However, if there is a suit which is pending in some other court and then winding up commences, then this suit can also be entertained by NCLT. So if you have any other claim, if you have any fast track merger application which is pending, any suits which are pending, all of that can also be dealt with by NCLT. Now, when winding up order is passed, liquidator has to prepare a report of three things: report of certain details, report of fraud if any, and report of viability of business, how viable the business is. Maybe we are closing down the company not because the business cannot be run, because there is some fraudulent motive, or maybe because the company is acting against the interest of the nation, right? So if you're closing down the business for that reason, or maybe the promoters are involved in fraud or something like that, maybe the business is fruitful, the business is intact, and there are a lot of employment opportunities in the business. So, if we close down the whole business, the employees might suffer, and that's why the business as it is can be sold, which is selling as going concern. So, that order may be passed if the business is viable, right? Secondly, if there is fraud which is involved, then of course an order of investigation may be passed. So these reports by liquidator are very essential, are very important, which must be made very carefully. Right? If there is involvement of fraud, then maybe further investigation is needed, because someone has committed a fraud and then we will close down the company, the person will be free. So these reports are important. So the contents of report, the basic details, that is what assets the company has, the liability, capital, legal cases, guarantees, what are the debts due to the company, subsidiary, holding, what are the pending contracts, etc., etc. Okay, this report can be inspected by the creditors or contributories. Now, after tribunal receives this preliminary report, they can take a lot of actions. They can do a lot of directions. What are the directions which may be taken by tribunal? First thing is fixing the time limit, because now tribunal knows these details. So tribunal can very well fix the time limit if they want to. Maybe can revise the time limit based on the monthly reports that they receive. Maybe can make a sale committee. It's again optional. Okay, the sale committee will also comprise of the promoters and all only. They can help facilitate the sale of assets. Okay. Protect assets of the company. What is protection of assets of the company? Maybe NCLT feels the need that these assets can make us realize 10 lakh rupees, but if they're not protected, then in the coming tenure, they will not even be able to realize 2 lakhs or 3 lakhs. So it's important that we provide protection to these assets, like insurance, right? So they can be protected, and they can also order investigation based on fraud. Okay. So I think this is clear. Fine. Now the promoters, directors, etc. have to cooperate with the company liquidator. Obviously, ma'am, they will cooperate, they will give whatever documents and etc. they are all needed. And if they don't cooperate, the tribunal can pass suitable order as they deem fit. Okay. Now we have an important section, that is contributories. I have already told you about the contributories. Now, who can be liable? It can be the present member. It can also be the past member. Now, past member will be liable only if the present member is not making the payment. And if I have transferred the shares 5 years ago, then I will not be liable. I can be liable only if I was a member in the preceding 1 year. Okay, then only I can be liable as a past member, as a contributory. Moreover, I will not be liable for any debts which the company has incurred after I ceased to be the member. So my membership had terminated. Thereafter, the company took a loan, and for making payment of that loan, you want money from me. Why? I will not be able to give you, right? So I will not be liable for that. Okay. Now, for what they can call for making the payment of debts, for even the cost of winding up, and for adjusting the rights of the members. What is adjusting the rights of the members? Well, there may be a situation that a member has paid rupees 2 and other member has paid rupees 4 on a sure. So to bring them all in one line, call can be made to adjust the rights, right? So it is the duty of the tribunal to settle the list of contributories. Now sometimes the list of contributories is not needed because we know that we have very limited assets. We know that we have very limited assets and all the shares are fully paid up, so no one will be able to contribute anything and we will not be able to give anything surplus to them. So there is no need to prepare the list. So in certain cases when the list is not needed to be prepared, then tribunal can dispense with the list. Otherwise, the list has to be prepared of all the contributories, so the members' register will be rectified, will be updated, and a proper list will be prepared. Okay, fine, ma'am. Then we have advisory committee. Advisory committee is made by tribunal to advise. It comprises of the creditors and contributories, maximum 12 members. Company liquidator will chair the advisory committee and it is made within 30 days of winding up order. How is it made? The company liquidator actually convenes the meeting of all the creditors and contributories to decide about the composition of advisory committee. Advisory committee will always be beneath all the creditors and contributories. So time and again, liquidator can call the meeting of creditors and contributories to ask what do they want, what is their wish and all that, and decide about the decide about what is the next course of action. Okay, fine. Then comes your powers and duties of company liquidator. So company liquidator, what does it do? Carry on business if there be need, execute all the documents, sell the properties, sell undertaking, raise money if needed, institute or defend suit, whatever they are going on, invite and settle the claims of creditors, then make negotiable instruments, take out the letters of administration, obtain professional assistance. In fact, we have a section 291 for professional assistance. Then take all the actions which are necessary, and lastly apply to the tribunal for other orders, for like orders like dissolution and all that, right? As I told you, we also have a provision for professional assistance. What do we mean by that? A company liquidator can obtain professional assistance. Professional assistance means what? CS, CA, CMA, legal practitioner. We can take assistance from that in discharging our functions. Then we have books and audit. So 293 and 294. First thing is liquidator has to maintain books of accounts of everything, that from where money is received, from where payment is being made, which can be inspected by the creditor or contributory, and you have to submit it to the tribunal twice a year. Winding up is a huge process. It does not end in a few months, right? It takes time. And the same is going to be also audited. So tribunal shall cause the accounts to be audited and the copy will be filed to the registrar, to tribunal, to creditors, as well as to government if it relates to the government company. Okay. Right. Tribunal has the power to order costs, tribunal has the power to make calls, tribunal has the power to adjust the rights of contributories, all that we have already discussed. Tribunal also has the power to summon the persons who are suspected of having any property. So if there is any person who has some information about a property of the company or has that property or has some books and papers and we suspect that, we can apply to tribunal and tribunal can give direction for the same. We can also examine promoters or directors. So tribunal also has the power to order the examination of promoters and directors. Plus, if someone has that custody of books, papers, or properties and is trying to leave India, abscond India, then tribunal also has the power to stop them and even seize the papers or property, whatever they have. So contributory or such person can be detained, he can be taken into custody, and that property can also be seized. After completion of winding up, liquidator makes an application to NCLT for dissolution. Dissolution order is passed, and within 30 days, tribunal forwards it to ROC and also directs the liquidator to forward it copy to ROC. Now, what is going to be the sequence of payments? Supposedly, we realize the assets. Now we will make the payments. See, as and when we keep on realizing the assets, we keep on making the payments also. We don't wait till all the assets are being realized. First thing is the secured assets. Company has taken a loan and the bank had mortgaged. The bank had a land which was mortgaged by the company. So that land is a security which is available with the bank. However, the security, the secured asset will not be used only for payment of dues of bank, but also of workmen. Why so unfair? Because this is something which is written in law. So section 326 gives us two payments which are going to be overriding preferential payments. That means before anything which is paid, these two payments have to be paid. So they are going to be paid in full out of the security. Now, usually if bank has given a loan of 1 crore, it will have a security of around 3 crores. So it has a lot of buffer. However, even if the assets are being sold and it is not sufficient to pay the workman dues as well as the secured creditor, then in such situation, it is not so that the bank will be paid and workman dues will be left. No, they both rank equally and they will be paid in equal proportions. Supposedly, it is insufficient, so some portion will be left. For that portion, they will be treated as unsecured creditor, and if any amount is left, they will be paid in that hierarchy. So we have a hierarchy called as when assets are realized. First is overriding preferential payments, then winding up cost, then preferential payments, then debentures and floating charge, and finally the unsecured creditors. Okay. So next is we have 7 payments which are called as preferential payments, but they will be paid after winding up and they will have a priority over debentures with floating charge. They all have equal rank. So these are the 7 payments: government taxes, employee salary. See, here workmen are covered and here other employees are covered. Holiday accrued remuneration, ESIC contribution, compensation on death, disablement, PF gratuity, any such fund, and investigation expenses. Fine. Okay. Another section, another important section, I would say, fraudulent preference. It is giving preference to a creditor. Giving preference is incorrect or is punishable, I would say, if it is given with a fraudulent motive. What do you mean by giving preference? Maybe providing some security to the creditor, maybe making his payment, maybe giving some type of preference through any transaction. And after giving that preference, within 6 months, winding a petition is filed. That means some idea was there that this is going to happen. That's why you have given preference to a creditor, which is, if in the opinion of tribunal, it is fraudulent preference, then the tribunal can declare that transaction, that preference, to be invalid and order to restore the earlier position. Sometimes the earlier position may not be restored because we have given him some security, or we have provided him the payment, and the payment is no. Sometimes if it is not, then the person preferred shall be liable as surety. Okay. Now, disclaimer of onerous property. Onerous means burdensome property. So if there is some asset which is burdensome, means we also have a section of section 332, which is effective floating charge. That is, if a charge is created 12 months preceding winding up commencement, then that charge will be invalid. If the charge is created and the company is solvent after creation of charge, then the charge can be valid. Or if the charge is created for a fresh loan, right? For a fresh loan means the rate also has to be specified, not exceeding the rate of 5% per annum or the rate which is specified by government. Supposedly you have taken some fresh loan, and for that fresh loan you have created a floating charge, then that is permissible. Otherwise, if you have created a floating charge before, it is also like this only, right? It is also like fraudulent preference. If you are creating a charge in someone's favor, that means you are putting that person in a position above unsecured creditors. So if you are putting someone in a position above unsecured creditors, that means you are giving him a preference. Why are you giving him preference? If you are obtaining something from him and then giving him a preference, it's okay. But then the interest rate should be within that limit specified. Or if you are creating a charge and the company is very well solvent, then also it's okay, because in the normal course you may create a charge in someone's favor. But if that indicates fraudulent preference or such type of case, then it will not be valid. Okay, then we have disclaimer of wondrous property. So if there is any land with some burdensome condition, or there are shares on which a lot of liability is there are some unprofitable contracts or some property which is not saleable, then company liquidator has a tenure of 12 months. So within 12 months of commencement of winding up, or if they do not get to know within 1 month of commencement of winding up, then whenever they get to know about this burdensome property within 12 months from that or any extended period, they have a time period to decide whether they want to disclaim the property or keep it with themselves. If they disclaim the property, so then what they can do is they have to make an application in writing to the tribunal and also send a notice to the affected party, right? So based on that, tribunal will decide that whether you may resign the contract, may order vesting of the property, or may order to pay damages, right? So all that will be paid. Then we also have some offenses by officers of companies in liquidation. So if the officers do not disclose about all the property, or if they keep some property with them, or if they fraudulently remove some property or try to hide, conceal, or through false pretense they take some property on credit, or materially omit anything in their statement which they know. So in all such 9 type of offenses, they have penalty. They cannot obtain anything giving a false pretense that yes, the company is a going concern, and then obtain that property, or maybe pledge it and obtain money from that property. So all that is punishable, and we have specific penalty and punishment which is specified in that case. Apart from that, we have a section 347 which is also important about disposal of your books and papers. You have to maintain it at least for 5 years and dispose the papers only on the instructions of tribunal. Okay. And we have another section 352 where we talk about company liquidation dividend and undistributed assets account. So if the company has undistributed assets which nobody is there to claim for 6 months, or the dividend which you have to pay to the creditors, but the person is not there to claim it for 6 months, then that will be transferred to the special account opened in a scheduled bank. If there also it remains unpaid for a period of 15 years, then it will be transferred to the general revenue account of government. Right? Okay. Tribunal also has the power to declare the dissolution void within 2 years on an application made.
Okay, now the revision of companies incorporated outside India, chapter number 22. It contains sections starting from section 379 till section 393A. But before that, we have to understand a very important term which is used synonymously to companies incorporated outside India. However, it is different. We have the term of foreign companies in this particular chapter, which is defined in section 2, clause 42 of the Act, which states that what is foreign company? A company incorporated outside India. See, one thing is clear, that whatever company is incorporated in India is governed by Companies Act 2013 completely. So you have to follow each and every provision unless exempted of Companies Act 2013. If there is a company incorporated outside India, it's doing business outside India, it has absolutely no connection with India, we are not concerned about such type of companies. You stay at your own place, you do the business any way you want to. But if you are a company which is not governed by our laws, that means you are incorporated outside India, but you have established some connection in India, then we are concerned. And we are going to, that is the lawmakers, the government has made some rules for you also to be complied with. Because you have come to India, because you are doing business in India, then with respect to your Indian business, undoubtedly we want some compliances from your end. If there is non-compliance, then it also has the consequences, it also has the fines, it also has some losing of rights. Okay, so this chapter tells us all. The very first thing, section 2, clause 42, foreign company, a company incorporated outside India, which is having a place of business in India. Now, this place of business in India could be either by himself or through an agent, physical or electronic mode. Electronic mode has been specifically defined in the rules, and which is very, very, very important from examination perspective. But the second requirement, after we read the second requirement, then I'll come to electronic mode. So once again, company incorporated outside India, having a place of business in India and conducting business activity in India. So there are two requirements, that you must have a place of business in India. That place of business can be electronic also, and you also must carry out business activity in India. According to the rules, what is electronic mode? See, if you're entering into any B2B, B2C transactions, or you're entering into via data interchange, you are entering into digital supply, you are entering into offering of securities, right? You are entering into any telemarketing, any telecommuting, telemedicine, education. See, all these keywords are very important and which you must keep in mind. Cloud computing, then any data communication services, data communications and sending and receiving through any mode. It could be electronic mode, it could be it has to be obviously electronic mode, it could be some voice transmission, anything. So all that part is included in the definition of electronic mode. Now, the very first section that we start with this chapter is section number 379. 379, which tells us about the application or applicability of the provisions to these foreign companies. As I told you, we have in total from 379 to 393A, we have these many sections. Section number 380 to 386, both inclusive, plus 392, 393. They apply to all foreign companies. Ma'am, what about other sections? Other sections apply to all the companies incorporated outside India, whether they are foreign companies or not. Okay, so these sections specifically are only for all foreign companies, and you know what is a foreign company now. Fine, ma'am. There is another applicability which comes in the subsection 2. So section 379 subsection 2, the only important subsection of this particular chapter is 379(2). It states that if it is if your foreign company has its roots or origin as Indian, that means if there is a foreign company more than equal to 50% of its capital, capital could be preference, capital could be equity, capital could be partly preference, partly equity, doesn't matter, is held by Indian citizen, Indian company, Indian body corporate, or in combination of them, then such foreign company has to comply with the provisions of this chapter along with other provisions as prescribed as if it were an Indian company. So if the company is an Indian based company means if you satisfy the criteria of section 379(2). So if a foreign company is an Indian based company, then you have to comply with some additional requirements, additional provisions which may be prescribed for you. Okay. Now, once we know that you are a foreign company, that means you have a principal place of business in India. Whenever you establish a principal place of business in India, you have a time limit of 30 days. Within those 30 days, you have to file a form FC1 to which registrar to ROC New Delhi. So it doesn't matter where you establish place of business, it has to go to ROC New Delhi. Along with this FC1, you have to file certain other things also. What other things? A certified translated copy of your charter, MOA, whatever it is, your address of the office which is registered in that other company, the list of directors, list of secretary, along with their prescribed particulars, that is their name, their PAN, their DIN, etc., etc. Name and address of the person who is going to be the Indian authorized representative. That person necessarily need not be the citizen. He has to be the person resident in India. That is important. Then, principal place of business in India, the address. If you have ever opened a principal place of business in the past and you have closed it, so all the details of that principal place of business, you have to give a declaration that none of your director as well as the authorized representative is debarred or convicted in the formation and management of the company. Other prescribed information, plus there is one more thing, that whenever you establish a place of business in India, under FEMA, you have to obtain RBI's approval. So once you have obtained that approval also has to be attached over here. In case you're not required to obtain approval, then the declaration by authorized representative shall be attached that we are not required to obtain approval, and hence we have not obtained approval. There could be a situation that there are changes in these details. So if at all there is any change in the detail, it has to be intimated to ROC within 30 days. The form over here is FC2. See, in this whole chapter, we have 4 forms that we need to study and learn. FC1, which is for giving the information, FC2 for alteration, FC3 is your financial statement, principal place of business list, etc., etc. FC4 is annual return. Okay. So I think this is clear. Now we come to section 381, which talks about accounts of foreign companies. See, while maintaining accounts of foreign companies, you have to follow section 128. This is given in section 384. Section 384 tells us about applicability of some of the provisions of Companies Act 2013 on the foreign companies. So it also tells that when a foreign company is maintaining accounts, it is bound to maintain accounts. It will maintain accounts in the same manner as given for our Indian companies under section 128. Moreover, under section 381, although the topic says accounts of foreign companies, we are concerned about financials of a foreign company. So every foreign company has to prepare balance sheet, P&L, attach all the annexures, balance sheet, P&L also according to schedule 3 as far as possible. Attach all the annexures which are needed, right? So they have to prepare all this and they have to file all this with ROC. Now the question is, what are going to be the attachments and what is going to be the time period of filing? Okay, because they are making these financials for their Indian business only, not the complete financials of the whole company. No, only the financials with respect to the Indian business. However, undoubtedly, you must have prepared some consolidated financial statements incorporating this branch as well. Right. Ultimately, foreign company is what? Foreign company is a kind of branch of some company incorporated outside India. Because if there is a company incorporated outside India and it has a principal place of business in India, by incorporating a new company, just like big MNCs do. If I talk about Apple Inc., Apple Inc. has Apple India Private Limited. So when Apple India Private Limited is incorporated under Companies Act, it becomes an Indian company and that cannot be treated as a foreign company under this chapter, under this act. Okay, you might refer to as, no, Apple is a foreign company, but it is not. Apple Inc. is a company incorporated outside India, right? It has formed a company over here, which is an Indian company and has to comply with all Indian laws. So whatever, if you have if you remember, I discussed with you by how many ways can a foreign company come to India and invest, right? So if there is an office of a foreign company, that office is operating, the office has to prepare its financials. Now, these financials, what is going to be the annexures? Annexures, as given in the chapter of accounts of companies, then there is going to be related party transaction statement, statement of repatriation of profits, statement of transfer of funds, consolidated financial statements, as well as the audit report. So, all that has to be attached, and for each financial year it has to be given to ROC within 6 months from the close of financial year, and it will be delivered in every calendar year. ROC may grant you an extension of 3 more months if needed. Fine. Okay, now section number 382. Every foreign company has to exhibit. If you open a principal place of business over here, you have to exhibit a board outside every office, which is going to clearly state the name of the company incorporated outside India, the country in which the company is incorporated, and if at all that company's liability is limited. That means it is a limited liability company. The liability of the members of that company is limited. Then this fact also has to be stated. Ma'am, where will it be stated? These three things have to be stated. Where will it be stated? It has to be stated at two places. One is the board outside every office. When I'm talking about board, in the board, it will be written in two languages, English as well as the local language. And when I'm talking about the other part, that is bills, notices, letters, any official communication, in that only in English, in proper legible characters. Fine. Now, if any notice, any document has to be furnished, has to be served on this foreign company, how can you serve it? We have an authorized person resident in India. It can be given to such a person by hand delivery, sent by post, or by electronic mode. Address, the address which has been mentioned. See, under section 380, we file a lot of documents. We file a lot of documents with ROC. We tell them about our authorized representative. We tell them about our address. So the same address, the same person will be used for communicating, for sending of notices or documents to foreign company as and when needed. And it will be sufficient for any authority. Now, section number 387, 388, 389 and 391. They all talk about prospectus. They all talk about prospectus. 390 is about IDRs, but this is a series which talks about prospectus. These sections are for companies incorporated outside India, whether they are foreign companies or not, it doesn't matter. Companies to be incorporated outside India. So if you're not even incorporated yet, in future you are going to be incorporated, but you are giving the you want to issue prospectus, you want to make an offer first. Whatever you lost permit, however you want to do it, there may be these two situations. They may have a place of business in India. They may intend to have a place of business in India. They may not even have a place of business in India. It doesn't matter. Any company which is outside India or which is going to be outside India, if it wants to offer securities in India via IDR, via prospectus, not IDR, I would say, via prospectus, how can it do so? It can, but only when it comply with the conditions. Even for our Indian companies, we have very strict laws and provisions for prospectus chapter, right? Prospectus and allotment of securities. There is section 26, which clearly states out the matters which have to be there in the prospectus. The prospectus has to be dated, prospectus has to be signed, prospectus has to be delivered to registrar. So a lot of requirements are there in that chapter as well. The same requirements have been reproduced over here. So there is absolutely no change in the requirements. The same requirements with a slight of addition have been reproduced over here. In case you remember the provisions of prospectus, great, you will be able to get even better clarity. But otherwise also it doesn't matter. So Company, company incorporated outside India offering securities via prospectus in India will not be allowed unless following conditions complied with. What conditions? The prospectus has to be dated, it has to be signed, it must contain certain informations. One thing is, all the matters which are to be specified under section 26 have to be specified here also. Apart from that, you also need your constitution, your governing act, your country of incorporation, your address, where the documents can be inspected. Okay, so all these details is also required. All the details are also required. So this is how you prepare prospectus. This is how you prepare prospectus. Now, after you have prepared prospectus, you cannot go out and issue the prospectus. Your prospectus must be delivered to registrar for registration. So how, ma'am? It has to be certified by chairperson and 2 directors and delivered to registrar for delivered to ROC for registration. Sometimes your prospectus has an expert statement, but you have to ensure that whenever your prospectus is going to contain a statement from expert, some conditions of that also has to be complied with first. You cannot include expert statement without obtaining his consent. So you must obtain his consent. He must not have withdrawn the consent. His consent must have been filed with the ROC, and you have stated this fact on the face of prospectus. So first thing, prepare a proper prospectus with all the contents which must be included. If your expert statement is included, ensure that you have complied with the conditions. After that, on the face of prospectus, write 2 things: that you have delivered the prospectus for registration, and about the expert statement that it is included and has not withdrawn consent. Now, this prospectus has to be given to ROC for registration. It has to be certified and delivered to ROC for registration. After it is registered, then only the companies can go ahead and issue prospectus. Fine. If you do not comply with the conditions of prospectus, then 3 sections get attracted. Section 34, criminal liability; 35, civil liability; and 36, punishment for fraudulently inducing people to invest money. So these 3 sections get attracted and you will be liable for them. After this, we have section 390, which talks about IDR, Indian Depository Receipts. Any company incorporated outside India wants to raise funds from India through IDR, it can do so. Central government via section 390 has the power to make rules for IDR. What rules? How IDR will be issued, how IDR can be transferred, how can you sell IDR, right? What is the manner in which IDR will be dealt by the custodian, by the overseas, right? And etc. So all these powers have been conferred to central government. Central government using these powers have made a lot of rules for IDR, but fortunately you don't have to read those rules, so I'm not discussing that rules with you. Apart from this, if you fail to comply with the provisions of the chapter, you have fine. On foreign company, minimum 1 lakh, maximum 3,50,000 for continuing offense, and officer in default, minimum 25,000, maximum 5 lakh. If section 393, kind of important for examination perspective, if the company has failed to comply, if the foreign company has failed to comply with the provisions of this chapter, say for example, it had to file the form of alteration in changes, it did not file, it will be attracted to fine undoubtedly. But does it affect the validity of contracts? It has entered into a lot of contracts with the third parties. So do these contracts become invalid because I'm not complying with the conditions that I am supposed to? No. The contracts will remain valid. If I breach, they can also sue me. So the contracts and my liability that I can be sued remains valid. What is lost is my right to sue. So now I don't have the entitlement to sue. I am a foreign company. I have lost my entitlement to sue the other party, institute legal proceedings, claim set off, counterclaim. Why? Because I have not complied with the provisions of this chapter. If I comply with the provisions of this chapter, then only I can go ahead and sue the other party. Fine. So, what are the consequences of non-compliance? Point number one, penalty, fine gets attracted. Point number two, the contracts remain valid. I can be sued, but I cannot sue. Right? So, these are the consequences of non-compliance. And then you have the very last section 393A, which only talks about exemption. Central government has the power to exempt foreign company or the company incorporated outside India from compliance of provisions of this chapter by notification. That notification will be laid in both houses of parliament, right? So that's it with the quick revision of foreign companies. Okay, now the chapter of NCLT and NCLAT. It comprises of sections 407 to section 434, although in the beginning or the initial sections, you don't have much content. We talk about the composition, we talk about the power of CG to constitute these authorities, that is NCLT and NCLAT, and what will be its composition. If I talk about NCLT, it comprises of the president, judicial member, and technical member. Now, who can become the president? Only someone who has been a judge court for at least 5 years can become the president of NCLT. If I talk about judicial member, someone who has been the judge of high court or the judge of a district court for 5 years, or an advocate for 10 years can become a judicial member. If I talk about technical member, practicing CA 15 years, practicing CS 15 years, practicing CMA 15 years, then someone who has experience and knowledge in specified fields for at least 15 years, someone who has been a presiding officer in the labor court or the tribunal established under Industrial Disputes Act for at least 5 years, or someone who has served as a secretary or joint secretary to Indian government in the Indian Corporate Law Service or Indian Legal Service for at least 15 years can become the technical member. If I talk about NCLAT, it comprises of chairperson, judicial member, and technical member. Chairperson, who can become the chairperson, only a judge of Supreme Court or the Chief Justice of High Court. Judicial member, someone who has been a judge of High Court or the judicial member of Tribunal for at least 5 years. Then a technical member, someone who has the experience of 25 years, and of course proven integrity, ability, specialized knowledge, experience in the specified fields. They will be appointed in consultation with the Chief Justice, and they can be removed also. There are certain grounds of removal. That is, if you become insolvent, if you do an offense involving moral turpitude, if your interest is involved, if you abuse your position. So these are kind of the grounds on which you can be removed. The minimum age is 50 years. However, the maximum age for president is 67. For chairperson, it is 70. For members of NCLT, it's 65. And for the members of NCLAT, it's 67. Their appointment is going to be made for one term of 5 years. Of course, they can be reappointed. So these are all the small points which I have made you recall. Now we come to the main sections. The very first section, that is section number 420. It is opposite of its section number because it talks about rectification. See, whatever application, whatever petition has been given to NCLT, NCLT will hear the case. NCLT will give an opportunity to both the parties to say whatever they have to, collect evidences and all of that, and then pass orders as it deems fit. Whatever order is passed by NCLT, a copy of that order will be sent to the parties. Now, sometimes it may so happen that in the order there's a prima facie mistake. That is a mistake which is apparent from the record. that mistake can be rectified. How it can be rectified? Maybe the parties identify the mistake and they give an application, or the tribunal itself identifies the mistake. So when an application is received, they identify the mistake and give an application to NCLT to rectify the mistake. Within 2 years from the date of order, NCLT will do so. However, in a certain case, rectification is not allowed. Which case? Where the party has preferred an appeal. So if you have preferred an appeal under section 421 to NCLAT, you cannot go for rectification order now. Section 421 talks about the appeal from the orders of NCLT. So whatever order has been filed by NCLT, you might not be happy and satisfied with the order. So you have a time period of 45 days, which may be extended by another 45 days if sufficient cause is shown and NCLAT is satisfied. So within that time period, you can file an appeal in prescribed form with prescribed fees to NCLAT. What will NCLAT do? It will again call the parties, hear the parties, give an opportunity of being heard to both the parties, listen to them, hear the case, and then either confirm the order of tribunal. That means it can say and stand and abide by what tribunal has done, or it can modify, make some changes in the order of NCLT, or it can set aside the order of NCLT. Whatever decision NCLAT takes, a copy of that order is also given to the parties and also to the tribunal, because tribunal is also one such party, right? Thereafter, if you want to appeal, you have to take help of section 423, where you can file an appeal within 60 days to Supreme Court. Supreme Court can again give you an extension of maximum 60 days. So 60 plus 60, you can file an appeal to Supreme Court using section 423. But one thing that you have to ensure is that you can file an appeal to Supreme Court only on a question of law and never on a question of fact. But there is one more point in section 421. What is it? You can file an appeal to NCLAT, that's not a problem. You have the time period also given. But you can file an appeal only if there wasn't consent involved. That means if NCLT has passed an order to which the parties have consented, when you have given consent, how can you again withdraw the consent and then file an appeal? No, once you've agreed, how can you disagree the very next moment? Right? So you don't have the option to appeal if the order passed is with the consent of parties. Right? Now, whatever appeal, whatever application, whatever petition is received by NCLT or NCLAT, they have to dispose it off expeditiously. That is the whole intent and purpose of forming NCLT and NCLAT. So their endeavor, their effort should be to dispose of the application within 3 months. However, if it cannot be done, then you have to record the reasons why you could not dispose of within the above time limit, and the president or chairperson, whoever your head is. If you're NCLT, then the head is president. If you're NCLAT, then there is a chairperson. So they will grant you extension maximum 90 days. Maximum 90 days. Appeal to Supreme Court, I've already told you. To carry out this whole procedure of inquiry or investigation, whatever they are doing and trying to find out or resolve the issue, they need some powers and they need some guidelines also. So one thing, they will not be guided by Code of Civil Procedure. They have to keep in mind Companies Act, they have to keep in mind IBC, and they have to keep in mind principles of natural justice. So they are guided and governed by these three and not by the Code of Civil Procedure. However, they have the powers as are given to a civil court while trying their suit. That means they can call people, they can enforce their attendance, they can issue commissions to them, they can ask for documents, they can even take affidavits, they can call for any public record or document, they can pass ex parte orders, they can set aside ex parte orders, They can dismiss the representations in case of default. They can even set aside the representations in case of default or any other matter. So these are the similar powers which a civil court has while they try their suit, and the same powers will be given to NCLT and NCLAT also while they are trying a suit. Fine, ma'am. Apart from this, sometimes to enforce or execute your order, you need to take the help of the local court jurisdiction or the local jurisdiction. So, how do you do that? A company is registered over here. You take the local district court or you take their help. So, you give a request to that particular court, and they will get the order executed in the same manner as if it were their order, right? So this is the way that you can get your order enforced. You may take assistance or execution of orders from the court where the registered office of the company is situated if the order is against the company, or where the person ordinarily resides where the order is against a particular person, right? Now, after this, if I talk, then if you do not follow the orders of the court, of course, that is contempt of court. And NCLT and NCLAT also has been conferred the power that if someone does the contempt of court, you have the power to punish them in the same manner as High Court has the power. You can delegate your powers to the officers, employees, and your officers, employees, president, members, they all will be called as public servants and will be guided by the rules thereof. You will get a protection just like every judge gets. If a judge makes a judgment, it may not even be very correct and appropriate, but a suit cannot be filed against the judge, right? In the same manner, you also get that protection that if you have discharged your duties in good faith, then no suit can be filed against you that you did this, you did that. No, whatever evidences, whatever facts and circumstances were produced before me, I took decision based on that, and that is my duty. I discharged my duty in good faith, so you cannot question me. Then we have section 429, which talks about seeking assistance. So during winding up or during any IBC proceedings, NCLT wants to take into their custody some papers or some documents or some property. It needs the help of local people out there. So local administration, who is involved in the local administration, it is the magistrates. So you request in writing, chief metropolitan magistrate, judicial magistrate, or district collector, they will help you. So they will take whatever steps they have to. They will use police force, they will use whatever force is required. They will take that property into their possession and hand it over to NCLT. Hand it over to NCLT. The civil courts are not allowed to intervene. No, absolutely not. Even you cannot go to any court and obtain any stay order against the proceedings of NCLT or NCLAT. That is something which is not allowed. At the same time, sometimes in the constitution of NCLT and NCLAT, there might be some defect, but that defect is not going to invalidate the proceedings which have been done so far. Okay, so whatever cases have been heard, whatever decisions have been taken, they all will remain valid. Apart from that, you also have an important section 432, which gives you a right of legal representation. So whenever you have to present yourself in front of NCLT, NCLAT, or any authority, what you can do is you can either go in person or you can authorize someone else like chartered accountant, someone else like company secretary, someone else like a legal practitioner, or any other person. So they can also represent you in legal proceedings. So you have a right to legal representation. And lastly, the Limitation Act is going to apply. You also have the section 434, which is irrelevant and not at all material now. That is a transitional provision which only tells us that whatever pending proceedings are there in front of CLB, they will be transferred to NCLT. So that is something which you don't need to read. Okay. Okay. The chapter of special codes, it covers sections 435 to 446b. But before we go on to the main sections and the core sections, we have some concepts which we must revise, and these are offenses and penalties. What do you mean by offenses? There are three types of offenses basically. The offenses are bailable, non-bailable, cognizable, non-cognizable, as well as compoundable and non-compoundable offenses. Firstly, if I talk about cognizable and non-cognizable offenses, cognizable offenses are more serious ones. And in that, one thing that you have to remember is that the arrest is possible even without any permission or warrant. However, in case of non-cognizable offenses, which are less serious, an arrest without warrant is not permitted. These offenses could be bailable, these offenses could be non-bailable. Non-bailable doesn't mean that you never have the opportunity to get bail. No. Bailable means that bail is your right and you will get it easily. However, in a non-bailable offense, there are strict conditions of bail which must be fulfilled. Only then a bail can be granted after arrest, of course. What are the conditions? I'm telling you one of the condition, that if you want bail, then the prosecutor shall be given an opportunity to oppose the bail. Only then bail can be granted. So this is the difference between bailable and non-bailable offenses. However, when we talk about compoundable and non-compoundable offenses, the offenses wherein you can get away with the court trial by paying a certain amount, right? Like you enter into an arrangement or a kind of composition, that is known as a compoundable offenses, and other than that are non-compoundable offenses. Of course, all the offenses which you commit under law are not compoundable. Example, there are 5 types of penalties which are given under Companies Act. What are the 5 types of penalties which are given under Companies Act? Fine only, imprisonment only, imprisonment or fine, imprisonment and imprisonment or fine, or both. So these are the 5 types of penalties which are covered under Companies Act 2013. However, all these type of offenses cannot be compounded. Wherever there is a probability that court can end up in passing an order of just imposing fine, only those offenses are compoundable. That means out of this, I can say that there are 2 offenses which are non-compoundable. There is never an option to compound that offense. They are imprisonment and fine, and imprisonment only. So these 2 offenses can never be compounded. Other than these offenses are compoundable. If at all you want to compound an offense under Companies Act 2013, what is the process of compounding? If I talk about the process of compounding, that is given under Companies Act 2013, which states that when the proceedings have begun or they have not yet begun, if you want to go for compounding, you can make an application to registrar. That is ROC. Registrar, along with his comments on the same, will forward your application to tribunal, central government officer, or regional director, whatever the case be. Central government officer and regional director have a restriction that they cannot compound an offense involving of more than 25 lakhs amount. For that, only tribunal has the power. Now, they will either compound the offense or they will not compound the offense. If at all they compound the offense, they will inform the ROC within 7 days. There are 2 options. Either the proceedings have already started. If the proceedings have started, they will be stopped. So the ROC will inform the court and the person shall be discharged. He will be free from the proceedings. If no prosecution was yet initiated, of course, there will be no court trial, no proceedings that will be started against the person. There are 3 important points that you must note even in compounding beyond that. One is that compounding is not permissible where investigation is being carried out. So if investigation has started, compounding is not allowed. Secondly, if you have committed an offense for which you have got the compounding done, and within 3 years, again, you want to compound a similar offense, that is something which is not allowed. And thirdly, there may be some additional directions which are given to you by the courts before compounding, and those directions must be complied with. Otherwise, the compounding amount will be doubled. Okay. So after we have read about this, we come to the main and core provisions of special code. The very first one, section number 435, which talks about the establishment of special code. So here CG has the power to establish special code. How many special code? As many as it thinks fit. What is going to be the special court? The old courts, the old session courts can be designated as special courts, or new courts may also be established. Why are they established? They are established for the speedy trial of offences under this act. So all the offences under Companies Act are now going to be dealt only in the special courts, except for section 452. What does section 452 tell us? Section 452 talks about the wrong withholding of property by an employee or officer, the property which belongs to a company. So if you are wrongfully holding the property of the company may bring a suit, and that is not going to be in the special court, that is going to be in some other court, right? Now, what is going to be the special court? The composition or the constitution of special court. I have explained you this before also, that special court does not mean a courtroom. It actually comprises of a judge, right? So who is going to be the one? For the offences which are more serious and involve an imprisonment of more than equal to 2 years, it is going to be a sessions judge or additional sessions judge. However, for other lesser quantum offences, it can be metropolitan magistrate or the judicial magistrate of first class. How the offences are going to be tried? If there is any offense under Companies Act except for section 452, it has to go to special court only. Which special court? The special court which comes under the jurisdiction where the registered office of the company is situated. It may so happen that in such area there are two special courts. In such a case, this problem will be resolved by the High Court. So relevant High Court shall specify which special court to approach. What is the process of trial? Whenever a person or an accused is arrested, he has to be presented either before magistrate or special court. Supposedly he is presented before magistrate, the magistrate can pass two orders. It thinks that, okay, fine, some more custody is needed for better inquiry, so it can order detention, extend the detention. And what is the power of granting detention? If it is executive magistrate, maximum detention that he can grant is 7 days, and if it is judicial magistrate, 15 days. However, if he thinks that the detention is not necessary, then he is going to forward it to special court as it is. The same powers are given to special court if the accused is presented before special court. Now, special court will try the offense, and special court can take cognizance of offense on submission of a police report as well. Special court also has been given the power that if during the trial you come to know that the person accused has committed an offense not just under Companies Act but also under some other act, you can continue the trial of that other act also. As well as you can also try the case summarily. That means you can also go for summary trial. There are two types of trial, regular trial and summary trial. What do you mean by summary trial? Regular trial takes a lot of time, but summary trial, there are some situations wherein you believe and you think that this is a case which does not involve much of time and effort, so we can dispose it off in a quick manner. But for not all cases, the summary trial is available. It is available for the offenses which involve punishment with less than equal to 3 years imprisonment. However, it also has a limitation that a judge cannot award a sentence of imprisonment of more than 1 year. So there are two limitations. Now, during summary trial also, if the judge finds that no, I will have to give a punishment of more than 1 year imprisonment, so he will shift the case to regular trial. Or if he thinks that it is not very fit to try the case summarily, then also he can shift the case to a regular trial. So special court after hearing will record and rehear the case. All the offences under Companies Act are non-cognizable except for the offence which is given in section 2126, which is all about fraud. So all other offences are non-cognizable. When shall court register the complaint and initiate the proceedings? When it receives a complaint in writing by registrar, shareholder, person authorized by CG, liquidator, and if it is a case of complaint of transfer or dividend, transfer of securities or dividend and like things, then SEBI can also be the complainant. If the complainant is registrar or the person authorized by CG, their physical presence during trial is not needed. presence during trial is not needed. Now, after this, we have some small points as well. Section 441, I've already told you. Since special courts are considered as equivalent to the sessions court, if you are aggrieved by the order of special court, you may prefer an appeal to High Court. Moreover, Code of Criminal Procedure is applicable to all the special courts. Section 440, we don't have to read, it is transitional provision. And then we come to section 442, which talks about mediation and conciliation panel. There is not much difference between mediation and conciliation. However, I have made you note the different points. However, if we read the section, the provisions are same for both the things. Mediation and conciliation, there are two aspects which are given in section 442. One aspect is that who can become a mediator or conciliator. So any person who wants to become the mediator or conciliator has to check whether he possesses the requisite qualification or not. If yes, then he can make an application in MDC 1 to the regional director. Regional director may either accept or reject your application. If regional director accepts the application, your name will be included in the panel of experts which is maintained by central government and is updated every year. Now, if you want to withdraw your name from that panel, you may. If you want to, if the government wants to remove your name, they can also remove your name by giving you an opportunity of being heard. The second question comes that if we want to go for mediation and conciliation, how should we approach? That is, how is going to be the process of mediation and conciliation. So when we talk about the process, the proceedings are pending before NCLT, central government or NCLT, and the parties want to go for mediation, then they have to file a form MDC2 along with the requisite fee and request that the matter be referred to mediation and conciliation cell. If the authorities find the need, then they can also refer the matter suo motu. Once the matter is referred, mediator from that expert panel is appointed, and that mediator disposes of the matter in 3 months. Of course, he's a mediator or a conciliator, so he does not have the power of a judge. He can only recommend things. He cannot impose a decision. So he forwards the recommendation to NCLT, NCLAT, or central government, whatever the case be. The parties may not be happy with the decision, so they have the option to raise objections. They follow the procedure which is prescribed. That is, they can discuss with the parties, they can fix the time, they can fix the place, they can fix the meetings, they will meet, they will decide, they can have joint meetings, they can have separate meetings, they will collect all the evidences, all the information, and give recommendations accordingly. After that, we have some very small sections, that is, central government can appoint prosecutors as it thinks fit. Central government can also authorize the company prosecutor to prefer an appeal against the acquittal. There can be compensation which can be claimed from the person who has unnecessarily tried to waste the time of the court by filing a wrong, by imposing wrong acquisitions against anyone. Whatever fine is collected by the court is applied firstly towards the cost of the proceedings and then for making payment to the other party. Then comes your two amended sections. One is section 446A, which talks about the factors for determining punishment. So whenever court has to give a punishment, it will see and take care of certain factors. What are the factors? What is the size of the company? What is the nature of business? Was there any public interest involved? What is the nature of default? How many times the default has been repeated? So repetition, all these factors will be taken in mind, and then only the punishment will be granted by the court. And we have another amended section, lesser penalties for certain companies, which is an important one, 446B. It says that if penalty has to be imposed, throughout Companies Act, a lot of penalties have been imposed on the company. So if a penalty, let's say a company defaults, this company will be liable to a penalty of 2 lakhs. All the companies will be liable to a penalty of 2 lakhs except for one-person companies, small companies, startup company, producer company, its officer in default, or a person connected with such company. So these will be subjected to straight away half penalty. So if the penalty for normal companies is 2 lakh, it will be 1 lakh for this company. If the penalty for normal officer in default is 5 lakh, it will be 2.5 lakh. However, it cannot be 2.5 lakh because therein also a maximum capping has been done. So despite saying that the penalty shall be reduced to half, still there is a maximum upper limit which has been given, 2 lakh in case of company and 1 lakh in case of officer in default. So once again, if I give you an example, the penalty for a normal company is 5 lakhs. Half of it comes out to be 2.5 lakh, but that cannot be imposed even on a small company. So the maximum penalty that can be imposed is 2 lakh, and that only will be imposed. Okay, so I think that's clear.